Good morning. It is 9 a.m. on Thursday, February 3rd. This is Yahoo Finance Live. I'm Julie Hyman. Brian Sozzi right there next to me. He is down at the NASDAQ once again today. And speaking of the NASDAQ, take a look at futures here this morning. We are seeing a deep drop in futures. In NASDAQ futures in particular, they're pulling back by nearly 3%. S&P futures and Dow futures also feeling some pain. But of course, what's going on in the NASDAQ has to do with technology, and it has squarely to do with Facebook. Shares of Meta, of course, the parent company of Facebook, plunging by a historic amount after the company missed on earnings, warned of competition, and said headwinds would continue into the next quarter. We'll have the latest as the company drags not just on its shares, but on the tech sector overall. Spotify sinking as well, but don't blame Joe Rogan. Guidance spooked Wall Street, the company warning of subscriber slowdown ahead. One analyst will tell us why he's still a fan of the stock and of Facebook for that matter. That's coming up a bit later in the show. And not just hodling, but adding. Michael Saylor of MicroStrategy on why his firm bought more Bitcoin and where he thinks the price is going. But first, let's dig into those numbers from Meta. Meta Platforms, as the company is now formally known. Those shares this morning are down by 23%. If it does drop by that amount in the regular session, that will be the biggest single day drop ever for shares of Facebook. The prior drop that we saw was about 19% in July of 2018 after an earnings report. This drop, by the way, would erase more than $200 billion in market value. And why is it happening? Well, take your pick of why it's happening. The company coming out with earnings per share in the fourth quarter that missed estimates. We did see revenue beat estimates by a little bit, but that's not helping matters because revenue forecast for the current quarter of $27 billion to $29 billion compares with a more than $30 billion that analysts had been predicting. Also, monthly active users, not really seeing any growth at 2.91 billion, and the company also, and also the company losing daily active users. So, Brian Sozzi, just wherever you look, billion.
I don't want to look, Julie. It's bad. It's bad. This is a true earnings shock from a company like Meta, given its scale, its size. Where was this warning that this was coming 3 months ago from CEO Mark Zuckerberg? Could they have put anything on that third quarter earnings call to prevent investors that are holding this stock from getting absolutely slaughtered today? The onus is on them. That is a disappointing job by Mark Zuckerberg and Sheryl Sandberg and really even the CFO of the company to really give any guidance that this stuff might happen. So what stuff did happen? Looking at the numbers, the family of apps, obviously that is Facebook, Instagram, and WhatsApp, operating profit margins down 600 basis points year over year. That is a trend or a happening, if you will, that has not been the norm at Facebook since the company was founded many years ago by Mark Zuckerberg. Also, too, fourth quarter ad impression growth down 6% year over year in North America, Julie. And you heard Zuckerberg on the call last night really mention TikTok. Now, I've never heard on earnings calls a Coca-Cola mention Pepsi or vice versa. So to hear Mark Zuckerberg highlight the growth in TikTok as a key contributor in this disappointing quarter and outlook was also shocking.
Yeah, and it's shocking in part because we have seen analysts remain so resolutely positive on the company. Now, there's one who just actually cut his recommendation finally. That's the JP Morgan analyst who covers the company. He cut his rating for the first time since the IPO. But a lot of these folks, they're cutting price targets. There are a lot of price target cuts this morning, but not a lot of downgrade.
No, 82% of the analysts that cover Facebook/Meta on the street, they have rated the stock buy. And to your point, we're seeing a lot of analysts come out here this morning, defend Facebook, really trying to write off 2022 as if it doesn't even exist. Things will get better in 2023, 2024. I even heard some analysts talk about 2025 and what Facebook is doing in the metaverse, and that's all great. But the stock is declining majorly today because there are concerns about the company's fundamentals this year. And can they grow in a world where Apple is cracking down in terms of privacy and in a world where TikTok just seemingly is growing through the roof?
Yeah, TikTok is something that Mark Zuckerberg brought up multiple times on the call as being an issue. And he talked about sort of bringing Reels, which is Instagram's answer to TikTok. He talked about bringing that up to speed, but that is not yet proving to be a formidable enough competitor to TikTok. And then, of course, there's the whole metaverse play, right? The company, for the first time, disclosing what it is spending effectively on what it calls Facebook Reality Labs. That includes the metaverse and virtual reality efforts. So the company said it had an operating loss of $3.3 billion. Again, that's the first time they've disclosed this, and they're going to keep spending there, as we know. So will investors be patient with them if there's a period of slowing growth in the core business while they try to ramp up the metaverse business? That remains to be seen, but today it's not a great indicator on that front. There is another issue that was a huge issue for Facebook in this quarter, and to discuss more about that, I want to bring in our Dan Howley, who covers tech for us. It has to do with the Apple tracking changes. Good morning, Dan. And basically, when you're on your Facebook app, on an Apple device, it says, do you want to be tracked on this particular app? If you say no, that presents some issues. And it seems like that definitely presented some issues for Facebook in this last quarter, Dan.
That's right, Julie. Actually, Sheryl Sandberg had said that it'll cost the company $10 billion this year, this new privacy change that Apple has rolled out. This isn't new, by the way. This is from iOS 14.5. We're on iOS 15, just to give you an idea. And really what this does is it blocks websites, apps from being able to track your activity across the web. So if you do get a notification when you download an app and you say do not track, then it will have a less effective means of measuring ad capabilities. And so that means that advertisers are less likely to want to spend on something like Facebook and more likely to spend on something like Google. And here's why. Because Google is a search engine, and search engines are basically exempt from this kind of privacy rule that Apple has. So you can go into the browser, do a search, and Google will still get that information. Now, Facebook as an app on its own, that will not be able to grab that kind of detailed data. So that's why Google wasn't as hurt, or Alphabet wasn't as hurt as we're seeing Facebook parent Meta being hurt here. And there's a few other things. As you said, they lost users, daily active users. They added a few monthly active users on Facebook, just 2 million. That's barely moving the needle here. And then the Facebook family of apps, that's WhatsApp, Instagram, Messenger, that only added 5 million as far as daily active users and 7 million as far as monthly active users. That is the slowest growth that we've seen for the company in some time. The metaverse, as you said, that, analysts can discuss that as much as they want, but Zuckerberg himself has said that that's 10 years out, and it's still going to cost billions of dollars for them. They said they were spending $10 billion at least in 2021 on it, and we've seen in this earnings that they started reporting Reality Labs that the amount that they're spending is just going to continue to balloon over time. And then outside of that, we just have the general idea that will Facebook be able to come back from these privacy issues? Sheryl Sandberg had said it's a years-long process. So this isn't something that's going to change overnight. They really have to recalibrate and optimize their ad technology, and it's going to take a while. So that's why you're seeing a lot of these issues. And it's not just Facebook. It seems to be bleeding over into the other major social networks and ad-dependent companies like Facebook and Meta.
Dan, I want to stay on that number. $10 billion headwind Meta says it will have this year because of these Apple privacy changes. $10 billion essentially up in smoke because of moves made out of Apple and CEO Tim Cook. If I'm an investor, if I've been holding Meta shares, I need to know when will Facebook overcome these challenges? Are we sitting here 3 months from now and then Facebook is outlining an $11 billion headwind? When could this company overcome this?
Yeah, I mean, look, Sheryl Sandberg laid it out. She said this is a years-long process. Now, the ad tracking and the ad optimization, there's two different things there. She did say that they're doing better in one aspect, but not the other. But this is something that really, Facebook was lobbying against these changes to iOS for a while. They took out a full-page ad in newspapers saying that this is going to hurt small businesses. Sheryl Sandberg specifically said that during the call, saying, look, larger businesses aren't going to be as impacted, but smaller businesses will be more impacted because their ads won't get to the right people that need to see what they're offering as far as products go. And so that could undermine their own revenue. So this is something that's going to take quite a while to shake out. And I think that's why you're seeing this kind of move from investors. This is, I mean, to say this is a shellacking is an understatement. And just to, keep going as far as they are now, I mean, you got to guess that they've got to have something up their sleeve. And that really is the metaverse. But as I said, Zuckerberg himself, 10 years away. So what do you do in that meantime?
Dan, really quickly here, you mentioned some of the other companies that are taking a hit today. You've got Snap down, you've got Pinterest down. There could be implications for Amazon as well. There's one company that wasn't affected by this. That's Alphabet, Google, right? Just really quickly, why wasn't it affected when everybody else seems to be?
Yeah, it really comes down to the fact that they get a lot of their data from YouTube and from Google search. And that's really the big driver there. And because they're a search engine, because people are typing directly into that app, into their browser and using the search aspect there, they're basically exempt from this. So it doesn't hurt them as badly. And so when you look between the two companies, we're kind of looking apples to oranges at this point, no pun intended with the Apple part. But it really is cracking down on the social side rather than the search side. And that's why Alphabet is doing better as far as being able to get the ads. Plus, I mean, look, they have so much data already that they're able to just pull from that essentially.
Right, exactly. Okay, thanks so much for breaking all of that down for us, Dan Howley. Got to turn to another company that we're watching plunge this morning. That is Spotify. And Spotify shares are down by 13%. This has a lot to do with the company's forecast for first quarter subscribers. So it's going to end the first quarter, it says, with 418 million total users, 183 million paid subscribers. Both those numbers short of analyst estimates. You can see here the year-over-year change that it saw last quarter in those subscribers. Actually, last quarter was relatively strong for Spotify. So it really seems here that it is the outlook in this case that is problematic for the company, Saz.
Julia, I wonder if in that image, that person listening to Spotify knows this type of quarter that Spotify came out with, because it wasn't that good. It wasn't as bad as Meta, and they'd probably be pulling their hair out if they were reading this thing. Again, here's another big cap tech stock. You're seeing the street come out here, really defend here this morning after a disappointing quarter from them. I know they beat on earnings or the loss per share number, but still margins were under pressure here. I believe the gross profit margin with the street follows closely on this company, flat year over year. And the bigger issue here, and we'll get into the Joe Rogan stuff in a second, Julie, but no full year outlook. Now I have a piece on the Yahoo Finance homepage really digging down deep into this, but still an environment that is still nervous for tech stocks, as we're seeing here by Meta. You need to come out with an outlook for the full year. Spotify didn't do it, had some concerns, I think, about how the growth will shake out in the first quarter, hence no full year outlook from them.
Yeah, at the same time, Daniel Ek, the CEO, is sort of trying to get investors to focus on the long term rather than just a 1 year outlook. And he has given some big numbers for the longer term outlook. Eventually, he says the goal is to sign up 1 billion users for the company's platform. So that's something, if you're a long-term investor, maybe you can sort of focus on. You and I have talked a lot about podcasting versus music and getting creators on the platform. Advertising sales, by the way, were 15% of revenue last quarter, which is the highest that we have seen. A lot of that advertising is indeed happening on podcasts as well. But if you're going to talk about podcasts, you have to talk about the aforementioned Joe Rogan, don't you? And the controversy that he has engendered, leading some of the sort of classic artists like David Crosby, Stephen Stills, Neil Young, Joni Mitchell. Neil Young, of course, started it, pulling their music from the platform. Ek talked about this as well. He said, usually when we have controversies in the past, they're measured in months, not days, but I feel good about where we are. So he didn't express a lot of concern about this on the call, Saz.
No, but still, you heard the concern in his voice, and just to say that, you may not see an impact in the first quarter from this, but just him pointing out perhaps it's something that plays out longer term. What does that mean for premium subscribers? What does it mean for ad-supported subscribers? And we always like to say the long term is great, and Spotify might hit 1 billion users, and in the long term everything is okay, and that'll be a metaverse universe as well too. But in the near term, in this market, investors want to see companies put up results and solid guidance, and we just did not get that from Spotify.
We did not. As we've been talking about, some people on the street have been cutting their price targets, cutting their recommendations on the likes of Spotify and Facebook this morning. Mark Mahaney still fairly optimistic on both these, although he did cut his price targets. Mark of Evercore ISI going to join us in a little bit to talk about, after all this, what do you do with the shares of these things? So please stay tuned for that. But also, you want to know, what do you do with Bitcoin here? We'll talk to a guy next who has some ideas. I suspect we know what he's going to say you should do with your Bitcoin. Michael Saylor, the CEO of MicroStrategy, will be along in just a moment.
Bitcoin prices are still having a tough time reclaiming the $40,000 level, with weak results out of Facebook not helping investor sentiment. Let's bring in a leading voice in all things crypto, MicroStrategy CEO Michael Saylor. Michael, always nice to see you. Thanks for taking some time here. Have you been frustrated with the price action in Bitcoin so far this year?
Now, my time horizon is a decade or more. The answer to your question, by the way, as to what you do with your Bitcoin is you hodl your Bitcoin. We're hanging out. People buy Bitcoin because they want to buy an asset that they understand that might have value in 100 years. And the truth is there's no security trading on the NASDAQ or the New York Stock Exchange right now that you can understand 100 years from now. We got a long time horizon. And so, yeah, this is near term. There's a lot of risk off volatility, but I don't think that bothers any true Bitcoiner.
And we know that you are a true Bitcoiner, of course, Michael, because we've talked to you about it, of course. You tweet about it. You've put it on the books at your company and on in your personal accounts as well. I would ask, though, when an individual buys Bitcoin and it goes down, it has an effect. When you put it on your balance sheet and it goes down, it costs you, right? It costs you in terms of the accounting for your company, because you get penalized when it goes down, but you don't benefit when it goes up until you sell it.
Go ahead. Your question?
Do you think accounting rules need to change on that front?
I mean, indefinite intangible accounting means that you can only mark it down, you can never mark it up. And in truth, I'd be better off from an accounting point of view to buy a stack of comic books or baseball cards, because I would only be evaluating them for impairment once a year, as opposed to every minute on a Saturday night why people are skittish about a risk-off trade. So I think that the gap accounting isn't a positive factor for a company that relies heavily on it. I believe that FASB's taken this up as an issue. We'll see what they say. Clearly, it would be better if there were fair value accounting for a publicly traded company. And if we ever see a transition from indefinite intangible to fair value accounting, that would be a catalyst for more corporate adoption of Bitcoin.
But could it also, in a sense, allow companies who are going to add Bitcoin to their balance sheets to sort of quote unquote cook their books, or to make things look better than they are? I mean, I guess you could argue on the flip side, things maybe look worse for MicroStrategy than they are right now because of that other accounting.
I mean, with the current accounting for, when Berkshire Hathaway accounts for their ownership of Apple stock, they do it via fair value accounting. So I think that either accounting is appropriate if everybody agrees that's what they're going to do, and then the accountants close the books at the quarter and they account for the assets based upon that guiding set of principles.
Michael, do you see yourself, despite any accounting issues as it pertains to how you account for Bitcoin, do you still see yourself using leverage at some point to go out there and launch more Bitcoin products and perhaps change your strategy at the company?
We have used leverage, and if you could borrow money at 1% interest or 2 or 3% interest, and if you thought that assets were going to appreciate at a dramatically higher rate, then it makes total sense. I think we're in an inflationary environment. The Argentine peso has lost 93% of its value over 4 years. In Lebanon, they've lost 93% of their currency value almost overnight. In environments like that, it's almost criminal not to use leverage. You should borrow in the local currency, and then you should buy a stronger asset. In the United States, I think you can expect a 15% or more monetary inflation rate for the coming few years. So if you could borrow money at substantially less than 15%, then your arbitrage is clear and obvious. So yeah, we think it's a good idea if properly used. It all comes down to the terms and conditions. With all leverage, I mean, I would not recommend anybody go and go long Bitcoin 20 to 1 in a mark-to-market margin loan situation. You're going to get wiped out. But if you have the ability to mortgage your house for 30 years for 2.5% interest, and if you knew that the currency was going to lose 15% of its value a year, then by all means, you ought to buy a house with mortgage. And if you have a house that's unmortgaged, then drawing down a credit line against that real estate in order to invest in a tangible, scarce, desirable asset that's going to appreciate in value at a much higher rate is a rational business decision.
Michael, before we let you go, as someone that has used Bitcoin to diversify their business, look what we're seeing out of Meta this morning here. Challenging quarter. Now, they announced recently they're getting out of the crypto space. Was that a mistake for them? Because if they added Bitcoin into their business and built that out, theoretically, maybe they would be able to just avoid some of these Apple privacy issues and just report better earnings.
Well, to be clear, I think the mistake was not getting into the crypto space. Meta pursued a DM project, and that wasted many, many years of their time. If they were to adopt and embed Bitcoin into their product, they could deliver a compelling offering to billions of people. And I think it'd be worth hundreds of billions, if not trillions of dollars to Meta. So the answer to Meta's problem on the revenue and the P&L side is embed Bitcoin and Lightning into their product line. And the answer to the problem of how do you make cyberspace more secure and improve the quality of your products is to embed Bitcoin and Lightning into your product line. I have 10,000 Instagram bots in my DM, and they're not real people. They attack me. You can't really trust anyone that communicates with you in cyberspace. You can't trust scammers coming at you in WhatsApp. Every day I have dozens of WhatsApp bots attacking me. So if you want to clean up WhatsApp, if you want to clean up Instagram, if you want to make Facebook, and for that matter, YouTube and Twitter safe for children and safe for the world, you ought to wrap those personas in a layer of digital energy, and that would be Bitcoin on Lightning. And Meta's solution is, Jack Dorsey pointed this out. He said, if Bitcoin had existed when Twitter was founded, they wouldn't be so reliant upon advertising, and you wouldn't have this surveillance capitalism problem. Meta's solution is to go from a pure ad model to a value creation model where they become a bank in cyberspace. There's no reason why they couldn't accumulate $1 to $10 trillion of assets on their cloud platform if they built Bitcoin and Lightning into their product line. So I think that's the solution to the problem. They have not embraced Bitcoin. That's the problem.
All right, let's leave it there. MicroStrategy CEO Michael Saylor, always good to get some time with you. We'll talk to you soon. All right, do stick around. The earnings season parade continues. We'll dive into the results out of Qualcomm next.
We're a couple minutes from the opening bell on this Thursday morning, and boy, is there a lot going on. You have, of course, the Meta platform's disappointing numbers. That's the reason that the NASDAQ is down by 2.7%. The S&P and the Dow also getting hit this morning, although the Dow to a much bigger extent. We haven't had a disconnect between those two like this in quite a while. But you also have some other things we got to watch. The Bank of England this morning raised rates by 25 basis points. 4 of those governors voted to raise by 50 basis points. So is that perhaps a little bit of a hint of the thinking that could happen here at the Federal Reserve? Maybe, maybe not, but it's something to watch. Meanwhile, the European Central Bank also at a press conference today didn't raise rates, but it too is winding down its bond buying program as of the end of March. And Christine Lagarde, the president of the ECB, came across as a little more hawkish than perhaps some folks thought that she would. And then we had jobless claims here in the U.S. Saz, is there enough going on this morning? 238,000 was the number of jobless claims, so ticking down a little bit, but it too was likely distorted by Omicron, just like we expect the jobs number from the government coming tomorrow for the month of January to be distorted.
Do you have anything else? You keep going. It's a busy morning, Julie.
Yeah,
I have to go.
We do have other stuff.
I have to go mine that Lagarde transcript. Maybe she has some ideas on how to fix Facebook so they stop warning on earnings.
Something tells me not, although if you talk to folks, regulators in Europe, they have some other ideas when it comes to Facebook that have nothing to do with interest rates, I suspect. But overall, all of this is equaling a push down in the futures this morning that, as I mentioned, is especially acute when it comes to technology. We will talk more about why in just a moment. But here's the opening bell. So there you have it, a dual opening bell, the NASDAQ and the NYSE, showing you this morning as we have this sell-off going on. Cue the confetti, I guess. Maybe if you're short this market, you're throwing some confetti, but otherwise, I think not, as we see this big sell-off going on. So we were just talking about Facebook, of course, and the drop that we have been seeing in the shares, the drop spreading to a lot of other companies that rely on people surfing their apps on their phones. And that's because Facebook talked about the effect of Apple's change to its tracking. Although Dan Howley pointed out it's not brand new at this point, but a lot of apps are still grappling with it. So the likes of Snap and Pinterest and Amazon that are set to report their numbers. Now we've got investors sort of bracing themselves about what those numbers are going to look like.
Well, you might just have to cover your nose for while reading those reports out of Snap and Pinterest. Pinterest was warning of these problems 3 months ago. Snap, the same deal. So it's I understand these stocks trading down in sympathy today. I believe Snap is one of the hottest trending ticker pages on Yahoo Finance this morning. Makes sense to me. But still, how can one think that Snap is going to say anything positive, really, regarding these Apple changes when it reports earnings soon? I don't see it. And believe me, there are people out there trying to spin the situation in Meta positive. I don't get that either.
Yeah, I guess after you see a 24% drop, if you liked Meta shares 24% ago, you like them even more now. Is it, as the old saw goes? But I think we also have to consider if a giant like Facebook is talking about the threat from TikTok, you have to wonder what that's going to mean for other apps as well. Here's a sampling of some of the other companies that were. I mean, that Snap drop of 18%. That's just incredible, Saz.
Yeah, what you're seeing here today is a complete re-rating on Meta. And the market is essentially saying Meta, at least for the next 18 months, will no longer be a growth company, or just as they have been since their inception. And if they are growing, they're not growing at these mind-blowing results. And the big problem is they're still trading at a premium to the broader market, which is, I think the market's still going to have to come out here and adjust just for the fundamental changes here that Meta revealed last night. And there were many.
Yeah, and in just a bit, we're going to talk to Mark Mahaney over at Evercore ISI, and he sort of acknowledges that in the short term, maybe it is going to be, if not dead money, certainly sideways money. I don't know, or we're not going to see the growth, to your point, but that eventually we're going to see it come back. We'll talk to him in just a bit. But we have to talk about some of the other reasons why that we're seeing the NASDAQ under such pressure this morning. Facebook, Meta, and the ripple effect is not the only thing. Qualcomm is also part of the issue here. Those shares not down as much, but they're still down by 2%. Now, the company actually beat last quarter. What happened again here is a forecast issue. So the company is saying here that, and also if you look at some of the individual areas within the company, yes, it's phone chips, still selling relatively well. That's still the biggest part of its business. But some of the other areas where Qualcomm is trying to grow, Internet of Things, and those are faster growing areas, I should mention as well. Internet of Things, for example, was up 41%, but it's still lower than what analysts had anticipated. So that seems to be one of the areas of disappointment here.
Yeah, I'll take the other side of this one. Look, let's look at what we're seeing here. Relative outperformance by Qualcomm, and the stock shouldn't even really be down here, Julie. This was a very, very strong quarter for Qualcomm. Also, unlike many other of these tech companies, a strong outlook. And you had CEO Cristiano Amano. We've talked to him a bunch of times. He's reiterating essentially everything that he's told us. He said on the earnings call last night, quote, "We're seeing more demand than supply right now." And that is a great position to be in. And in many respects, the same tone we heard from AMD when they reported their results earlier in the week. If you're selling chips, that's a good place to be.
And by the way, people have been selling chips, right? We should watch the other chips as well this morning to see how they're doing in reaction to those Qualcomm numbers. It's been a bit of a tricky road there. And then I also want to just highlight what we're seeing with the pharmaceuticals as well this morning, because we had a trio of big pharma companies report. That is Merck, Biogen, and Eli Lilly, all of them reporting their numbers. So Merck, by the way, talking about getting a boost from its COVID-19 treatment, but it's maybe a little bit smaller boost that it had anticipated. Those shares are down by 2%. And the company coming out with a forecast for the full year whose upper end is $7.25 in earnings. That's lower than what analysts had been anticipating. So that explains what's going on with those shares this morning. Biogen shares off by 4.5%, and that guidance too missed analyst estimates. The company talked about a write-down related to its Alzheimer's treatment, Aduhelm, which, as we know, has been having a lot of issues in terms of getting adoption and getting approval from various agencies. And then Eli Lilly, as we mentioned, that is the other of the big three. That company actually reaffirming its estimate for earnings and revenue for the full year. Nonetheless, those shares are also under pressure here this morning. All right, before we go to break, I want to take one last look at Facebook, Meta, Meta. When are we going to have to stop doing that? I don't know. I mean, it's still Facebook. This ticker's still Facebook. It's supposed to change its ticker sometimes in the first quarter. So that 26% drop that we are seeing in those Meta shares at this moment, it's a record drop for the stock itself. In terms of the market value represented, it is a record drop as well. In other words, the more than $200 billion that is being wiped off of Meta's market value today is the largest single day market value drop a company has ever had. Unless, barring something changing before the end of the session, and of course, as we've seen recently, that has happened, that is going to be the milestone for those shares today. We're going to be right back with Brian Belski and talk to him about what's going on in this market. Stay with us.
Soft earnings report and outlook from Facebook is weighing on a market that has seen its share of nervousness in recent weeks. But is it time to get in there and buy that dip? Brian Belski is BMO Capital Markets Chief Investment Strategist. Brian, always nice to get some time with you. This week, look what we have seen. Meta shares getting absolutely obliterated. You had PayPal earlier in the week get crushed. You know, as a strategist, do these reports suggest that the broader market is still overvalued?
Great question, Saz. Nice to see you. Thank you so much for having us. You know, the market is a market of stocks. It seems to us that people are missing the fact that the stock market's done a pretty good job discriminating and indiscriminating with respect to how it's looking at things. For instance, in the beginning of this pullback in January, it was very discriminating, taking out a lot of the high multiple stocks, whether or not it's double-digit price to sales or whatever, on tech stocks in particular. And then it became indiscriminate. When the market becomes indiscriminate, taking out stocks behind the woodshed, as we used to say in the old days, that's when you buy. And I think that's why the market has reversed, because the market became too indiscriminate. Now, with respect to what's happening with Facebook and some of these other names, it really speaks to why you have to be a stock picker and not be making decisions at the index level, Brian, but especially at the sector and industry level. So for instance, we have the very good fortune of running 9 equity portfolios, real live money, $7 billion. We sold all of our Facebook in November, December of 2019. And the reason we did it is we run concentrated portfolios of 35 to 40 stocks. And we think that with respect to our work that in the communication services sector, Facebook is traditionally very correlated from a price performance standpoint to Google. So we made our bets with Google. And now you're seeing this week that the market obviously is paying and being discriminate with respect to earnings. And I think that's going to continue as the overall market, which has been our call for 2022, is transitioning more to a fundamentally / earnings driven market, which creates more volatility, Brian, because of the stock by stock type of trading. But ultimately, we still think S&P 500 closes at 5,300, $245 earnings. And obviously, with the month of January, we were quite humbled with the market being down, and we never like to lose clients' money. But as you know, we're much more fundamentally disciplined and longer term, and we're not going to be shook out by a lot of the fear and rhetoric that's been going on out there.
So, Brian, given that 5,300 target that you guys are sticking with, and given the volatility between here and then, if you don't mind, reiterate and sort of walk me through how we get there. The rocky road between here and then that eventually gets the S&P to 5,300.
I know, Julie, you love it when I get quantity and analytical, so I'm going to throw some numbers at you. So our theme for 2022 is the year of the second derivative, meaning less positive across the board, meaning price isn't going to be up as much, earnings aren't going to be up as much, valuations aren't going to be up as much. And here's the shocker, drop the mic. Inflation's not going to be up as much. We actually think that inflation's in the process of peaking right now. If you take a look at monthly and quarterly statistics, it's already begun, but we're so fascinated with this year over year number, which we should be from an analytical perspective. But we actually think the second half of the year, we're going to see a massive drop off in inflation and a potential supply glut that's really going to drive earnings. You're already hearing the supply chain blame game with respect to earnings across the board. Apple did a great job coming out saying, meh, not really, we're managing it. And I think that's a leadership position in the biggest and one of the best companies in the world. That's why we own Apple across 6 portfolios, I'm sorry. And so I think the way that the year is going to follow through is we've reared an entire generation of investors that all they believe is the stocks go up as interest rates go down. We published a note last week calling the Generation QE correction. We do not think we're going to see 5 interest rate increases. Our great economics department is saying 4 at BMO. We actually think it could be 3, especially given the fact that Mr. Powell I think he's doing a great job. If anybody can thread the needle, it's going to be him. I think he's probably going to move in March and a couple more times and then wait and see what happens. I think that's more common sense. I think we're too stuck in books and too analytical looking at history. Those people talking about inflation, Julie, weren't alive in the 70s. I was alive in the 70s. This is the 1970s. This is the 1980s. And oh, by the way, today's tech sector has nothing to do, no comparisons to the 2000s. So those are some of the hot button issues that we talk to clients about every day. And we'd like to clear up some of that rhetoric and fear that's going on out there.
Brian, I like your confidence. I can appreciate it. How come you don't fear the Fed?
Well, I mean, we know the Fed is going to make a mistake. So let's embrace that. Let's have faith. And in this business, faith is fundamentals, and fundamentals of the U.S. market look great. I mean, in terms of cash flow and balance sheet, the Fed's going to do what the Fed's going to do. And so we can be expressly critical that they're too late. I go back and read what I was writing in 1998 or even 2010, 11. We were expressly critical of the Fed. We thought they should have stopped QE a lot sooner. But again, they didn't stop QE till 2014. I think this is going to take longer than everybody thinks. As we like to say in Canada, it's a process and a discipline in terms of normalizing. I think this normalization process is going to take a lot longer than everybody thinks. And so we know the Fed's going to make a mistake. They probably already have made a mistake. So now let's have faith in the Fed. Let's have faith in that they're doing the right thing. I think Powell is a great Fed head. And I think he's going to do a wonderful job in terms of communicating. We in society, we need to know information right away. And I think he's done a great job in terms of kind of towing the line with respect to the questions and how he's handling a lot of the press conferences. And he's going to stick with what his discipline is.
All right, we'll leave it there. Brian Belski, Chief Investment Strategist at BMO Capital Markets. Always good to see you. We'll talk to you soon. All right, coming up, Facebook shares are getting absolutely slaughtered today after a very challenging quarter and outlook. If you own this stock, you want to stick around. Up next, that is Mark Mahaney, noted tech analyst. We'll talk to him next.
We've been talking about it all morning. Meta shares are plunging this morning. They're down by 25%. That means the market value being erased from this company today is the biggest we've ever seen from any company because of the size of the company and because the size of this drop. So do you want to step in here and get these shares? Are you buying them on sale or should you stay away from them? Mark Mahaney's with us, Evercore ISI Senior Managing Director and Head of Internet Research. Mark, I know you cut your price target on the stock, but you still have the equivalent of a buy rating. What say you here? What are you thinking as you see that share decline in Meta today?
If you're willing to look out 12 months, I think this is a very good buying opportunity. If your time horizon is 3 to 6 months, I think you steer clear of Facebook / Meta. There's a series of risks, headwinds that the company is facing now. Some of these, I guess most of these have been rising for some time. There was the Apple privacy changes, which materially impacted the efficiency of Facebook's ad network. That's going to probably linger on. It's more than lingering, but it's going to be there for several more quarters. And then the next risk is the rise of TikTok as a alternative usage and user magnet that issue is going to be permanent. The question is whether some of these product changes, like adding in Reels, and then just the basic nature of Facebook, a lot of that social media element is actually a very different value proposition than what TikTok offers. And then there are other challenges, including sort of the more temporary macro challenges. I think Facebook will work those through the back half, by the back half of the year. But I think that as you step back and think about the stock, I don't think fundamentals are going to improve, i.e. revenue growth acceleration and margin expansion, until the back half of the year and into 23, which means the shares are probably dead money at this level for at least the next 3 months.
Mark, TikTok is just growing by leaps and bounds. I was just surprised to hear how much Mark Zuckerberg talked about that competitor on the earnings call last night. How can they crack the code? How can they wrestle back market share from that company?
Well, I'm not sure they can. I think there's two things. One is just keep in mind that Facebook Meta is a family of apps. One of which I think is most directly competitive with TikTok, and that's Instagram. But the social media element of the idea of sharing stories, pictures, events with friends and family, that's kind of the core Facebook offering. That's not what TikTok's value proposition is. There are also other apps within the Facebook family, within the Meta family, like WhatsApp. That's not part of the value proposition of TikTok. So I think in part they hedge themselves against the rise of TikTok because of the different proposition that they offer to users. And then the second thing is when they go head to head with TikTok is they're trying to bring in they're trying to better integrate Reels and make that product content-wise, usage-wise, as good as the leader in the field, TikTok. Whether they can do that or not, I don't know. They're certainly investing a lot in that, and they absolutely should be doing that.
To go back to your earlier point about what things are going to look like 12 months from now, Mark. So the TikTok thing seems to be an open question, but those other things that you mentioned, paint a picture for us of the Meta 12 months from now and what it looks like, what its growth looks like at that point, and will it have solved, for example, the Apple tracking issue and some of the other challenges, the non-TikTok challenges?
Okay, that's the right setup. So I think one of the 2 or 3 biggest issues right now, leave aside TikTok, then there's 2 kind of major issues. One is the working through some of the temporary inflation supply chain challenges that Facebook Meta's family of advertisers has to deal with. That's a temporary problem. I think that's 3, 6, 9 months, something like that, till it gets solved. So that would be by the end of 2022. The other one, of course, is the Apple privacy changes. And so the question is, how long will it take them to come up with what I call a son of IDFA, or a daughter of IDFA, or a child of IDFA? IDFA, identifiers for advertisers. That was the system that was built around around Apple and the data that they provided that helped advertisers track, measure, target, and attribute success or failures to different ad campaigns. And that was taken away, for privacy reasons by Apple in the middle of last year. And so it was a wonderful ad attribution, ad targeting, ad tracking tool, no longer available. Facebook and others need to come up with a successor to that. I think they will. There's no particular proof out there that they will, but the stakes are so high, and frankly, the quality of the product development staff at Facebook is high enough. And then there's so much incentive in here because you're trying to fix this for small businesses, for small marketers. So there's just so much incentive all around to get a solution here that I think one will come up, and it will come up within a 12-month period, hopefully, before the end of this year.
Mark, all these companies, all these social media giants, Snap, I'm just looking at some notes here, Snap, Twitter, Pinterest, they're all being impacted by these Apple privacy changes. And of course, Meta last night warned about it as well, $10 billion risk this year in terms of revenue. If you're an investor, what name do you gravitate towards? Do you go to some of the more hyper-focused names like a Pinterest or Twitter on weakness, or do you still stick with Meta?
So of those 3 names that you mentioned, Pinterest, Snap, and Twitter, I think the company that's most impacted and it's trading off the most, so it's the logical trade-off, is Snap. Snap and especially Facebook were the 2 that leaned in most heavily towards IDFA, or the ad tracking, ad attribution models prior to the privacy change by Apple. That's not an issue for Twitter. Twitter really leans much more on brand advertising, and it's only a small issue, I think, for Pinterest. The obvious 800-pound, I guess it's the gorilla, whatever. It's the champion in the room is Google, Alphabet, which had very little exposure to IDFA and is invested very aggressively in constantly improving both YouTube and its core search business. So, Google will remain the highest quality tech name, probably along with Amazon, in the internet space. But I do think that of those four names, we talk about the ad names, my guess is that the one with the most upside here, given valuation and given what I think are its ability to fix some of these challenges, is Facebook, remains Meta.
I want to switch gears a little bit, Mark, and talk about Spotify as well, because that's another name that's being hit today. I guess one of the through lines is the attempt by the CEO, Daniel Ek, to try to get investors to focus on the longer term. Do you think that the same sort of framing that you were talking about for Facebook, a short-term rockiness that translates into longer-term value, do you think that goes for Spotify as well?
Yeah, I think so. I also think that with Spotify, this is I sort of feel strongly that the market's got this wrong. Occasionally, the market makes mistakes, and occasionally I make mistakes too. So I may be wrong here. But with the 10% correction in Spotify shares last night, the results in the fourth quarter, I think, were in line or better than expected. People wanted a full year guide. They didn't get it. They only got it for the March quarter. But the company did express its hope, its expectation that they'd be able to continue to add as many premium subscribers, paid subs in 22, and MAUs, or monthly average users, in 2022 as they did in 2021, i.e. there's no maturation here in the business, which is kind of the overhanging issue on Netflix. And then really it's a question of when gross margins inflect up. But I think that's a when issue, not if. And so you've got a name that trades on price to sales. When gross margins gap up, that means that the price to sales multiple will re-rate or go higher. So I love the unlock opportunity on Spotify. I think the stock is extremely dislocated. They're the leader in music streaming. And I think a lot of these podcast investments have absolutely been the right call on their part. I think this is one of the best cases of a company that's under earning. Their gross margins in their ad business are so low. There's like 11, 12%. You can't find another ad model with gross margins that low. And that's because of all the upfront investments they're making in content. They'll scale against that. So at some point, I don't know if it's this year or early 23, I think it's this year, you're going to get this gross margin inflection point, and you want to be long the stock before then. I like Spotify here now. I'm an aggressive buyer of this dip.
Mark, great to get some time with you. That's not even talking about Joe Rogan, which we could spend another 5 minutes on, but unfortunately we're out of time for the moment. Mark Mahaney, Evercore ISI, Senior Managing Director, Head of Internet Research. Thank you so much. We're going to talk much more about today's market action coming up after the break. About a half hour into the trading session, we've got stocks trading lower, and we just got a read on the services sector from the Institute for Supply Management. It is 59.9, the ISM Services Index, 59.9 in January. That is a little bit higher than the 59.5 that was estimated, but it is a drop from the revised 62.3 reading in December. So again, a drop in services. This has been something that a lot of economists have been looking for. Well, at least that we would see services start to moderate, perhaps, even though manufacturing had been hot, and it has been moderating as well. Factory orders, by the way, speaking of manufacturing, down by 0.4% in December. That number just coming out as well. Ex-transportation up by 0.1%. Durable goods in December, the final read, a drop of 0.7%. So getting some economic data in the past few moments that is, I think, seems a little bit biased to the downside. The stocks had already been selling off. Not sure we're seeing any kind of increased reaction there. Obviously, the big weight today remains Meta, and we continue to see that effect on the NASDAQ, particularly acute. Coming up in the next hour, we'll be talking, of course, more about Meta and the effect of tech on the market. Also, we'll be speaking with FTX co-founder and CEO Sam Bankman-Fried on all things crypto and their latest funding round, plus the CFO of the Hershey company after that company came out with earnings. We'll be right back. Welcome back to Yahoo Finance Live on this sell-off Thursday, prompted by technology. I'm Julie Hyman. Brian Sozzi right there with me every step of the way, as always. As we look at what's going on today, you can call it a tech wreck thanks to the major miss from Meta. It was a historic earnings report, but for all the wrong reasons. The platform losing users for the first time ever. Stock on track for its worst decline ever as well. If you take a look at the broad market, you can see clearly the effect that Meta has been having because the NASDAQ is most acutely affected, as I was saying a few moments ago as well. The NASDAQ off by more than 2%, the worst performer of the three major averages. Also being caught up in this risk-off attitude that we are seeing from today. Bitcoin, that is down as well, and was down as sort of a precursor to the decline we have been seeing in equities. Of course, it's been a rough start to the year in crypto as well. Investors are still getting in, though. FTX CEO Sam Bankman-Fried will be here on the heels of the company's latest fundraising round. He'll be along in just a bit. Plus, tax filing season's underway. It's expected to be one of the most challenging in years, not just for you, but for the IRS. What you need to know as you get ready to file. That's later this hour in our Financial Advisor Corner. But first, we got to check in with our Jared Blickery as to what is going on in these markets today. Take your pick. There's a lot of carnage to choose from, Jared.
Yes, those Facebook earnings, an absolute disaster. And let's take a look at the Wi-Fi Interactive to chart some of the price action. Going to start with the indices, and especially the NASDAQ getting clobbered for 2%. Communication services, which houses Facebook, by the way, down the most since the pandemic lows in March of 2020. But the S&P 500, I just want to spend a couple minutes on, or a couple seconds on, because it reached an important inflection point, which it sold off from yesterday. I've been talking about the S&P 500 needing to clear 4,600. That is not the case right now. So shorts back in control. We'll have to see if this holds, but not the best news for the bulls at this time. So here's the NASDAQ, and all eyes are on Facebook right now, down 15%. And Brian Sozzi, I agree with you. What kind of guidance did we get? There could have been some kind of preliminary announcement. This really reminds me of what happened in 2018. This was that one-day drop that they just surpassed, by the way. And we saw a slow, steady bleed down. We didn't find the lows till much later. This stock is dead money for a while, and so are a couple others in sympathy. Amazon is not one of those, but it is down as well because of those problems caused by Apple removing the ability to so easily track users across different websites. So here, Amazon back to potential support, kind of flirting with something. If it breaks down from here, probably going to see some more downside accelerate. And I got to check out some of the other stocks that we've seen and we've been talking about today, specifically Spotify. Now, this isn't necessarily as affected by the Apple change, but I want to show a max chart here. I'll put some candlesticks on. You can see Spotify, after breaking down from this potential support area, it is heading down, and we don't really have support until about the 90-95 level, so could see some more there. Interesting to get Mike Mahaney's comments on Spotify, and I think he's spot on. But right now, the stock is dead money, so you got to have a longer-term view if you're going to catch this falling knife. Here's the sector action, and we see communication services, as I said, that is down 5%, followed by consumer discretionary, Amazon, weighing that sector down by 2%, guys.
We did get guidance from Meta. We're all going to have avatars, apparently, in the metaverse. That's the guidance from Meta. Yeah, I'd rather talk to the actual faces of people, but that's just my own personal bias. Jared Blickery, thank you so much. Here's another face, an actual face I'd like to talk to. It's Tony Dwyer, Canaccord Genuity Chief Market Strategist.
You should really go to the metaverse.
No way. Tony, it's good to see you. Now, as we see what's going on today, what is the sort of takeaway? I know that you have been warning investors to brace for volatility. Here it is in spades. What's the sort of takeaway? I mean, this is not just an interest rate increase related fear for Facebook. This is real stuff.
Yep. It's the differentiation you get in the transition of an economic cycle. From where, remember, Julie, what happens is coming out of a recession, each recession is unique in the way that we get in there. It could be the pandemic, it could be the great financial crisis, 9/11, the savings and loan crisis in the early 90s when Saddam Hussein invaded Kuwait. Ultimately, the response is always the same, which is throw as much money at it as you can. And when you throw as much money at it as you can, all of that money has to get invested. And that money typically gets invested in financial assets as well as things like houses and stuff like that. So this is not unusual where you get this kind of differentiation, and it's going to continue. I know that there was another mega cap name yesterday that reported that did really well, and folks were like, okay, that one did really well, so these might do well. And that's not the way it worked out, because there is that differentiation at this point in the cycle.
Tony, if trades like Facebook and Netflix, they're not going to work, and they haven't worked. Meta getting creamed here. Netflix got creamed on its earnings. Where do you think investors should hide out?
Well, the problem, Brian, is that everybody thought that some of these mega cap, growth names were defensive. And it's not proving out that way. So unfortunately, the top five, according to Ned Davis, at the end of the year, the top 5 stocks in the S&P 500 accounted for about almost 30%, the better part of 30% of the index, which is historically the highest since the early 70s. So you're in this situation where a lot of folks went to these names thinking that they're defensive, and they're not. And what happened is you're seeing that money come out of them, which is probably exaggerating some of the moves. But again, as you guys know, I don't talk to specific stocks. I'll leave that to the analysts. But it really, again, this hits that whole tumultuous feel that we're going to have coming into this year. And guys, it's not so dissimilar to what happened in 2005 in the first half or 2011 in the first half.
I want to bring up central banks for just a minute because we have a lot of news on that front today. The Bank of England raising rates 25 basis points. I just saw a headline that even though the ECB is not explicitly saying it is going to be raising rates necessarily, it is going to be winding down its bond buying program. There's a headline, it may be recalibrating, quote unquote, in March. We know what the Fed is doing. What does all of this do to investors' ability to find stuff that's going to be resistant in that rising rate environment?
Well, resistant to the initial impact psychologically, or the resistance to what it's actually going to mean toward their interest expense. So, Julie, I think it's really it still blows my mind when I say it out loud. We're talking about the Fed raising up to maybe 4 to 5 times this year, according to some, maybe even a 50 basis point, winding down the balance. They're still buying bonds. If they were that worried about inflation, why didn't they stop buying bonds at the January meeting? So they're still uber accommodative. That's where I differentiate a little bit. I think the Fed is going to lower fewer times than the worst case scenario. But I think that this whole the Fed fear and the economic transition I talked about from doing stuff because we were given so much money and we're sitting at home to buying stuff to doing stuff. I think that's going to be a really important and strange, tumultuous time in the first half. But this whole idea that the Fed is going to be extra and excessively tight, I think sets the stage for the recovery toward the second half.
So it sounds like, to boil all that down, you think the market is too hawkish here when it comes to what it's expecting, not just how many times it's expecting the Fed to hike, but the effect that is going to have on stocks and on the real economy for that matter. Am I extrapolating too much there, Tony?
Well, Julie, as you know, when I say I think or I believe you should run the other way, I go by the data. And I got the 10-year inflation break-evens, which as I look over are 2.42%. They've actually come down a little bit, I think, in the month of January. So the long-term inflation break-evens, the 10-year note yield at a 1.8%. Tells me if you think the Fed is going to 2.5%, you better bet on much higher long-term interest rates, which aren't happening. So the way the inflation break-evens and the long-term interest rates, they're suggesting the market believes, or real investors believe, that the Fed will be successful in transitioning from this high inflation environment back to a more normalized environment. And again, that should happen as we get into the second half. There has been a historic rise in wholesale inventories. And when you have a supply chain constraint, what companies and households do is if you want 10 widgets, you buy 20. You order 20. Well, the wholesale inventories are led by goods orders by 5 months. Goods orders are coming down dramatically, which suggests you're going to start depleting those inventories over coming months, which means you're going to be producing less goods. That's that weird transition where we're going to have a Fed in a box that's going to be raising rates beginning in March. Dot plot says 3 times. But you're going to be doing that at the same time as getting this economic transition from buying stuff to doing stuff. So it's going to feel soft and squishy. So it's just going to be it just makes for a very difficult investment environment in the first half.
In the second half, Tony, do you think the market is set up to rally into your end and the ground is set for another year of double-digit returns? Not like we saw last year, but could we see the S&P 500 and the year up 10%?
I don't think we'll see it that much. On December 6th, when we put out our 2022 outlook, we called it a plus or minus year. Brian, it should. So let's go to the data. Since 1980, when you've had the S&P 500 up more than 25% in a calendar year, the next year has a median gain of 13% with only 2 negative occurrences. So history certainly suggests that you're going to have a positive year. There are a few instances of less than a double-digit percent, and I think that's likely to be the case. But we have to see what the Fed is doing going into year. If the Fed is super aggressive and the 10-year continues to stay low and even come down further, you're going to be darn close to an inversion, which isn't great. Doesn't mean the market or the economy goes negative right away, but it's definitely going to be a heads up.
And so finally, what do you do strategy-wise here? I mean, if we are seeing this sort of differentiation within sectors, can you employ a sector approach, or do you just have to be a stock picker here?
Julia, it's really risk on or risk off. I was talking to a healthcare executive earlier today. I don't know, is healthcare defensive or offensive? You've got pharmaceuticals, which are defensive. You've got biotech and med products, which are offensive. So I think in this environment, in the first half, and it's proven to be true, I think we want to avoid a catastrophic mistake versus making a bet. And by avoiding a catastrophic mistake, you don't sell into the kind of sentiment we had early last week. Right. And you don't feed into an 8% rally off the intraday low in 3 days. It's just avoiding getting too negative when it's down or too positive when it's up. It's going to be this kind of tumultuous volatility around Fed policy and economic transition.
Steadiness should rule the day, it sounds like. Tony, thank you. Good to see you. Tony Dwyer, Canaccord Genuity Chief Market Strategist. Appreciate it. All right, we got a stat of the day for you folks. The jobs report, we're focusing on that, but consumer balance sheets look to be okay in the face of that. $19 trillion, that's household net worth, 15% above pre-pandemic levels here. That is a stat that Michael Darda at MKM Partners is throwing out there. But if you talk about inflation's effect on that household net worth, it's actually only about 9% above pre-pandemic levels, something to keep in mind here. Coming up next, we're going to talk to Sam Bankman-Fried, FTX co-founder and CEO. In this period of crypto volatility, he's still raising cash. We'll be right back.
Most Bitcoin bulls are staying true to their outlooks for the crypto, even as it has had trouble reclaiming the $40,000 level, and regulations are likely looming. Let's talk more about this with FTX co-founder and CEO Sam Bankman-Fried. Yahoo Finance's David Hollerith is here as well. Sam, good to see you again. You're hot off another capital raise, $400 million, valuing your company at $32 billion. Help us understand how you've been able to raise this amount of money, just given the price declines we have seen across the crypto market.
Yeah, I mean, I think one piece of it is that we've continued to have strong growth in our market share over the last year. We've been really excited to see that, and excited to see that continue. I think we've also been building out our regulatory suite quite a bit, and are excited about what's coming there in the next year. And I think the last piece of this, which is pretty relevant, is when you look at sort of the difference between public and private markets right now, there's definitely been some real selling off in public markets. But in the venture side, I think markets have remained fairly strong. And we've seen VC funds continuing to raise substantial funds over the last month.
Yeah, and Sam, getting back to sort of the crypto side, so obviously you started an exchange originally because you were, at least personally, somewhat dissatisfied with the products that were currently being offered. And sort of compared to something like the stock market, crypto market structure is still fairly new. So I was sort of curious, with all these announcements, you're sort of going in a lot of different directions, a lot of different possibilities. I was just curious about some opportunities for improving the crypto market structure that you're interested in, particularly with FTX.
Yeah, absolutely. And I think we're really excited about what we can do there. I think that one piece of it that we've seen is, our ability to build out a robust risk management suite and, margin engine, which can sustain, stable markets even through 20% market moves, 50% market moves that we've seen. And I think that's something that we're, really excited to have built out. It's a 24/7, 365 risk engine. I think another piece of this is starting to look at the model that we have in cryptocurrencies and what this could mean for the financial sector more generally, where everyone has direct and equitable access to the platform. And we think this is really important, that we don't charge for market data, we don't gate our market, and we don't gate market access to people willing to pay tens of millions of dollars a year for access, licensing, co-location, and data fees.
Yeah, and Sam, I know you're not necessarily a security expert. I don't want to hold you to that, but I'm curious about your opinion on this. Wormhole, the token bridge, so sort of it's like a software that allows people to take cryptocurrency on one blockchain and move it over to another, was exploited yesterday, and it looks like it's still developing, but it's something like a $321 million exploit. So I was sort of curious, the whole idea of a token bridge is that people would be able to move assets across blockchains. So I kind of wanted to know your thoughts on what this means in terms of the development of token bridges, whether or not people would do that, or maybe this is just growing pains.
Yeah, I think to some extent it's growing pains. And I think the other thing I want to say is bridges are hard. We've spent years building out the wallet software that we use for FTX. And, it's hard even just to build in the functionality, let alone the security side of it. I think that, being able to offer a service which is both fast and efficient for users, but also secure, it's not a trivial problem. I think it's something a lot of bridges have struggled with. I think they're making progress. I think the Wormhole team, I think it's a strong team, and I think the fund's been topped up. I think customers will end up losing funds from it. But yeah, I think it's real growing pains, and I think it's something that we may see from a lot of bridging providers.
And Sam, it's Julie here. I wanted to follow up on that a little bit because, of course, that's just the latest hack that we have seen or security vulnerability that we have seen. So why do you think this keeps happening? And what do you think platforms need to do differently when it comes to their security approach?
So, and I, with a lot of caveats here, including that I don't know the details of what everyone is doing right now because much of it is not public.
Right.
You generally don't want to make every piece of your security suite public. But my general sense, for what it's worth, is that the thing that people are most likely to miss is having various sanity checks all over the place. You can try and build a perfect system, but the truth is no system is ever perfect. And I know a thing that we spent a lot of time doing at FTX is making sure that in addition to the standard set of checks that we have in the standard protocols and procedures, we have a number of just heuristics to try and alert for unusual behavior, to try and flag things for review, and generally to try to have redundant checks in place for like are each of our wallet balances exactly what we think they should be, and if not, then like something weird happened, and that's probably something to investigate. And so I think that's sort of my biggest piece of advice, is that in addition to the standard protocols, think about a lot of sanity checking that you can integrate to your wallet or bridging software.
Sam, I think the crypto industry generally agrees that regulation is coming, and in some ways it is good. Do you think the SEC should be the one that regulates the crypto industry?
So I think it's mostly inevitable that both the SEC and the CFTC are going to play a role in regulating the crypto industry. They're the two primary markets regulators in the United States, and crypto is a markets-based system right now. I think that you're certainly going to see digital security tokens having at least some SEC purview, and you're going to see digital commodity futures having at least some CFTC purview. I think that there's a lot left to be resolved about what happens with spot commodity transactions, about what happens with stable coins, and what happens with tokens that fall somewhere in between categories. I think that a joint regime could make a lot of sense here between the SEC and CFTC. I think that you could see, especially on the clearing, custody, and sort of margining side, the CFTC playing a large role. It's what they have a ton of expertise in. I think the asset issuance side, the SEC is almost certainly going to end up playing a significant role here. And that's my best guess for I think what we're going to see going forward.
And Sam, you actually got into the crypto sector as a trader originally. So I have to ask, you clearly are spending a lot of time on philanthropy and your company. But, are there any sort of opportunities or segments of the market that you're watching with interest right now?
There's always a lot of interesting things going on, and I can't help but watch markets. I don't trade anymore, although I certainly enjoyed it, years ago when I was actively. I think that things that I'm looking at the most right now are, first of all, which things are resilient through down market moves. I think that tells you a little bit about what the real kind of firm backing is behind some of these tokens, and what the core community is. I think that, as always, looking at layer ones, layer twos, and seeing how they're performing. And then I think the last thing that I'd say, which is really interesting, especially through volatile markets, is to look at funding rates, look at interest rates on borrow markets in crypto, and see if you can line those up with market demand and supply, because there's often really interesting relationships between whether futures are trading at premium or discount, and what that says about which direction flow is going in. And then you can try and line that up with, well, what's a Bitcoin borrow rate, what's a US dollar borrow rate in crypto.
FTX co-founder and CEO Sam Bankman-Fried, good to see you again. Thanks for hopping on. Yahoo Finance's David Hollerith, good to see you as well. All right, do stick around. We'll have some headlines you need to know next.
There's another earnings report that bears mentioning this morning. Oil giant Shell reporting a big beat on full-year profit and the highest quarterly profit in 8 years. Company suggested earnings $19.29 billion for the full year 2021. Shell also announced an $8.5 billion share buyback authorization in the first half of 2022, and it's going to boost its dividend by 4% in the first quarter. The CEO, Ben van Beurden, describing 2021 as a, quote, momentous year for the company, said the last 12 months would enable Shell to move faster on the future goals of the company. The shares are trading little change right now. By the way, there was just a reorganization of the share structure, and it's no longer known as Royal Dutch Shell either, just plain Shell. Airlines are urging the Biden administration to remove the testing requirement for vaccinated international travelers coming to the United States. They argue the move would help the travel industry recover at a quicker pace. In a letter to the administration, the group noted that surveys of air passengers indicate that testing is a major factor in their decision not to travel internationally. The letter was signed by Airlines for America, which represents Delta, American Airlines, Southwest, and United. And Tesla is recalling more than 817,000 vehicles in the U.S. because the seatbelt reminder sound may not chime if the driver has not buckled that seatbelt. The recall covers the 2022 and 2021 Model S sedan and the Model X SUV. That's according to documents posted by regulators. Safety laws in the U.S. require the chimes to sound once the vehicle has started. Tesla said it's going to fix the problem with an over-the-air software update this month. In other words, it's not like the recalls of old where you got to take your car back to the dealer. You just upload it, I guess. All right, we're going to take a quick break. When we come back, Hershey out with better than expected sales and earnings. CFO Steve Voskuil is going to join us to discuss the results. That's coming up next.
Candy giant Hershey is out with better than expected sales and earnings. The company also struck an upbeat outlook for profits this year, despite being in a very inflationary environment, just like many others in the packaged goods space. Joining us now is Hershey CFO Steve Voskuil. Steve, always nice to see you. Thanks for taking some time. We were in search of some good news in the markets today, and it's coming via Hershey. The results you put up today, does that reflect that we have become even more a nation of snackers during the pandemic?
Well, we certainly have. We're very pleased to finish the year on a strong note. There aren't many years where you have the opportunity to deliver double-digit top and bottom line growth, growth across all of our top 20 brands. I think average growth across that group of 12%, record cash flow, record production. So all in all, very pleased with where we finished. And yes, we are ever more a nation of snackers.
And Steve,
go ahead, Seth.
No, I was just going to follow up on that. It looks like you were able to push through price increases in the most recent quarter. How much have you been able to push through in terms of price?
Yeah, so over the course of last year, through a series of price increases, we've been able to take our whole portfolio up, mid to high single digits, depending on which part of the portfolio. We will take that benefit forward into 2022, and we're going to need it. Like many companies, we're facing the same sort of inflationary pressures across all the input costs that go into making Hershey and Reese's taste great.
Steve, it's Julie here. So when you look at those input costs, what do you see going forward? We know that costs have been going higher. What is this year going to look like? What kind of visibility do you have?
Yeah, we have pretty good visibility. We've got a hedging program, and as you'd imagine, with as much as we consume of some of our ingredients, we need to purchase those well in advance and have some long-term contracts in place. Across the commodity space, the areas where we're seeing some of the biggest increases include sugar, dairy, nuts, specialty ingredients, and packaging materials. But if I step back and look more broadly, of course, we're seeing inflation in areas like labor and even services that are provided by third parties. When we look across all of those impacts for us, we see inflation pressures in the mid to high single digits for 2022.
What has surprised me, Steve, is that a lot of retailers have been working down their inventories in many product lines, and that has impacted the packaged goods space. Any signs that might alleviate this year, and you'll see the likes of a Walmart and Target rebuilding how much stuff they stock in the stores?
Yeah, we believe it will. In fact, as we've contemplated our guidance for this year, we're assuming some level of build back of retailer and distributor inventory. Of course, we also need to build back some of our own inventory. But we're counting on some recovery, and that will allow us to get our customer service levels up higher and just do an even better job of serving our consumers.
Is Hershey should investors think of the company as a confectionery player or more increasingly as a salty goods player? You recently made that acquisition, $1.2 billion total of Dots Pretzels, that gets you into the pretzel space.
Yeah, that's right. I mean, more and more, we want to have that balance in our portfolio. We are, first and foremost, still a confection company built around those great brands that are our heritage. But several years ago, we began the first steps into building out that snacking portfolio on the savory side. And that includes the brands Skinny Pop and Pirate's Booty, and as you said, Brian, now Dots as well. And we're very excited about that part of our portfolio. It is seeing even more robust volume growth than we've seen on the confection side as people look for savory snacks as well as sweet snacks. And we look forward to seeing that portfolio continue to grow and expand and gain scale as we go through 2022.
Should note that Hershey shares are now at a record high after this quarter, and outlook from you guys today. Lastly, Steve, I was reading an analyst note, and they said that you are expanding manufacturing for gummy products. What might you launch this year?
Yeah, so our Jolly Rancher gummy product has been doing great. We're going to launch some new flavors. One of those is called Very Berry. I have some in my desk. That will be one of the products that we bring out in the gummy space this year. And, the sweet space and gummies in particular is a rapidly growing part of confection, and we want to continue to meet consumers' needs in that space.
Anything with caffeine, Steve?
Nothing with caffeine. Not
Gotta
yet.
ask. Gotta ask. All right, just gotta ask for myself. Personal interest question. Hershey CFO Steve Vosko, good luck this quarter. We'll talk to you soon.
Thank you.
All right, coming up, we'll dive into all things tax season. Yes, we're almost there, people. We'll be right back.
The IRS is reportedly hiring 1,200 new employees to help the agency in what is predicted to be a very challenging tax filing season, perhaps the most in years. So let's talk about how perhaps you can best prepare. Joining us now is Jamie Hopkins, Managing Partner of Wealth Solutions at Carson Group, as a part of our Financial Advisor Corner to help us with some of these questions. So I guess first up, with that precursor that the IRS is going to be swamped. They're already swamped. They're still working through the 2020 stuff. What do people need to know now? I mean, should people be filing as early as possible, for example?
Yeah, it's a great question to ask. What should people know about taxes right now, being that there's still a lot of returns not processed from 2020? I put people into two categories here with should you file quickly or slowly? There's one group that if you're looking for a refund, you expect a refund, your taxes didn't really change a whole lot from last year to this year. Tax season is open. You can start filing. So get those in as soon as possible. The longer you go, I actually think the more likelihood is that we're going to see delays as things break down, as some complexity arises. So if you're looking for a refund, get that in quickly. Now, if you're in a little bit more of a complex tax situation, I've been telling some people to maybe hold off for a little bit. I don't think it's super likely, but there's still conversations in DC right now. There's governors that were on TV last week talking about they would still like to see some retroactive tax changes to last year. As I said, I don't think that's super likely, but if you're in a more complex situation, just making sure you get everything documented, that you feel good about heading into tax season. I see it every year where people rush in, they don't have all their forms. Maybe they've got partnership forms and other forms that are delayed right now. They're filing things and then having to amend after tax season kind of closes out on April 18th this year. And that creates additional complexity. So if you feel that you've had a complex situation in the past, you've got additional state income, I'd say, maybe even consider filing an extension or waiting. That doesn't get you out of the taxes you owe, but there are really two different groups of people there when you're thinking about, should I rush to get in or should I take a more measured approach?
For those trading that have been trading crypto very aggressively, or traded aggressively last year, what's your advice to them as they approach tax season this time?
A piece of advice on the crypto side is, look, this has been taxable for a long time. The IRS considers exchanges, trades in non-qualified accounts, which is most of the situations in which you're going to be trading crypto. Any of those times where really any transaction occurs, it's a potential taxable event. Unfortunately, most people have not been tracking that. They haven't been tracking their cost basis, the interactions that they're having. I even heard an accountant say this recently. Oh, I took all of my crypto and I bought a vacation, so it's non-taxable. And just staying there being like, we've got accountants that are getting this wrong. So first of all, it's track it and report it. The IRS is getting reports now from a lot of the major crypto exchanges. So they do know what you're doing. If those things are not matching up, you could find yourself in a little bit of trouble. That wasn't always the case 2-3 years ago. If you go back to President Joe Biden's budget back in last April, looking back there, he actually said, look, we expect to get more tax revenue than ever before from crypto. And so the IRS is going to be honing in on that. I did see some of the exchanges are starting to send out some tax forms. I saw that in the last couple of weeks. So if you're getting one of those, or even if you're not, but you are heavy, as you said, in trading, exchanging, anything with crypto, make sure you talk to your tax professional. And it is on the form now. Your 1040 will ask about crypto.
Very, very important note for folks, for sure, Jamie. When it comes to deductions, I know you noted to us that IRA contributions tend to be overlooked. What do people need to do when it comes to those contributions?
The IRA contributions get overlooked in the sense that a lot of people think, well, it's, we're now in a new year, so I can't make contributions for last year. If you read up on financial planning articles, you're going to see people talk about that all the time, but we can make those IRA contributions for 2021, last year, all the way out until this year, April 18th, which is our tax return date for, our 2021 returns. So you can put, $6,000 into a traditional IRA, deduct it per spouse, $12,000. And if you're over age 50, you can do to an additional $1,000 per person. So all of a sudden, we're talking about a $14,000 potential way to save for your future retirement, invest inside the IRA, and create a tax deduction. That's just often overlooked because we're thinking about this year. We're thinking about moving forward. The same is true for Roth IRAs, although we won't get a deduction, and HSAs, health savings accounts. If you're in a high deductible plan, that one is probably arguably overlooked even more to go fund that HSA for the last year. And I consistently tell people, if you were in a high deductible plan, you really should be. If you have the financial means to fund the HSA, you should be considering it. It's one of the best benefits from a financial planning standpoint or tax standpoint from having an HSA and high deductible.
Good things to keep in mind across the board. Jamie Hopkins, thank you. Managing Partner of Wealth Solutions at Carson Group. Appreciate your time this morning for our financial advisor corner. Let's take a look at stocks here. We are seeing stocks come up off the lows a touch. The NASDAQ is still down, though, by more than 2%. But there are some stocks that are higher, not just higher, but hitting record highs today. We mentioned Hershey a few moments ago. Here's some others. AbbVie, Lowe's, Travelers, Parker Hannifin. Yes, Mr. Sazi?
Yeah, Hershey. Hershey had a record. Look, they just put up results that you just have not seen anywhere else in packaged goods. Hershey pushing through price increases. What inflation? Dropping the mic, Hershey.
Well, they're pushing them through because there is inflation, right?
I'll buy whatever they're selling.
We're going to take a quick break. We'll be right back.
Welcome back to Yahoo Finance Live. And Julie, I was just spending a few seconds over in the Yahoo Finance YouTube page, just looking at the commentary this morning. First, I want to give that whole group on there a shout out. A lot of Yahoo Finance love, a lot of loyalists, but really a group looking what to do next with tech stocks. This sell-off on Meta just continues, and it's actually accelerating.
It is accelerating in Meta, although the effect on the overall market is moderating to some extent. So here's Meta. I'm taking a look at the 2-day chart just to show that incredible leg downward. And as we've been talking about, not only is it a record one-day decline in percentage terms for the stock, it's also wiped off a record amount of value in a single day. And that's not even to get into what we've talked about, what we haven't touched on yet, which is Mark Zuckerberg's net worth as a result of this falling, right? But in terms of what we're seeing from the NASDAQ on a broader level as a result of this, take a look at the two-day chart for the NASDAQ. Yes, we saw that leg down, but actually the NASDAQ is up a little bit off the lows of the session. So yes, it's a broad-based effect here, but it's not as bad as it was very early on in the session. The ripple effect, though, is being felt certainly when you look at other types of companies that play in this space. So Snap, down 20%. We talked to Mark Mahaney earlier. He said of the sort of social media companies, Snap is perhaps the most exposed to the tracking changes, IDFA and the Apple changes that have been made that allow ad tracking across websites. So Snap perhaps the most vulnerable to that. Amazon, which is about to report its numbers, is off 6.5% today. It's hard to see that they would be as affected by some of those Apple changes, but we'll see what else those numbers show. But certainly the 6.5% drop shows the trepidation that's being reflected here. Spotify off on its subscriber growth forecast, off by 13%. Merck down as well because some of its numbers and estimates for its COVID-19 treatment perhaps a little bit lower than had been estimated. Pinterest down along with Meta as well. Shopify down. I mean, there's just carnage here. I want to mention Honeywell as well, which is on the list. Obviously, this has nothing to do with Meta, does it? But the company is down on an outlook that missed estimates. Here's one little area of green, Brian Sozzi. T-Mobile. Look at that. It's up by 10% today. That's after its earnings report, subscriber growth beating estimates and its outlook ahead of estimates. So not everything is red today. There are a couple things that are in the green.
Yeah, not everything is red. You're right. T-Mobile and Hershey, again, I cannot say this enough. The company's stock, record high, better than expected quarter, better than expected outlook. We just talked to the company's CFO. Sounded pretty optimistic to me, but it just really underscores, and this should serve as a reminder that there are more stocks out there besides Facebook, Amazon, Apple, Netflix, Google, and oh yeah, plus Microsoft. Do your homework. Go find those winners so you don't get slaughtered, because if you bought Facebook a week ago, you're getting obliterated today.
You are. That's true, but not unless you sell, as I always like to say. If you hold on here, maybe it could go. Maybe you could recoup your losses. We'll see. One more look inside the Interactive, because I just want to. I noticed one other stock that's higher today. Oh, there are a couple, but one other. The one right in the middle here. Tesla's up today, friends.
Tesla, we know
Look at that. It turned around. It was lower earlier. Now it's up by 2%. So this is another one. It's a high momentum name for sure. I mean, listen. The chart year to date still looks ugly, but it is interesting to see it going counter trend on a day like today. AMD recovering, you can see there, it's off, or I shouldn't say recovering, it's up for the second straight day after its earnings. So it's getting a little bit of momentum here. Now it's up 7% over the past two sessions. So it's not just in good old fashioned Hershey, Brian Sozzi. It's also in some other hot tech names that are on the rise. That does it for Brian and I. After a very busy 2 hours, we are going to turn it over to Akiko Fujita and Brian Chung for the next 2 hours. We'll be back here tomorrow early for Jobs Day.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We've 90 minutes into the trading day right now. We're seeing Facebook derailing the tech comeback. The stock here, we should say Meta, seeing or on track for its biggest single day drop as weakness in the quarter. Mixed guidance sends investors fleeing. The disappointment dragging down the major indices with it. The NASDAQ, the biggest laggard here, down about 2%. The S&P 500 and the Dow also firmly in the red. Facing the heat, confirmation hearings for President Biden's Fed nominees kick off in the Senate. Soaring prices, a big focus, as one nominee calls high inflation a grave threat. And unions stepping up. Amazon employees in Alabama prepare to vote to organize for a second time. Starbucks employees, in the meantime, continuing their push to unionize, with the effort now spread across nearly 20 states. We are beginning this hour, though, with the tech wreck that is playing out right now in the session, with Facebook's Meta leading the declines. Want to get right to Inez Ferre, who's tracking the latest market action for us today. And Inez, we're talking about Meta being down more than 20%, on track to raise about $200 billion from its market cap.
That's right. And if we take a look at our sectors, communication services, that is the one that is getting beaten the most. And that's because of Meta. Let's look at the NASDAQ 100, where you can see Meta down more than 24% right now after that disappointing quarter. There are now 4 analysts that have downgraded the stock, including JP Morgan analysts, which cut their rating for the first time since the company's IPO to neutral from overweight, talking about the competition from TikTok and also Apple's iOS privacy issues and how that's affecting advertising capabilities at Meta, that being a very important issue, which the company highlighted yesterday. Taking a look also at some other social media companies that are also tanking today, that being Snap, down 20%. Snap will be reporting its quarterly results today after the close, and also Pinterest down more than 7%. I also want to mention Amazon, which is down more than 6%. Amazon will be reporting its quarterly results today after the close. Pay attention to costs for labor, costs surrounding its fulfillment center, supply chain constraints. Analysts have been pulling back their expectations on Amazon's quarter, but still the street is very bullish on this stock. You've got 59 Wall Street analysts who cover the stock that are tracked by Bloomberg. All of them have a buy rating on the stock with a $4,100 average price target. And finally, I want to mention what's happening with Spotify, because Spotify also tanking after its quarterly results, down 14%. This is because of its forecast. Its first quarter subscribers coming in short of estimates for its forecast. Also, no full year guidance. The stock absolutely getting hammered today. Akiko, Brian.
Okay, Inez Ferre walking us through the market action there. I want to get right to our first guest for the hour. We've got Rohit Kulkarni, MKM Partners Managing Director, Internet and Capital Markets. And Rohit, it's certainly good to have you on this day when I think a lot of investors are trying to make sense of these numbers. There's a number of threads that came out of that earnings call, obviously slowing user growth, the competition coming from TikTok, and then, of course, the big concern investors have been flagging for a while, which is the declines in ad sales coming from Apple's privacy features. What stood out to you the most? What do you see as the biggest long-term risk for the company?
Hey, thanks for having me. And a lot of negative surprises yesterday. I think users was something that was the most biggest negative surprise, in my opinion, although they are kind of saturated in key markets that account for more than 70% of their revenues. But users declining in growing markets, that's a bit of a bigger yellow flag, in my opinion. Whether that's competition or macro factors, we need to see greater evidence for that. And secondly, I think just the revenue headwind. There are various factors that's leading to the revenue headwind. There is macro, supply chain inflation, commerce related. Then there is micro ecosystem, Apple and Google making changes. And then there are self-inflicted changes, be it consumer behavior or competition. So the revenue headwinds, some of them are fleeting, some of them are permanent. So I think user growth and permanent revenue headwinds, these are the two things to monitor here. And that's why the stock is down where it is. overall, last point on this, and then we can move on, is 22 seems like a much bigger transition year for Facebook now than what we thought heading into earnings. We knew that they're changing the name of the company, they're breaking up more revenue segments, we are going to get Meta versus Facebook and so on and so forth. But hearing from management, their priorities and the investment plans and all those things, I think 22 is just a very big transition year for Facebook. So you need to have that leap of faith, look beyond, say, August of this year to essentially get better comfort as to where Facebook would land from this current various degrees of headwinds that they're facing.
Hey, Rohit, Brian Chung here. I wanted to ask just about your price target. You've got a $365 price target, which presents a considerable upside, especially after the big drop to around $240 that we have today. We've seen a number of others on Wall Street reprice where they could see Facebook going. There's been 20 firms, I believe is the count, cutting price targets for the company formerly known as Facebook. Wondering how you justify, despite those revenue headwinds you were just describing, that $365 price target that you have.
So mathematically, Facebook remains a cheap stock and remains a very profitable company. So getting to an upside price target, in my opinion, is not a big bit of a stretch. We are applying just a 20 times earnings multiple on our 23 earnings estimate, which came down 10-15%. So we are applying a lower multiple, we are reducing our earnings estimate, and that's how we came to $365, 20 times about $17 per share. That also implies a much cheaper valuation when you take out the cash, and if you assume that the cash burning part, which is the metaverse, is also treated as just a one-time thing. But 20 times next year's earnings is something that we feel comfortable with. Facebook may not get out of this down rating anytime soon until we see evidence of user growth and revenue headwinds, or both. As in, we need to see both for it to get back to more than 325, but near term, we need to see at least one, user growth or revenue acceleration.
So let's pick up on that user growth, because you flagged that as a big concern. I mean, there is an argument to be made that when you've got a platform of nearly 3 billion people, at some point, you're going to hit the ceiling, right? But yesterday, we also heard Mark Zuckerberg talk about TikTok a lot. Probably the most he's mentioned it on an earnings call, specifically talking about the competition. Let's take a listen to what he had to say.
The thing that is somewhat unique here is that TikTok is so big as a competitor already, and also continues to grow at quite a fast rate off of a very large base. And so that to the question that was asked before around, is there anything that's going to make it so that it takes us longer to kind of get to where we want on this? It is that, even though we're compounding extremely quickly, we also have a competitor that is compounding at a pretty quick rate too.
Rohit, it's worth mentioning that TikTok has its own challenges, potential additional investigations coming from the US government into Chinese apps. And yet, when you're talking about a company like Meta that has said the future is not just in the metaverse, but in the medium term, in Reels and short form video, how big of a concern is it for you, the fact that Mark Zuckerberg is talking about the competition from TikTok in the very area that Meta has said they want to double down on?
Yeah, absolutely. I think if you read between the lines and kind of peel back the onion a little bit, I think it is more about TikTok targeting 18 to 29-year-olds. I think overall, if you look at user growth and user base, Facebook is probably 3 times bigger than TikTok globally. But when you peel back the onion from the consumer demographic, I feel where they are currently losing is the 18 to 29-year-old demographic, which TikTok seems to be winning very, very rapidly and accelerating its lead. So if you fast forward that 3 to 5 years from now, that presents a very, very big challenge for a company like Facebook that needs to maintain its user base and keep on attracting new users who are mobile friendly, mobile first, and mobile only. So that I feel that's where TikTok presents a bigger challenge. We haven't seen that yet in the numbers. Perhaps 4Q was the first time we saw that in the numbers. And that's the bigger worry right now on the stock. It's a wall of worry that the company needs to climb if they are going to succeed in this competition for this 18 to 29-year-old demographic. They need to win against TikTok, and that's the North Star right now.
The one other big bet long-term for the company is, of course, the metaverse. It's the reason why they changed the name to Meta. And yet on this call, it was the first time we saw the breakout of Reality Labs, a $10 billion loss last year. And Mark Zuckerberg seemed to be a little cautious to say, look, this is a long-term project. They've talked about 10 to 15 years down the line. How do you think investors should be looking at this particular segment as a driver for the company when so much of the public focus has kind of shifted in that direction?
From an investment community standpoint, I think it's purely a moonshot. It is 10 years out. The earliest evidence of any economic value towards Facebook, which is already a very large company, I would be very surprised if they start showing any evidence of that in the next, call it 3 years or so. So for now, I think over the next 2 to 3 years, all we are going to see is headlines and product progress and ecosystem build-outs. There won't be any economic value associated to it or any growth in that, in my opinion, from either bullish or bearish investors. If they start burning a lot of cash on that without adding any economic value, that would just give some fire to the bearish investors. But until then, I think all they need to do is show progress in terms of containing the cash burn and containing the headlines around metaverse. They have a bigger problem on their hands in the family of apps where they have significantly under-monetized a couple of apps there, WhatsApp and Messenger. WhatsApp is probably the second largest mobile app in the world, and after Facebook Core. So again, they need to show evidence that they can monetize more apps. They did that with Instagram, so that's something that we can believe that they can do. So the bigger problem in the next 12 to 18 months is how they can diversify their monetization and perhaps accelerate revenue growth in the core family of apps itself.
And then lastly here, I want to highlight another company that's been seeing a sell-off today, which is, of course, Snap, which didn't report yesterday. You could see shares down over 20% just today. So obviously they're riding a little bit of the headline news as well about this issue with competition for eyeballs. How do you think the issues that we're seeing with Facebook, as highlighted in their earnings yesterday, spill over to other companies as well?
Yes, Snap has the greatest overlap. Look at 3 or 4 pillars of overlap: the customer base, small and medium-sized businesses. Any changes that Apple made, if they hurt Facebook, they did also hurt Snap to this similar degree. And then the consumer demographic challenges. If Instagram or Facebook is facing challenges with TikTok, probably Snap is facing the same. So these are derivative implications on Snap that I feel are justified. The only kind of silver lining in there is we think Facebook overskews towards small and medium-sized businesses, whereas Snap has a slightly better mix of large and small businesses. And Facebook did say yesterday that, okay, small businesses are hurting on ad spend on Facebook, but large businesses are doing well. So if there is a silver lining here, that may be a positive surprise from Snap, that maybe perhaps that the way their customer mix is, they may see less worse results than what we saw from Facebook yesterday.
A lot of people are going to be keeping their fingers crossed when those numbers come out. Rohit Kulkarni, MKM Partners, Managing Director, Internet and Capital Markets. And Brian, as you flagged, we've been seeing a lot of these other social media stocks falling along with Meta today. Snap touching the lowest level since September 2020. That stock down about 70% since its peak in September. And then you've got Pinterest also hitting the lowest level since July of 2020. We've also seen Twitter down as well. And, you know, it's an interesting point that Rohit just made. There's a number of ways to slice the commentary we got from Meta yesterday to say, well, how much of this narrative actually applies to some of these other companies? Meta has said that the privacy features that Apple's put in place is going to cost the company about $10 billion this year. Some would argue that, well, that means Snap's going to see significant declines too, because they flagged in the previous quarter about the headwinds they're seeing from that front. So interesting to see, how the market is processing this, but also, what those numbers are going to look like from companies like Snap, because that seems to be the big overhang, especially for social media apps.
Yeah, I mean, I would describe just the broad market action across the board as down bad, right? I mean, these companies are getting shellacked to a degree that maybe some people at the surface are wondering, why is that? I mean, you clocked in at $33 billion for one quarter in terms of top line revenue, and it seems like people are freaking out over guidance of $27 to $29 billion for the next quarter, which is a significant, I guess, down step from where Wall Street estimates were. But those comps would still be not so bad when you consider Q1 2021 earnings for Facebook came in, $26 billion? So the comps will still actually be an improvement year over year if they even hit the bottom end of their guidance for revenue in the next quarter. But I think, again, the bigger picture here and the reason why you would expect to see or maybe back into an explanation for an over 20% drop in one single day is because of the absence of a short-term catalyst with all these revenue headwinds, as Rohit was describing. And in the absence of any sort of reality labs or metaverse or Web3 or what have you issues, which will be coming down not in the next year, but perhaps in the next decade, maybe people are just ready to downshift in terms of where the stock is, at least in the short term, and just waiting for those headwinds to hopefully come up later down the line. But again, pretty remarkable action here. We cannot discount that, Akiko.
Yeah, I mean, Brian, you bring up a good point. When you look at the numbers themselves, there's a lot of companies that will look at that and say, well, we'd love to be in that position. It's simply that the expectation, especially with big tech, has gone here, and things are starting to shift down here. And it's interesting to me that the action that we're seeing today just kind of points to just how jittery those investors are. Last week we were talking about the big declines, and then Apple came out and things kind of calmed down. Alphabet came out earlier this week, and people said maybe we've seen the bottom in tech, and yet here we are talking about Meta. These are all different narratives, right? Google doesn't operate on the same function that Meta does. The ad sales, well, people are trying to make the comparison. I mean, it's a different market in many ways, and so the overall action today certainly speaks to this sentiment in general, which is how much more growth are we going to continue to see from high growth companies in the face of rising rates? And that, I'd imagine, is going to be the narrative that sticks around for a while.
And that's thematically the story for every other market leader that we've seen over time. It hasn't always been Facebook. At a time, it was, the large industrials, but those were the growth stocks at the time. And people wondered, at what point is the growth that's being priced in simply unreasonable because they're reaching a steady state level by which their quarterly over quarter or yearly over yearly comparisons just won't be as fast as they were in the first 10 years, for example, of their existence. So uneasy lies the head that wears a crown. Indeed, always the case for the leaders in a given market, especially by market cap. But let's shift gears and look forward to what we're talking about after this quick break. We're going to talk about President Biden's Fed nominees who are currently on the hot seat, the latest developments as Fed pick Sarah Bloom Raskin is grilled in the Senate Banking Committee over how regulators should be looking to mitigate climate risks. That's next. Welcome back to Yahoo Finance Live. Let's get a live look down in Washington, D.C., where the Senate Banking Committee is currently holding a hearing for the 3 remaining vacancies at the Federal Reserve. You can see Sarah Bloom Raskin, the Biden pick for the vice chair for supervision role, currently getting grilled by a senator. Of course, all 3 are currently facing a hearing and alongside the top picks for Jerome Powell and Lael Brainerd at the top seats of the Federal Reserve. Sarah Bloom Raskin, a very interesting pick because of her previous commentary and writings over the last 2 years regarding how the Federal Reserve should be policing a climate-related financial risk. Take a listen to what she told a senator earlier in the morning with regards to how she's thinking about whether or not the Fed should be directing the flow of capital to or away from certain sectors. Take a listen.
Well, it is, of course, not the role of the Fed to be directing credit allocation. They do not choose winners and losers. The way supervision works is by looking at risk, and by looking at risk wherever it may arise. You look at that risk, and you have to do it in a very, honest way, and ask yourself whether there is any correlation between that risk and the ability to hurt a financial institution.
Let's get a little bit of analysis on the happenings in D.C. with Isaac Boltansky, a BTIG Director of Policy Research who watches this space very closely. Isaac, great to have you on the program this morning. The hearing is still ongoing. Sorry to pull you away from that, but wanted to just get your initial thoughts on the many questions that we heard regarding Raskin's views on how the Fed, or if the Fed, should be policing climate-related financial risks.
Yeah, Brian, you've followed the Fed for a long time. You know how important this role is. Sarah Bloom Raskin is the nominee for the vice chair for supervision of the Federal Reserve. This is a post that was created by Dodd-Frank, and it has wide array of responsibilities and really a broad portfolio when it comes to policing risk in the financial system, in particular, the country's largest banks. And so, look, this is a very important role and one that I think has real consequences for the economy as a whole. Now, her job today was to come before these senators and allay fears regarding her views on climate change. In particular, allay GOP concerns that she would take on this role and make it more difficult for banks to finance, in particular, fossil fuel enterprises. I think reasonable minds can disagree on how well she's done with that. I don't think that it was the strongest showing that she could have had. I think there were some muddled moments, in particular, relating to specific questions on her past writings. But to me, Brian, the most important thing was a question from Senator Tester, a centrist Democrat from Montana, one of the key votes. And it looked like he was okay with Sarah Bloom Raskin's role. So at least for right now, at this very moment, it looks like her nomination is still alive.
I want to zoom out a little bit, Isaac, because there are 2 other individuals that are also up for Fed governor positions, so not the supervisory specific role, but Lisa Cook, a Michigan State professor, and from Davidson College, Philip Jefferson. There was some concern because my email was blowing up from many DC outlets just kind of about Lisa Cook's resume and her qualifications for this role. But you even heard Senator John Kennedy from Louisiana, a Republican, seem to voice his support. I want to play for you a quote that we had from Senator Sherrod Brown, the chair of the Senate Banking Committee, that we had earlier on Yahoo Finance with regards to his expectations. Take a listen.
We're going to confirm all 3 of them. I would assume almost all of them will get a significant number of Republican votes in the end.
So despite all the fanfare, it seems like the chairman is still pretty optimistic that all 3 should be a breeze for ultimate confirmation. What's your expectation?
Yeah, so the way I frame it for clients is you've actually got 5 nominees, right? So you have Powell and Brainerd as well. So all of them will be up for a vote in the committee, most likely on February 15th. The way I think about it is Powell, Brainerd, and Professor Jefferson should be able to easily make it through the committee. Keep in mind, this committee is split, right? It has an equal number of Republicans and Democrats. So there could be a delay if all Republicans are opposed. My sense is that you will get Republican votes for at least those 3. And they should make it to the floor shortly thereafter and should be confirmed in February. The other two were tougher, right? Sarah Bloom Raskin and Professor Cook both have certain headwinds. My sense is that at least Sarah Bloom Raskin is going to be stuck in committee for a short period of time while they figure out how to get her out. As you know, there's one Democratic senator, Senator Ben Ray Lujan, who is actually going to be out for 4 to 6 weeks due to a recent stroke. And you need all 50 senators to get someone out of committee if they're stuck on a party line vote. And so the way I think about it, Brian, is we will have those three that I mentioned before, Powell, Brainerd, and Jefferson, confirmed by the full Senate this month. The other two, I think, may take a little while longer. The odds favor Professor Cook a little bit more. I would say probably 70, 75% likelihood at this very moment than Sarah Bloom Raskin, who's a little bit lower, given that we're still waiting to hear from some of those other centrist Democrats like Manchin.
So, Isaac, let's assume that those assumptions hold. I mean, it sounds like you're saying things are going to be delayed a bit, but ultimately they will all be confirmed in some vote or another. And I want to get back to the climate issue because, you know, we heard Sarah Bloom Raskin say it's not the role of the Fed to direct credit allocation. It is about looking at risks, but some would argue if the risks are there, at some point that the allocation is going to come into question. I mean, how do you think that this framework, if we're talking about something like a climate stress test, how do you think that ultimately looks like?
Yeah, look, to your first point, it's always fair to take the over on timelines in DC. So I think, you know, cutting through all the noise and all the procedural nonsense that we have to chronicle on my end, I do think that at least right now, it's fair to assume that all of them will get confirmed. There are obviously some caveats there that I talked about, but I do think that's a fair assumption at the moment. In terms of what all of this means, look, I think that for me, it's pretty straightforward. We will see more scenario analysis around climate risk. I think that's already happening. It will continue. It will expand. It will get more granular in certain areas. But from a practical perspective, some of the fears that you've heard from Republicans don't seem as though they're in play at the moment. And here I'm talking about specific portfolio limits, capital charges, or enhanced prudential supervision leading to changes that otherwise wouldn't be made in their portfolios. And we've got to keep this in mind. Some of these banks are making the changes on their own without the supervisory pressure due to either shareholders or their own internal analyses regarding these risks. So I think that we're going to continue to see this shift happen, whether it's expedited on the regulatory side or not.
Yeah, certainly, Isaac, I guess the argument here is that things are shifting, but some would argue it's not shifting quickly enough, but that's for another conversation. Isaac Boltanski, BTIG Director of Policy Research, really appreciate your insight today. Coming up, Qualcomm shares falling despite beating earnings and revenue expectations. We're going to be breaking down the chipmaker's latest results on the other side. We'll be right back. Welcome back to Yahoo Finance Live. We are seeing shares of Qualcomm falling in the session, down about 3.5%, despite the chipmaker posting record high quarterly revenue and earnings per share. It also beat out revenue expectations by over $2 billion. For more on the quarter and the stock move, let's bring in Brett Simpson. He's with Arete Research partner and co-founder. Brett, talk me through this price action. We're talking about record revenue, and yet here we are talking about a 3.5% decline.
Yeah, I think this was a good quarter for Qualcomm, and they obviously beat numbers, but I think the guide was also reassuring because it's usual for a business, Qualcomm, to show sequential growth in their chip business in March, and they've done that in spades. And also, I think, get some strong signal about how the rest of the year plays out that is leading to higher consensus numbers on the back of this print. So difficult to see faults in numbers. You can see the stock traded a little bit after us as well. And I think that perhaps because we've seen costs rising a little bit more. But a whole, I think EPS growth is just going to be well above plan, and good news.
Brett, it sounds like some of your audio got cut out there, but I wonder if you think this decline that we're seeing is part of the broader sell-off, whether this is justified given the numbers. Talk me through your thoughts.
Yeah, I think we've seen a broad sell-off in tech, and I think it didn't help with the move in Meta yesterday as well. I think there's generally some concern building about some of the names in tech that are performing well right now. But I think the fundamentals around Qualcomm's business in 5G as a theme is going to be around for at least the next couple of years as a strong growth driver. And so any business, I think, that has that type of visibility should be getting rewarded in this type of environment. So I get the sentiment is concerning right now for investors, but I think this is a business that should perform very well fundamentally over the next couple of years. And I think even beyond 2023, there's some good opportunities in adjacent markets. So this is a business I think that has got good solid fundamentals over the next few years.
Brett, it's Brian here. I want to ask about the prevailing story for the industry at large, which of course is the supply chain issues. We were talking about this with AMD yesterday, but what did you hear from the management yesterday with regards to supply? I did hear that Cristiano Amon, the CEO, was saying that they did see some supply improvements. Do you think that's going to remain the story through this year?
Yeah, that's a good question, Brian. I think, supply has been a real bottleneck in semiconductor companies for the last 3 or 4 quarters. And I think Qualcomm is still having some supply challenges, and they've said that over the course of the next 2 or 3 quarters, it's still going to be quite tight. What we see is leading edge is definitely going to be challenging over the course of this year. I think if you look at the December quarter and the guide, you can see the adjacent businesses certainly suffered from some supply issues. The Wi-Fi business, for example, saw some challenges in the December quarter. But I think as we get through the next 2 or 3 quarters, supply will start to, come online. I think Qualcomm certainly has done a good job bringing on supply this last 3 to 6 months, and there's more coming. So, I think by the time we get to the second half of this year, supply demand should be more or less in balance, I think, yeah.
Brett Simpson, Arete Research partner and co-founder. It's good to talk to you today. Really appreciate the time. Well, coming up, President Biden speaking out on a U.S. air raid or U.S. raid in Syria that killed an ISIS leader. We're going to hear from him on the other side and the details of that raid. That's coming up in our Worldview next. In our worldview today, a U.S. military raid in northwestern Syria killed the leader of ISIS overnight. 13 other people were also killed in the operation, including 6 children. President Biden spoke to reporters this morning detailing the incident.
Our team is still compiling the report, but we do know that as our troops approach to capture the terrorist, in a final act of desperate cowardness, he, with no regard to the lives of his own family or others in the building, he chose to blow himself up, not just with the vest, but to blow up that 3rd floor, rather than face justice for the crimes he has committed, taking several members of his family with him, just as his predecessor did. I'm grateful for the immense courage and skill and determination of our U.S. forces, who skillfully executed this incredibly challenging mission.
Biden also said the Defense Department carried out a special forces raid rather than targeting him in an airstrike to minimize civilian casualties. The White House says there were no American casualties in the operation. Russia is beefing up its military presence in Belarus, deploying more troops there than at any point since the Cold War. NATO Secretary General Jens Stoltenberg said 30,000 Russian troops are now expected to take part in joint military exercises there this month. This comes amid a tense standoff between Russia and the West over the Kremlin's military buildup along the Ukrainian border. Over in Washington, President Biden announced additional troop deployments to the region on Wednesday, with 3,000 U.S. soldiers moving into Poland, Romania, and Germany. The Kremlin accused the White House of inflaming tensions, calling the deployments unfounded and destructive. And the president of the International Olympic Committee is set to meet with Chinese tennis star Peng Shuai in Beijing this month. Speaking to reporters ahead of the opening ceremony tomorrow, Thomas Bach said Peng planned to enter the Olympic bubble to meet face-to-face. Peng has largely stayed out of the public eye since accusing a former Chinese vice premier of sexual assault last year, raising concerns about her personal safety. Bach has spoken to the tennis star virtually several times already. The IOC has been criticized for its refusal to investigate Peng's claims, with Bach doubling down on that decision today. The organization has not set a timetable for the meeting.
Turning our attention to the global story on inflation. Pressures remain the case in many other countries as well. In Turkey, the country's inflation rate is soaring to a 20-year high in January. Get this, at a 48.7% pace in January. Compare that to the 5.8% inflation we're experiencing here in the United States. The acceleration is due to a frail lira, along with higher food and energy prices. And across the pond, energy is a concern as well, at least in the United Kingdom, where bills are expected to rise dramatically. This is after the country's regulator is adjusting its price cap by a record-breaking 54%. That means that the average household could see their bills rise by over $900 a year. The Bank of England voted today to raise interest rates in the face of above-target inflation. A minority, by the way, on that policy-setting committee voted for a more aggressive interest rate increase. Coming up, Yahoo Finance editor-in-chief Andy Serwer heads to the Bronx for an exclusive sit-down with Alexandria Ocasio-Cortez. The details, as the New York lawmaker says corporate price gouging is fueling inflation. That's next. Let's take a look at some trending tickers. Tesla is facing some new scrutiny, although shares of the stock are up. The electric automaker is recalling more than 800,000 vehicles in the United States over seatbelt concerns. The National Highway Traffic Safety Administration is out with a new warning that the chime that's used to remind Tesla drivers to buckle up might not sound when the car is fired up. Federal safety laws require that sound, that chime, when vehicles are started, and apparently the chime stops once the seat belts in the front are buckled. To fix the issue, Tesla will send out an over-the-air software update this month, and at this time, Tesla says it's not aware of any injuries related to the glitch and noted a visual reminder to wear a seatbelt is still displayed. Well, in this week's episode of Influencers, Yahoo Finance editor-in-chief Andy Serwer headed to the Bronx for an exclusive sit-down with Congresswoman Alexandria Ocasio-Cortez. The two discussed her thoughts on capitalism, the broader U.S. economy, and also her concerns over rising inflation. Take a listen.
I think particularly when we have this conversation in the context of inflation as well, it's really not just labor, it's not just rising wages, but there's a lot of different dynamics that I think are contributing to the increase in prices, whether it's supply chain complications, yes, labor issues, but sometimes lack of labor, a lack of the ability to be able to work consistently in their jobs, which is also tied to pandemic controls. And also, there's a real distinction to be made between inflation and price gouging. And there's a lot of evidence that particularly industries with high concentrations, corporate concentrations, whether it's almost oligopoly level industries, a lot of these price increases are potentially due to just straight price gouging by corporations.
Are you concerned about inflation and higher interest rates and the impact on working people?
I mean, wherever prices are increasing and it's making it difficult for someone to be able to feed their family, that is always going to be a major point of concern, a primary point of concern. But the real key is making sure that we're diagnosing the causes correctly, because the danger here is that if we say we're helping working people too much and say that the cause of this is, oh, it's because we provided too much assistance during the American Rescue Plan, stimulus checks were too generous, that is why we are dealing with the problems that we're dealing with now. What that's going to result in is a pullback in the assistance that some families need the most right now. And when we already talk about the cessation of the child tax credit with the failure to pass the Build Back Better Act before the end of last year, we really need to be very careful about diagnosing these issues correctly. Because on the flip side of that coin, if we say there are real antitrust issues here, there's a lot of corporate abuse of power leading to price gouging, then that allows us to pursue lanes such as antitrust and also pursue labor protections, COVID protections that can help people get back into the workplace and stay safe in the workplace.
Right, and so you are seeing those who are suggesting that it's because of the assistance that people had during COVID that's inflationary, and therefore we need to swing the pendulum back.
Yeah, and I couldn't disagree more.
Right.
I couldn't disagree more with that assessment.
Student loan debt, and I know you've called repeatedly for President Biden to forgive student loan debt. Why hasn't that happened, and what do you think will happen if the pause that exists presently is allowed to lapse?
Well, I cannot understate the danger and the risk economically, politically, and just where we are right now as a country of allowing the moratorium on student loan payments to lapse in May. If we just allow a full just continuation of student loan payments, we are talking about a catastrophic development for millions, the over almost 50 million student loan borrowers in this country. There were millions of student loan borrowers that were already defaulting going into the pandemic. But more than that, we are at such a delicate point in the financial and just general economic recovery post-COVID that to then restart payments that are essentially the size of a mortgage payment, sometimes even larger, on a generation that was already so devastated, not just by this, but the recession, et cetera, I believe it could it could throw out of balance already what is a very fragile recovery. And not only that, but this forgiveness is forgiveness is the just thing to do. It's the right thing to do. Why the president hasn't done it yet, I'm not sure, but I do think that this is an issue of increasing urgency. He has already indicated an openness to it, and he has actually already used his authority to forgive student loan debt in certain small, very narrow cases.
Because there are people who suggest he doesn't have the authority. Is that a legitimate argument or just maybe a smokescreen?
I don't think it's a legitimate argument. In fact, we've seen him use the same legal authority that the president has used to suspend student loan payments is the same authority that he would use to cancel them. And not only that, but he has used that authority. He has indicated a willingness to use the authority. And I think that it would be extraordinarily important and urgent for him to do so.
And what about the argument that it's a moral hazard? In other words, you're letting people off the hook by forgiving the debt.
Well, what I think is the true moral hazard here is the surging costs of education in the United States. What has actually created the moral hazard is this guarantee of saying we will issue minors hundreds of thousands of dollars in student loan debt at almost any level with almost no limit, and we will allow colleges and universities to dramatically increase the costs of their tuition with the guarantee of that loan value on 17-year-olds. So what is the actual true moral hazard here in the situation is the controls on the cost of education in the United States. And one very important control in this, to that note, is tuition-free public colleges and universities. Because then what that does is that it introduces competition into the market to which private universities have to actually meet a lower baseline. But people act as though it's just fancy public schools that are extremely expensive now. But public college tuition has also increased dramatically far beyond the pace of inflation.
Shifting gears a little bit, you have a huge social media following, obviously, and a big platform. Have you been either surprised by how much or how little influence that affords you in Congress? In other words, how does that translate, Representative?
That's an interesting question. I think it's the way that I've thought about it, first going into office and then continuing, is that in Washington, there are a lot of different sources of power. There are some members who have extraordinary connections to different power players, different power centers that are very well connected and networked. There are other individuals who are very, frankly, financially connected. Industry, lobbyists, corporations throw their weight and donate and give their influence, their lobbyists, et cetera, throw an enormous amount of their support behind other members of Congress. So every single member kind of has their assets that they lean on. And for me, I decided early on, because I don't accept money from corporations, I do not take meetings with lobbyists, I am not well-connected, I don't come from a well-connected family or community or anything like that, that my ability to navigate and advocate is going to have to be squarely rooted in relying on everyday people and their support and my ability to communicate with them what is going on in Washington.
And don't miss the full episode of Influencers tonight on Yahoo Finance Live. Coming up, a battleground over unionization is brewing for Amazon and Starbucks employees. The latest developments ahead.
Heavier workloads, delayed breaks, and shortage of personal protective equipment. Just some of the concerns detailed by Starbucks employees who have now expanded their union push to nearly 20 states. Let's bring in Yahoo Finance's Max Zahn, who's been speaking to some of these baristas about that push. Max, what are they telling you about their concerns?
Yeah, Kiko, it's hard to overstate just how unlikely this wave of unionization is at Starbucks. The share of workers who belong to a union in the private sector, it stands at just 6.1% of workers. In food service, that drops to 3.1% of workers. Couple that with the fact that the company gave a raise to workers in October before these union drives began. So it begs the question, why are we seeing this wave of unionization? Now, people will say it's because of the labor shortage, that's happened across the economy, especially in food service, because these jobs risk exposure to COVID-19. That gives workers leverage. They can demand raises, they can quit, or, they can demand a union at their workplaces. Now, I spoke to 4 Starbucks employees involved in union drives in stores in different states across the country, and they mentioned this labor shortage, but in a very different way. They said because we're understaffed, it just makes our jobs a lot more stressful and a lot less enjoyable. We have to delay breaks. We have to do multiple jobs at once, and we have the same number of customers and peak periods where they demand work that we just can't follow through on. I spoke to one barista, Nikki Taylor, in Memphis, Tennessee. She said we used to have 8 or 9 employees to handle these peak periods, in the mid-morning, in the late afternoon. Now we only have 4 or 5, but customers have over years built expectations that these drinks will be served in a certain amount of time. And as one other employee said, they'll be served with a smile on our faces. And so they want unions so they can have more say in how their workplaces are run. Now, what's interesting about this is that Starbucks has acknowledged this problem. On an earnings call this week, they said, it's no secret we have issues with worker shortages and staffing problems. I spoke with a spokesperson from Starbucks who said, we do have policies in place to deal with this. We give employees at stores the option to suspend mobile orders or suspend in-store orders as a way to relieve some of that pressure. And overall on the union campaign, Starbucks has been very upfront. They've opposed the union drives. They say we can negotiate with our workers ourselves. We don't need a third party to resolve these differences. But the spokesperson did acknowledge that the company has, potentially had issues during the pandemic with that communication with workers, because things like staff meetings are more difficult when they can become super spreader events. So it's unclear what the company can do to address this problem. Wage inflation came up as an issue during the earnings report they had. It's unlikely to see a big wage increase of the type we saw late last year. So they might just wait for those cases to subside, Omicron subside, and hopefully these disruptions go away. And I think, frankly, hopefully the company, thinks maybe these union drives will go away along with it.
Max, in many ways, the challenges you're talking about within Starbucks, something that so many companies have faced. And that's why we've seen this union push, a wave, if you will, across sectors. Amazon looking at 2 new votes here, one in Staten Island, and then another one, a repeat of what played out over in Bessemer. How likely are those votes to go through?
Absolutely. And we just saw a third, warehouse a second on Staten Island, a third overall file for a petition yesterday. So we could see if that gets validated, a third vote at an Amazon warehouse, which would be historic. Now, the problem and the challenge for these union drives, and something that I've spoken to experts about, is, let's focus for instance, on the case of Staten Island, this latest one that we've seen an election scheduled likely for later this year. They filed with the threshold of right around 30% of worker support. That's what you need to trigger an election at your workplace. But of course, to win a union, you have to cross that 50% threshold. Now, Amazon is an especially difficult place to organize. These are big warehouses. That Bessemer warehouse you mentioned has 6,000 employees. And couple that with the high turnover you see at Amazon and their ability to hold meetings and dissuade workers from supporting a union. So experts say you should expect around 15% or so attrition from that number that you file with when you start the election process. So on Staten Island, they filed with right around 30%. It's very difficult to overcome that attrition and get to that 50% number. In the case of Bessemer, they faced an overwhelming defeat in that vote. Now they're going to get a revote, and there was, reason to believe that illegal interference by Amazon affected that result. But again, to overcome the attrition in turnover since that initial vote and the expected anti-union campaign from Amazon is a very heavy lift.
An enormous lift for sure, but you can't discount the fact that there feels like there's something going on in this labor market, especially with the amount of job openings out there. But Yahoo Finance is Max on. Thanks so much for breaking all that down for us. Coming up on the other side of this break, not exactly music to Spotify's ears. Yikes. We'll reveal the latest hurdles for the music streaming giant besides the Joe Rogan controversy ahead. Welcome back to Yahoo Finance Live. It is 12 p.m. here on the East Coast. I am Brian Chung, alongside Akiko Fujita, here to hang with you through the next hour of trading. We've got a lot going on, so let's take a look first at where markets are right now. NASDAQ feeling the heat after some big yikes earnings from Facebook last night. You can see down about over almost 2% really on the over 2% actually on the NASDAQ. So the S&P 500 is down almost 2%. The Dow not getting as much of a steep fall as the other indexes. In the show, we're going to take a deep dive into another tech company beyond Facebook that's getting the work this afternoon. That is, of course, Spotify. We'll have an analyst stop by to talk about how the Joe Rogan controversy is weighing on the company alongside the related or unrelated story regarding their subscriber numbers. And then non-fungible tokens. What's an NFT on your phone if you can't flex your NFT on your phone? We'll have the founder and CEO behind Casetify, a company that's allowing you to show those bored apes on the backs of your phones. But first, let's take a look at Spotify. Shares are getting really hammered in the afternoon trading after they reported earnings yesterday. So let's talk a little bit more about what's going on with that company with Lou Basenese. He's Disruptive Tech Research founder and chief analyst, to talk a little bit more about what's going on in the space. Lou, great to have you on the program. It's interesting to see the numbers really clock in here when we talk about their subscribers. That appears to be the big issue. A record 406 million monthly active users, but we can see the street's sour reaction. Any initial thoughts on the report yesterday?
Yeah, I mean, I think as investors, it's time to tune out and really wait for the growth to come back. I mean, you highlighted it. They're at about 406 million monthly active users. This, for whatever reason, in the platform world, whether it's social media, streaming services, becomes a roadblock. It's a temporary plateau that some companies just can't get through. Snapchat has struggled to get north of 400 million. And, I'd say Spotify is stuck in this trap right now, stuck in that mud. And the streets really, I wouldn't say they're overreacting even. So if you look at the premium subscription growth numbers, it's actually decelerating significantly. So quarter over quarter, it's only been about a 1.7% growth that they're projecting right now moving forward. That's coming after about a 5% growth. So you're seeing a steep decline in user growth. And it begs the question, is Spotify topped out on growth? And that is why I think everyone's hitting the sell button to find out, later on. It's better to exit now and come back when the growth returns.
Lou, it's Akiko here. I mean, even with that said, I wonder how much of this is a pull forward that we saw in the previous quarter. They had really strong numbers back then. So is this just a matter of setting expectations?
I would agree with you up until the conference call, because if we look, they do a lot of year-end marketing to pull users in at the end of the year. They've tried to say on the conference call that this was a seasonal slowdown, that this will prove itself out over the years. But here's the problem. Management is now cutting back the guidance that they're providing. They revealed on the call they're not going to provide annual guidance anymore. And those quarterly metrics, instead of giving a range, they're just going to provide a single number. We've seen this traditionally happen on Wall Street, especially with tech companies. When management pulls back the transparency, investors, they hit the bricks. They go somewhere else until they start getting some clarity on those trends. I mean, we saw it happen with Apple before. We've seen it happen with Facebook and various other platforms, where if you don't give investors the information that they can use to gauge where growth is going to come in, they're going to move on until they can get some confidence there again. And I don't think anyone has confidence in the growth right now.
Lou, I want to switch to the big headlines around Spotify that have happened over the past few weeks. Obviously, over the Joe Rogan controversy, we don't need to break down exactly what's going on there. But do you think that those headlines will weigh on the subscriber numbers and the revenue in the quarters to come? And is that perhaps a reason why the stock is also experiencing such a bad day today?
I'm going to be the contrarian view here. I don't think it matters at all. I mean, honestly, I'm a Spotify premium subscriber. I'm not thinking about canceling my subscription because of Joe Rogan or Neil Young not being on there. Hey, he's gone. But there's plenty of other content providers that are on there, and content is always king. So for subscribers that are actively paying the premium subscription, it's not a matter of one person leaving the platform that's going to make them migrate elsewhere. I think it's the collective. And, look, even if you band together here, all these artists and creators that are removing their content, there is still just a myriad of other content that we come to consume on Spotify, and I just don't think that's going to change at the price points. Now, if it was a super expensive subscription, maybe that would influence behavior on the user base. But we've seen it happen before with Netflix, with Dave Chappelle. We've seen with all these platforms, the controversies around content really don't put a dent in their user numbers.
Lou, from a competitive standpoint, which platform poses the biggest threat to Spotify? And if we're talking about not having a catalyst there to get those growth numbers back, is it going to come down to content on the podcast side or the music side?
Great question. So, I mean, if we look at market share numbers, Apple Music is obviously the next in line. So Spotify has, I believe, at the latest numbers, 31% market share. Apple's at about 15%. Obviously, I would argue that Apple has much more ability and a user base that they can leverage to grow consistently over time. So I think that's probably the biggest competitive threat. And in terms of different mixed medias, I think it's podcasts is key for two reasons. One, you're seeing a lot more content being created there. There's very faithful followings in podcasts. But then more importantly, that generates the advertising revenue inventory. And we've seen it this quarter with Spotify. 15% of revenue came from advertising revenue. So that's going to be a key driver. It's almost the key metric that you have to watch moving forward as an investor. How much can they ramp up that advertising revenue? Because if user base flatlines and just kind of just stays steady, it's going to be really key for growth in terms of growing earnings and consistent profitability for them to generate a lot of ad revenue.
All right, well, we'll have to see what their other quarters bear in the future. Lou Basinese, Disruptive Tech Research Founder and Chief Analyst, thanks so much for stopping by this afternoon. Let's shift gears now to the macro economy. We got weekly jobless claims this morning totaling 238,000. That was fewer than expected, this coming before the big January jobs report tomorrow morning. So for more on this, let's bring in Dan I, Fort Pitt Capital Group CFA and CIO. Dan, great to talk to you this afternoon. Just thoughts on your expectations for that big jobs report tomorrow. You know, the ADP report, pretty ominous bellwether we got yesterday with a contraction of over 300,000 in the month. What are you expecting?
Yeah, thanks for having me. I think expectations have certainly changed after the ADP report yesterday. Consensus is for an addition of 175,000 jobs. It looks like we'll see something with a negative print tomorrow, but I think it is really related to the Omicron situation in December and the carryover to January. So I don't think it necessarily will speak to the strength of the health of the labor market for the first quarter and for the rest of the year.
Dan, when we're looking at the market action today, it sort of begs the question again about whether it is the earnings that's going to be driving the action moving forward, or if it really comes down to some of that economic data you just pointed to, specifically on something like these high growth names, the tech names. Do you see more downside to come just because of the uncertainty, not necessarily within the sector, but outside of it? How do you look at the swings we've been watching?
Well, I think in our view, it's just a situation where the market needs some time to really adjust to the new reality of tighter monetary policy and dramatically lower fiscal stimulus. So we're really expecting to see a continuation of volatility throughout the year, and more back and forth as investors really grapple with on one hand tighter Fed policy, and on the other still very healthy economic and corporate earnings growth. I think from our seat though, we're excited because we see a very wide valuation dispersion gap in the market. So some stocks are extremely expensive and probably shouldn't be, and some stocks are extremely cheap and probably shouldn't be as well. So we just think that it sets up for a really good environment for fundamental stock pickers like us.
Dan, I want to ask you just kind of about the rotation broadly in assets. I mean, today we're seeing red across the board in equities, but then you also have the 10-year up 6 basis points to 183. We've seen a rip up also in the 30-year 6 basis points, which tells me that there's still a lot of pricing going around the Fed that might not be translating necessarily in full to other asset classes as well. How does that kind of form your investment thesis through that volatility?
Yeah, I think we expect to see a continuation of interest rates grinding higher from here, but it looks like the velocity of those interest rate increases have kind of leveled off a bit over the last week and a half or so, and I think that has contributed to the pretty strong snapback rally that we've seen over the last week and a half or so. But other than that, I think maybe makes some short-term corporate bonds look a little bit more attractive. But we do think that there's some room for, especially the longer end of the yield curve, to grind a bit higher over the coming weeks.
Dan I, Fort Pitt Capital Group, joining us there. Appreciate your time today. Well, coming up, crypto regulation back in the crosshairs. SEC Commissioner Hester Peirce joins Yahoo Finance for an exclusive interview. That conversation is up ahead. Well, cryptocurrency exchanges certainly facing increasing pressure as the SEC looks to craft regulation around some of those big platforms. Our very own Jennifer Schonberger spoke with SEC Commissioner Hester Peirce, and she's here to bring us that conversation. Jen.
Good afternoon. Securities and Exchange Commissioner Hester Peirce last week dissented against an SEC proposal that would seek to expand the definition of a trading platform. I spoke exclusively with Commissioner Peirce about why she dissented against this, as well as regulating cryptocurrencies. She told me she sees this proposal as a backdoor way to try to regulate cryptocurrency exchanges, though she says the SEC does not have formal plans right now on the docket to propose any regulations around regulating crypto exchanges nor crypto overall this year. Take a listen.
I certainly think that the expansive definition that's being proposed for exchange will cover a lot of potential platforms that haven't thought necessarily that they would be covered, and that's in the traditional securities space as well as in the crypto space. So I want people to think about it, and the reason that I dissented is that we're not giving people enough time to think about it, and so I'm not going to be able to get the feedback that I need to make a decision about whether or not this proposal is a good one or not. So that's kind of the crux of the reason that I disagreed with it. Now, I will say that Chair Gensler has said, even under our existing rules, that he thinks a lot of crypto platforms should be coming in and registering with us. So regardless of what happens with this proposal, I think he's trying to pull those crypto platforms into our ambit. The proposal, if it's adopted, will make that a lot easier.
Do you believe that this proposal could be adopted? And if so, how long between the time with which it's adopted to when compliance would be required for these crypto exchanges?
Well, it's hard to tell now. I mean, we will look at comments, I hope, as they come in, even though we did give such a short amount of time. And so that should inform the rulemaking process and the decision about whether to move forward with adoption as proposed or whether to modify it in some way. If it does go into effect, it's difficult to know what the implementation period will be. Again, that's something that we'll get feedback from people on what they think a reasonable period would be and then go from there. So things in Washington take a long time generally, but Chair Gensler here at the SEC is keeping us working quite hard, and he tends to move pretty fast. So it's all relative, I guess, but for DC, he moves fast.
You mentioned that Chair Gensler is urging cryptocurrency exchanges to register with the SEC, though it hasn't been mandated. You guys haven't put out formal rules or guidance on that. And speaking with Chair Gensler last month during a press conference, he told me that he hopes this is the year that the SEC will put out rules to regulate exchanges. Do you see that happening? Are you directly working on rules behind the scenes for cryptocurrency exchanges or for decentralized finance?
Well, Jennifer, your question is exactly right in the sense that we don't have a rule book in place that works for crypto exchanges as they currently operate. And so absent some kind of adjustments or exemptions, it's going to be very difficult for these entities to register with us. If you look at the agenda that Chair Gensler has put out, I don't see anywhere on that agenda a rule directed toward crypto exchanges and registration of those exchanges, other than the one that we just proposed, but that's not specifically tailored to addressing these questions about what does it actually look like for one of these entities to be registered. So I think there's a disconnect there.
So then, Commissioner Peirce, are there any regulations or rules that the crypto community can expect this year from the SEC, whether it's exchange registration or otherwise, or should we expect a ramp up in enforcement activity?
I think that's the discouraging piece of it, that we're leading a lot of these charges through enforcement instead of taking the approach of using our rule book, our existing rule book, and our existing statutory authority, which tells us that we can make adjustments to the rules to accommodate new things and different things. So we should be working on creating that kind of a framework that works. But I just don't see it on the horizon based on what's in the regulatory agenda. And that leads me to fear that a lot of this work is going to be done through enforcement, which is not the right way to go about writing rules. You want to do it in a transparent way that involves all of the affected people, whether it's the people running the platforms or the people trading on the platforms. You want everyone to be able to have a say in how those rules look.
The digital assets industry doesn't have a clear framework from the SEC, as you mentioned, for what really constitutes a security versus a commodity. How do we solve that?
I think, again, we sit down and we think about what it is we're trying to achieve. And we're trying to make sure that people who are buying these digital assets, these crypto assets, know what it is they're buying and get the information they need to make a good decision. And so that looks a little bit different for a crypto asset than it might for a regular security. And so what we should do is sit down and figure out what information do people need. Is the SEC the right agency to get them that information? If so, let's draft a rule and say, here's the information you should provide when you sell one of these things. But so far we haven't done anything other than slap labels of security on various digital assets. Sometimes we don't even tell people which digital assets we think are securities, and so people are left guessing.
And stay tuned in the 2 o'clock hour for the second half of that interview, where Purse and I discussed her views on how digital assets should be regulated, including looking at NFTs. Guys?
Yeah, Jennifer, I don't want to front run the clip that you're going to be playing later on, but I guess give us a little bit of color on exactly how she's thinking about just those non-traditional, if you will, crypto assets like Bitcoin or stable coins and whatnot. Is there any hint that the SEC would want to get into the space of regulating things like NFTs or DeFi and what have you?
Yeah, hey, Brian. So 2 things there. One, I asked her about what's it going to take for the SEC to finally approve a physical Bitcoin ETF, a spot Bitcoin ETF. And she says it's really going to take regulating the underlying markets, Bitcoin, cryptocurrency markets, like equity exchanges before the SEC is comfortable with doing that. So it sounds like it may be a little bit of a while here before the SEC would be comfortable in greenlighting that. Now, she also notes, NFTs have exploded, as you know. They're now worth more than $40 billion as a market, almost the size of the global art market. And so she thinks it would behoove the SEC to come up with rules or guidelines for folks that are dealing in NFTs, whether partially or wholeheartedly, to see where these would intersect with securities laws.
Yahoo Finance's Jennifer Schomburger, thanks so much for bringing us that interview. Well, on the other side of this break, stocks are poised to snap a 5-day winning streak as Facebook parent company Meta tumbles on earnings. The latest market action next. we are 3 hours into the trading session on this Thursday, February 3rd. So let's take a look at where markets are right now. And it still appears that everything is red across the board. The Dow down almost 1%. The S&P 500 getting a little bit of an elevated sell-off there, down 75 points. But it's the NASDAQ that's getting a lot of attention, down 2.5%. And the big reason why, one of the major large stocks, that's the F in FANG, seeing a steep sell-off. When I say steep, I mean steep. That's 25% down after they reported earnings yesterday. That's a big reason why the NASDAQ is selling off. And a bunch of other tech stocks like Snap also getting sell-offs around 20% as well. But interesting to see that the 10-year bond is actually getting some interesting movement upwards in terms of yield, up 6 basis points to 183 basis points. So a lot of market action as we get deeper into the afternoon. Of course, we'll have more market coverage on the other side of this break here on Yahoo Finance Live. We'll be right back.
With just over 2 months to go until the tax deadline, there's a lot of taxpayers out there that are looking to those itemized deductions. Today, we're specifically focusing on charitable giving as part of our Taxes Made Simple series presented by Tax Act. Let's bring in Joanna Fenton. She's Friedman LLP tax partner in charge of East Hanover, New Jersey office. Joanna, it's good to talk to you today. You know, a lot of people are just kind of gathering their paperwork right around now, trying to think, okay, what's the first step I need to take as I look to April? What do you say?
Yeah, well, I always say, and I share this with all clients, that it's time. It's never too early to start this discussion, and acting in a good partnership with your advisor is just so important.
Tell us about what that engagement looks like. I mean, what type of communication should you be having right now with your tax advisor? I mean, obviously getting started early is always kind of a good approach to this, but what should you be talking about in the early stages here in terms of making sure that your house is in order for filing season?
Sure. Well, it's a partnership, right? And the idea of building that return quarter by quarter is ideal. If that didn't happen last year, now there's a little catching up to do. And with that, some thoughts on the most valuable sides of things, right? Income is closed down. We know what gross income looks like. Now we need to understand what deductions are available for us. And so that's kind of segues into what's left on the table. There's not that much from an itemized deduction standpoint, as the state and local tax deduction has been capped out. But there are a few things. And one of the biggest items really comes in by way of charitable contributions. And charitable contributions come in two forms, right? Cash that has been contributed, and non-cash items as well. So having the contemporaneous documentation in place, sharing that with your advisor is just so important.
Yeah, when we think back to the beginning of the pandemic and that first round of COVID aid, we saw an expansion in eligibility for charitable donations. And there's a push right now in Congress to expand that further. But how should taxpayers be thinking about the rule change on that front? Because we're not talking about, we've seen a shift in those rules between what played out in 2020 and last year.
Right. So I think where you're going with this, and it's right on, is that folks that are not itemizing still have an opportunity to gain or to take advantage of a charitable contribution. So that those limits are in place, and they really never were before if you weren't itemizing. Then if you move to the itemized taxpayer, that taxpayer really has had the opportunity last year to go as high as in certain cases 100% of AGI. So that was a major offering. In 2022, the numbers are coming back down a bit, and there's some opportunity to think about where gross income is coming, right? So we've got 2021, it's already closed down. And if charitable giving wasn't something you thought of then, as increases to gross income occur in your 2022 tax picture comes together, perhaps considering charitable contributions and considering them in a more thoughtful way, meaning utilizing highly appreciated securities that you otherwise receive long-term capital gain treatment on, thinking about those items as a way to give to charitable organizations. So that's a non-cash contribution, and it's a twofer. You're getting the benefit of not having to realize the long-term capital gain, and you're getting the benefit of the charitable deduction. So it's something that, when used properly, can really have an amazing impact on your bottom line if you're charitably inclined.
And Joanna, lastly here, a pretty simple question, but what are the deadlines in the timeline that we're looking at here? Because, during the pandemic, there was some movement in terms of when the actual filing deadline was. What are we looking at for the 2021 filings this year?
Brent, I'm really glad that you brought that up. So right now we're in kind of a clunky window. Coming up in the next week and a half, we're looking at a deadline for Q3 and Q4 of 2021 tax payments. So there was IDA relief in some states, and so some taxpayers are only getting around to making their tax payments right now. As we go into 2022 tax filing season, we've got a couple of states already that have extended our tax season deadline into the summer. So IRS continues to be very much behind. And it's yet to see what they're going to do with our extension deadlines. But right now, the deadline is April 18th. It is not April 15th. There are some holidays that are coming in between that have already created a bit of an extension. And it really makes a lot of sense for taxpayers to get things in order as various holidays bump up against that April 18th, as we know it right now, deadline.
Yeah, and that's going to come up quick. Joanna Fellon-Freeman, LLP tax partner in charge of the East Hanover, New Jersey office. Thanks for stopping by this afternoon. On the other side of this break, a Bored Ape NFT on the back of your phone. We'll have the founder and CEO behind Casetify, the company that's allowing you to show those NFTs on the backs of your phones. We'll be right back. device maker Casetify is announcing it's launching NFT Your Case, which makes custom phone cases using NFT verification technology. Stick with me on this one. Users will be able to verify NFTs on Ethereum wallets, and then they can print them onto Casetify cases. This move comes after Casetify's NFT purchase itself of a Bored Ape Yacht Club. That's number 3583. They bought that for 83.4 Ethereum, which, by the way, is about 260,000 US dollars. So let's unpack exactly what's going on here with Casetify founder and CEO Wes Ng from Hong Kong. Wes, it's great to have you on the program this afternoon. Tell us a little bit about the strategy here. Why did you decide as a phone case company that you had to get into the NFT space?
Well, first of all, thanks for having me. Casetify was started back in 10 years ago, and the mission that we have always been around one thing, which is self-expression. And for me, what's better things than, showing off your favorite NFT projects on a device that you're carrying every day with you. So we thought, okay, maybe we should do something about, turning this digital thing into a physical thing. And that's why we call it the digital case.
So Wes, talk to me about how big the market potential is. I mean, this got us thinking in our morning meeting today. I, by the way, should point out, I have a phone case from Casetify. I do not own an NFT. How big is this market for you? Or how big do you think this market can be for you?
Well, if you look at a traditional tech accessories phone case market, we're talking about 33 billion globally. But then if you're talking about the NFT space, that's a $1 trillion market size I'm talking about. And what's interesting about, if you look at a phone case company, why we're getting into the NFT space is because Metaverse itself is all about self-expression. So it's a very natural extension for Casetify to get into Metaverse. We want to empower people to express.
Okay, Wes, explain to me, though, exactly what this product does. And if a phone case is supposed to be an expression of yourself, I've got nothing on here, so I guess I've got nothing interesting. But let's say, for example, I wanted to get a Casetify phone with an NFT that I own in an Ethereum wallet. How do you verify when I'm showing this off at the restaurant to my friends that I actually own this NFT?
Got it. Well, I'll explain to you with a case on my hand. So this is the actual NFT Your Case. Oh, let me show you what it is. So we got the blue ring here, and a regular Casetify case feature a black camera ring. So instantly you spot the difference. And the most important thing is this part, all right? We'll be able to print your favorite NFT project, connect with your Ethereum wallet. And then what it does is, not only we just print any NFT that you have in your wallet, but we will also read the smart contract to verify ownership and authenticity. So we make sure this is legit, in another word. And also you see that QR code here, right here. So you can scan it and then show the Ether scan record. So you can show off, okay, you really owns it. It's not a screenshot. And also the details here, it shows how much you pay for it as well. So that's another flex.
So Wes, I'm sensing a pattern here. We're all talking about what cases I have. I'm going to show off my case. Can you see it? This is a collaboration that Casetify actually did with Paketo, and your platform has come to be known for that, not just with brands, but also with TikTok influencers, K-pop groups. What does that tell you about how people are starting to think about their phone? I mean, obviously, this is half of my brain right now, I would say, quite honestly, but what have you seen in changes in the way people consume on your platform, and what specifically they're looking for?
Yeah, I mean, for us, there's a very interesting observation that we got is people really seeing their phone more than a phone case, like a protective gadget. It's more like a statement that they want to show who they really are. So with Casetify, we collaborate with Blackpink, with Pokemon, with a lot of fashion designers, artists. I mean, it's really, for everyone. So for NFTs, what's really interesting for us is, we want to do the same, so for what we have been doing on a phone case, but on a different platform for a different medium.
Well, certainly going to be interesting to watch the growth. Wes, appreciate you staying up late for us over there in Hong Kong. Wes Ng, Casetify founder and CEO. Coming up, stocks are poised to snap a 5-day winning streak as Facebook's parent company Meta tumbles on earnings. We've got the latest market action on the other side. Welcome back to Yahoo Finance Live. Facebook's Meta continues to drag down the rest of the market right now. We've been talking a lot about the reaction on the back of those weak earnings. NASDAQ continuing to be the laggard on the day, down well over 2.5%. Let's bring in Yahoo Finance's Jared Blickery for the rest of the market action. Jared.
That's right. And let's start off with a chart of the NASDAQ here. This is a 2-day view. So not a lot of action yesterday, but definitely a lot of action today. And we'll look inside and see all those mega caps that are experiencing, for some of them, some of the worst days ever. That would be Facebook, of course. Now, S&P 500, I want to go to a 2-month view because yesterday we stalled out right under 2,600. This is one of my key levels, this little box in here, and it looks like short sellers are in control, at least in the interim. But I'd say if we break below 4,500 or so, probably going to take out these lows, at least test them. So that is definitely in the cards here. Interesting that the market action today, not even based on the Fed. Nobody's really talking about inflation that much. It's really all about Apple and its effects on some of those other mega caps. Here's Staples. That's the only sector in the green today. Very defensive setup. Utilities and healthcare in the red, but close behind. Communication services, that's where the action is. And we're going to see what's happening with Facebook. Now down 26%. That is $190 billion of market cap that has been wiped out in one day. Let me just pull up a chart here. I was charting this earlier. I think we have to go back 5 years, and especially looking at the candlestick area, we just sliced through what should have been strong support, and that is not a vote of confidence. We've been at these levels before, but not since the recovery in March of 2020. So probably going to bounce around in here, and then we're going to see another decline. That would be par for the course with what happened in 2018. Very similar situation, but in that case, just kind of, slowly bled dry into the end of the year. So we'll have to see what comes of this, but gapping below support is a very ominous setup here. And then you can see Amazon. Amazon's down over 6%, almost 7%, but still kind of holding its trading range. You could make the argument that it maybe is trying to break below here. I would say that this is kind of a make or break level. So 2,800 is what we're watching in Amazon. Also want to check out the travel sector, kind of get a different flavor of what's going on. Aside from the hotels, we've got Marriott, Hilton, and Hyatt. Those are all in the green. Carnival Cruise Lines, that's down 1%. Norwegian Cruise Lines down 1.75%. Also want to check out the ARC Innovation components. They're getting taken to the wood shop too. Shopify down 7%, Square down another 10%. Just look at what's happened over the prior 4 days. So kind of a mixed picture. We did have some green, but also some dark red guys.
And, Jared, it's worth noting as we talk about this sell-off that we're seeing in tech, just how significant a weight Meta is, right? Meta/Facebook. On track right now to lose more than $200 billion. If we're talking about a 20% decline coming off of the lows by the end of the session, it would still be more than the market value of 452 S&P 500 companies. So that just shows you how significant the sell-off we're seeing today is. And worth noting that this may not be the end of it, because we've got Snap reporting after the bell. Obviously, Amazon, a heavyweight, also reporting. And Brian, it feels like this could really accelerate if those numbers come in weak.
Yeah, certainly. And I think that the big story, though, if we just kind of zoom in on Facebook, is really just the growth story that they have in the medium term. I think that the long-term vision that they plotted ahead, and possibly a big reason why they timed the rebrand perhaps ahead of this report to Meta, or whatever it is that you want to call it, is because of the fact that the existing revenue streams that they have right now probably don't have the growth rates that people were pricing in the rally that we had seen through this pandemic. But at the same time, I want to emphasize that this is still a stock that's up 18% over the last 2-year period. And Jared, I don't know if you have any cool fancy charts that you can show to kind of illustrate that.
Always.
Obviously, that's below the NASDAQ's 50% growth over that time period. But look, at the end of the day, if you put money in this stock during the pandemic, you still made out pretty okay, did you not?
Yeah, it depends on what you're looking at, though. I like to look at something called anchored VWAP. That's the average volume weighted average price. I don't have that particular indicator on here, but basically it gives you an idea of where the average person who's come into the market in a particular rally or decline is experiencing. So it would look something like this. Probably caught this low here, and the average person might be is probably underwater now. So I think that tells you that on a net basis, a lot of people are going to be looking for the exits on any kind of a rally here. There's something in trading where people want to get out at break even. It's a bad habit, but market goes against them. They get into the green by 1 penny and they sell. And that's why markets tend to reverse at very predictable places. You put all that behavior together on a net basis, and that's why technical analysis works. What we're looking at here, this candle here, this is a broken stock. This is not going to fix itself overnight. You can talk about future monetization opportunities with Instagram, with WhatsApp, but you put it all together, this is a broken stock right now, so it's going to need some time to repair. You take a look at what happened in 2018, did not get to new material highs until after the pandemic sell-off was over. So we're talking about 2 years there, it looks like.
A broken stock, just got to let it repair itself. Just give it some time, it'll be okay. Yahoo Finance's Jared Blickley, thanks for breaking all of that down for us. Well, before we go and say goodbye to you for this afternoon, I want to tease our poll that we have on Twitter. We want to hear your thoughts on the following question. Should employers be required to post salary ranges in job postings? This has become a big debate in New York City or this could become part of the law? Obviously, we were asking for you to say yes or no. Do you feel like employers should disclose that information? Well, again, markets are red across the board as we almost wrap up the 12 p.m. hour here on the East Coast, again, across the board. But for Akiko Fujita and Brian Chung, thanks again for tuning in for the last 2 hours. More Yahoo Finance live coverage will continue. Alexis Christoforous and Karina Mitchell will have you on the other side of this break. We'll be right back.
Where have all the users gone? Facebook loses daily users for the first time in its history, and investors send the stock to its biggest ever one-day drop. What Facebook's dismal outlook means for social media and big tech. Lawmakers are grappling with just how to regulate burgeoning industries. Congresswoman Nancy Mace of South Carolina is here to talk about how Congress is taking on 5G, cannabis, and autonomous driving. And the airline industry asks the Biden administration to relax COVID rules for international travel to the U.S. But is now the time to drop testing requirements, and just what's at stake for the major carriers? Hello, everyone, and welcome to Yahoo Finance Live on another busy day. I'm Alexis Christoforous here with my co-host Karina Mitchell. And it looks like stocks, Karina, are back to their losing ways. We have got all three benchmark indexes deep in the red this hour. That disappointing profit report from Facebook's parent company, Meta, certainly weighing heavy on tech. Let's not forget we still have Snap, Pinterest, and Amazon waiting in the wings. Also not helping, news today that the service sector has slowed down, putting the health of our economy right back on the front burner.
Yeah, economic tensions being played out in the markets today. Let's get you right over to the benchmarks to see what's going on right now. We can see all three major benchmarks deep in the red, giving up a 4-day winning streak that was actually helped along last week by strong earnings from Apple and then Alphabet this week, Meta helping sink all of that. So the Dow is down by 333 points, the S&P off by 78 points. And the NASDAQ back in correction, with Amazon set to report after the bell. Expectations there are muted. Sector-wise, consumer staples, the only sector in the green right now, and the laggards, the biggest ones, the communication services, and of course, tech. One reason, of course, is Meta. It was a $900 billion company yesterday, now valued at about $670 billion. The stock is down 25%. Facebook, Instagram user growth stagnating, taking a hit from those Apple privacy changes. Guidance was weak. VR and AR unit also was disappointing. They pumped a lot of money into that area. Okay, let's head over to the bond market for a quick check there, see what is happening. And we can see that bonds are higher at the moment, up to 1.83, so above 1.8 ahead of the jobs report. And the 30-year yield is up at 2.15%. All right, with a deeper dive into what else is going on in the markets, let's bring in our Jared Blickery. Jared, there is definitely a lot going on and much more to come after the bell today as well.
Yes, it is. And just taking stock of everything, definitely about Facebook, Meta, whatever you want to call it here. But let's chart the day's price action. This is going to be the NASDAQ. It's down the most, over 2.5% here. But I do want to point out that we were in the midst of a nice 4-day rally. Kind of petered out yesterday. S&P 500 hit some critical resistance. But for the most part, the NASDAQ still holding on to 5% of gains. Also want to take a look at the VIX, and we'll get a candlestick chart here to get a bigger deeper perspective. And you can see 2 green candles here, so we are on the upswing in the VIX. Doesn't mean that we have to go higher, but it could be the start of something. As I said, the S&P 500 selling off from key resistance, so we got to check that out, keep it front of mind. So here's our sector action. Only staples is in the lead today, or in the green today. To the downside, communication services, that is down 6%. Worst day since March of 2020. That was the midst of the pandemic sell-off. Also, consumer discretionary and energy looking weak here, but here's where the real carnage is in the NASDAQ, and we can see Facebook off 26% here. And you just take a look at a 1-year chart, you'd have to go back several years to find where we are in terms of price right now. I do also want to take a look at some of our leaders. These are flagging a bit. We have only the regional banks. Those are in the green here. To the downside, we got U.S. internet stocks. We got the ARK Innovation Fund, IPOs, solar energy, chip stocks, software, and cannabis. All of those on the lower level here are in the red, most of those in the deep red. But if you take a look back to Facebook, back to Meta, by the way, who is going to get a new ticker, I think in the first half of this year, they finally secured META, before is MVRS. They're going to get that ticker sometime in the coming quarter or half. So Facebook off 26%, but look at Snap. Snap is down 21%. Even Amazon down about 6 or 7%, all on the back of Apple, that big change that Apple made to its operating system, making it a little bit more difficult for users to have their data tracked. Now having to opt in really smashed some of that user growth. Only Tesla among the mega caps is in the green here. So let's take a look at the EV space before we go. And besides Tesla and Toyota Motors, everything else pretty much in the red here. Rivian down 7%, guys.
All right, thanks a lot for that roundup, Jared. I want to stick with these markets and bring in Brian Jacobson, Senior Investment Strategist at Allspring Global Investments. Brian, we meet again on another day where we have got ourselves a steep sell-off, and I want to begin with big tech because we had a top tech analyst on earlier who actually said that Meta is, quote, probably dead money in the short term. Earlier, Jared called it a broken stock, and we see other social media companies like Twitter, Pinterest, Snap falling in sympathy. What do you do if you're an investor with Facebook or Meta right now?
Yeah, that's a good question. And I mean, thankfully, across a lot of our portfolios, we were underweight Facebook going into it, mainly because we saw better opportunities elsewhere as far as where are some of the really sustainable growth or underappreciated growth opportunities. And so I think that as far as broadly for investors, I mean, the news has already come out and it's a little late to act on it now. And you just really have to do a little bit of maybe soul searching to ask yourself what the future might hold. Who's likely to be the next leader? It's really a question about who's going to come out with the next big thing next that's really underappreciated by the markets. For my team, we actually think that it's really the pivot more towards cyclical stocks here, at least in the short run, favoring more of the small to mid cap names, more on the value side of things. Not to say that tech can't recover, but it could be a little tough going for a little while here.
So when you say tough for a little while here, you don't believe then that we've fleshed this out and that the market will begin to repair itself and rebuild tech anytime real soon?
I think that it just really draws into question what the growth opportunities are and where they might be. And it might take a little bit of time for companies to really prove that. Across our portfolios, we still are optimistic on the outlook for tech. Just to give you an example, we're on this type of activity, we're beginning to slowly overweight, say, the NASDAQ relative to the S&P 500 because we do like the price correction that happened, but still the long-term value. The only problem is trying to time the turn of the market. That's a tough thing to do, which is why we're more legging into it very gingerly as opposed to just jumping in full bore.
All right. Well, certainly, this jobs report due out tomorrow could be a market moving report. What are your expectations and how did you position your portfolio perhaps differently given the jobs data we saw this week? Disappointing numbers from ADP. We had another rise in weekly jobless claims.
Yeah, I mean, to be perfectly honest, I don't know what to expect anymore, right? I mean, there was a huge miss with the ADP number. The initial jobless claims numbers weren't horrible. But if you look at, say, the ISM surveys, the manufacturing index and the services index, they each have a subcomponent as far as employment. Those ticked lower. So, I mean, it's pointing towards weakness, but we've been already hearing from President Biden and even Chair Powell and many of the Fed speakers that, well, maybe we should kind of ignore this one just because it's really reflecting the slowdown that took place December and January due to Omicron affecting the service sector activity. So it's really more a question of what's the next one? What's the February number going to look like? And so looking out that direction, we expect to see some improvement going to more of a run rate of around 200 to 250,000 jobs per month, which is actually a marked slowdown from what we had last year, where it was closer to 500,000 jobs per month.
What do you make of these jobless claim numbers declining further for the second straight week as I guess this Omicron wave starts to shrink? How do you rectify that with the big drop we saw in private payrolls this week?
I think that's really the challenge. And one way to think about it is as far as what are the survey questions that they're actually answering, right? ADP, it's about who actually got a paycheck. For the payrolls number, it's about who are on payroll. So you can be on a payroll, and if you're not working because you're out sick or something, you might not get a paycheck. And so, that might be part of it here if people were out sick. And then with the initial jobless claims as well, are these people who already exhausted their benefits, or is it that they're just temporarily off from work? Maybe they were just sick, so they didn't actually need to file for unemployment claims because they're anticipating going back to work within a week or so. So I think that's maybe part of the story, is just what are the surveys actually asking? And they're somewhat giving you maybe a bigger picture when you get into the details about this was a temporary slowdown, but it doesn't really change the general trajectory of improvement for the labor economy as a whole.
All right, I want to switch gears and talk about the Fed for a moment because the Bank of England imposed back-to-back rate hikes, something it hasn't done in, I believe, about a decade, as that country tries to wrap its hands around higher inflation. Do you think that gives our central bank here in the U.S. a little more license to perhaps do the same? And do you think they might have to?
No, I don't actually. And the reason is the Bank of England, keep in mind, they have one primary mandate, which is price stability, so inflation, whereas the Federal Reserve, they have a triple mandate about full employment, stable prices, and moderate long-term interest rates. And so that gives the Fed a lot more wiggle room in order to actually set policy and maybe be a little bit more patient than what the Bank of England can be. And so the Bank of England, I think, has startled a lot of investors as far as with pretending they were going to hike and then not hiking, and then hiking when they said they might not, and now hiking 2 times in a row. And additionally, they're saying that they're actually going to be selling some of their balance sheet assets into the market over the course of the next 2 years. So I think that it's actually a stark contrast to what we can expect from the Fed, which is about moderate increases in the interest rate and then gradually allowing its balance sheet to shrink. So it's, I think actually they're standing in almost polar opposites as far as how they're going to approach removing accommodation.
And Brian, just staying globally here for a moment, what opportunities are you taking advantage of outside of the U.S. right now? And we know that there are geopolitical tensions between NATO, Ukraine, and Russia at the moment. So how are you playing that, if at all, on the portfolio?
Yeah, the way that we've done that is actually just exposing our or increasing our exposure to energy, whether it's through West Texas Intermediate or through Brent, or if it's through the energy sector as a whole. So we do have an overweight to energy because we do think that this issue isn't really going away anytime soon. And as we've seen with the earnings numbers, this has been pretty much a bonanza for a lot of the energy companies. But we actually really like emerging markets as well. So when you get this almost a spasm of fear hitting the market, you tend to get lots of parts of the market selling off, even if it doesn't seem to be justified by the fundamentals. And we like the emerging markets for a long term. It might be a little too soon to say that they're going to take a turn, but in the last 2 hiking cycles, 2016 to 18 and then 2004 to 6, emerging markets outperformed the US. And so that's kind of where we're leaning in towards a little with our allocations.
All right, Brian Jacobson, Senior Investment Strategist at Allspring Global Investments. Always great to get your insights. And as always, you can step up your investment strategy with a free 14-day trial of Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek and ad-light experience. You can check it all out today at yahoofinance.com/plus. Karina?
Okay, and we speak to the CEO of IT giant Cognizant about earnings and the company's outlook coming up. Stay with us. Welcome back to Yahoo Finance. Well, IT services giant Cognizant reported fourth quarter results yesterday. The stock was higher on their earnings, lower today along with the rest of the market, but capping off a year the CEO says delivered a series of hits. He joins us now, Brian Humphreys. Thanks so much for being here, Brian. So revenue and guidance came in line with expectations. Profit was a beat. You say Q4 revenue, which came in at $4.8 billion, was the highest ever. The stock recently also hit an all-time high. Congratulations. That is a lot of firsts. I wonder, what are some of the other firsts and how did you get there? I know you have a strategy of 4 pillars of growth.
Hi, Corinne. It's great to see you, and thanks for having me here. Yes, we're very excited about where we stand at this moment in time. We had record quarterly revenue in the fourth quarter, record revenue for full year 2021. We'll surpass $20 billion in revenue next year for the first time in our history. And as you said, we've been creating shareholder value as we do that. So we've well down the path now of executing against a comprehensive program, which started with refining our strategy, aligning our portfolio to higher growth categories. And of course, what's important in a knowledge-based company like Cognizant is our people. And I'm delighted to say we are a talent magnet these days. We're executing our largest ever recruitment campaign and continue to add tens of thousands of employees per quarter.
Yeah, Brian, I wanted to ask you about that because you hired over 40,000 employees in 2021. I mean, if that's not a testament to the demand you're seeing for your products right now. Talk to me a little bit, though, about how you are retaining employees, how you're attracting talent, and then we all keep hearing about those higher labor costs. How is that impacting the bottom line, if at all?
You know, it's very important, as you said, to be able to attract talent, but simultaneously to be able to develop talent. So it's somewhat serendipitous for us. We have been repositioning our brand in recent years. We've always been known as a company that's been values-led, built around client centricity, delivery excellence. We're increasingly known as a company that has a high growth profile, a digital transformation partner to Global 2000 C-suite executives. And so for the talent we brought into Cognizant, we've deployed over 23 million hours of learning and development upon that cohort in the last year. Those employees have taken over 130,000 courses. And of course, we have revitalized the notion of upward mobility in Cognizant. We've had 14,000 job moves or promotions in the last year alone. So we're very excited about the engagement of our employees and very excited about our ability to continue to attract talent.
And then, Brian, the company's revenue from its most advanced projects, known as digital, rose by 20%. Can you tell us more about those projects and what they include?
Yeah, you know, we're excited about digital. When I joined the company a few years ago, it was less than 30% of our business, but it's now about 45% of our business. And that's important for us because it enables us to be in higher growth categories, typically higher margin categories. But in terms of our relationship with our employees, it's really good in terms of engagement because our employees get to work on cutting edge technologies. And in terms of our ability to work with clients, it increases our intimacy with them because we're working on some of the most strategic projects that they have. And every company in the world has gone through a period when they've thought of the COVID environment as being perhaps a temporary environment. But what we found ourselves doing is they are managing their business now on a go-forward basis, leveraging the same lessons as they experienced during the COVID period. And a lot of this is around better leveraging data and analytics, knowing their customer, upselling, cross-selling. The notion of user experience is more important than ever before, both for their employees as well as for their clients. And ultimately leveraging modern technologies like cloud to become more agile, better able to scale with the presence demanded in today's environment. So it's a very exciting period of our business. We're rapidly embracing it. We spend about $1 billion a year now in M&A to accelerate our digital portfolio, and we're certainly on a roll in that regard.
Talk to us a little bit about the spending power on the part of clients in this environment, because I'm curious how higher inflation and higher labor costs are impacting your clients to the extent that it then impacts your relationship with your client.
Look, that's one of the reasons I think it's a wonderful time to be CEO of an IT services company. There is no demand issue whatsoever. On the contrary, there is more of a supply issue, which brings you back to that importance of investing in your talent. We had bookings growth in the third quarter of 24% and in the fourth quarter of 22% year over year. Our annual bookings this year were $23 billion. That tells you behind each and every one of those dollars, there is a client win. And so at this moment in time, I'm very, very bullish on the industry and our position within it.
All right, we will leave it there. Congratulations on a great quarter, Brian Humphries, Cognizant CEO. Thank you so much for your time today. We're going to take a quick break, but coming up, the latest on the COVID front, including a push by airlines to end testing requirements for international travel to the U.S. Stay with us. Welcome back to Yahoo Finance. Well, Pfizer's applied for emergency use authorization of its COVID shot for kids under 5. It could be available later this month, but some parents are worried. The Surgeon General, Vivek Murthy, spoke earlier today with a message of reassurance. Take a quick listen.
Pfizer's application will now undergo the same independent, rigorous, and transparent review process that was used to authorize the vaccines that now more than 250 million Americans have received, including millions of children ages 5 and up. It will involve the FDA receiving the full data from Pfizer, posting that data publicly, and then convening its advisory committee for a transparent discussion of the data. The FDA will then render its opinion, after which the CDC and its advisory group will assess the data and make their recommendation.
To discuss, let's bring in Dr. Anand Swaminathan, Assistant Professor of Emergency Medicine at St. Joseph's Regional Medical Center and Emergency Medicine Physician in New Jersey. Doctor, thank you so much for being here today. So parents are concerned, and I'm wondering if you could just explain to us, is the regimen any different? Is it the same dosage? Do you wait the same time before shots?
Well, it is going to be a different dosage that's been studied, and that's what we're going to be looking at the data for. And this transparent process that the FDA is going to go through is really important for the public to understand that we're not just going to approve these out of hand because we want them approved. We're really going to have to look at that data and see whether there's effectiveness. But if we get an EUA here, it could be pretty huge because we're talking about 20 million-ish kids in that age group that now could be eligible for vaccinations. We have tons of data telling us about safety. We do need to see the data on effectiveness. And this is particularly important right now because we've had about 3.5 million cases in kids over the last month. We've had 8,000 hospitalizations. But Karina, I think one of the important things for us to do is not just focus on the new shiny toy, but think about the things that we already have in place as well that maybe we need to do a little better job with. If we look at kids 5 to 11, vaccines for that group has been approved for 3 months. And yet we only see about 20% of that group that is fully vaccinated. That means there's 22 million kids between 5 and 11 who are not fully protected. And then we look at the older age group, those teenagers, 12 to 17. We only have about 50% of that group vaccinated, only about 20% boosted. So again, we're talking about 12, 13 million teenagers who aren't fully protected. I have 3 kids between the age of 5 and 13. All 3 of them are fully vaccinated. My 13-year-old has also been boosted. And when I talk to my colleagues, whether they be MDs or RNs, anybody who takes care of kids, all of their kids are fully vaccinated as well.
Yeah, I have a 14-year-old. She couldn't wait to get her shots and get boosted as well. So some people are just really gung-ho all about it, but then some are nervous and holding back. What do you think we need to do, or you need to do as medical professionals to help get more people to feel comfortable to go and get those shots for their children?
I think more of us need to be really frank with the American people that our kids are vaccinated, that these are safe. And we need to have clear messages based on the science that we have available, that they are safe, they are effective, that COVID is massively affecting kids, especially during this Omicron surge. And these are preventable. These are preventable hospitalizations. There are preventable deaths in kids. It's not a huge number, but still 75 kids died in January from COVID. Those are preventable deaths. We don't need to have any kids dying of this, and vaccines can help to protect the group where they're approved.
And Doctor, let's switch gears for a second. Airlines are now calling for an end to testing for international travel into the U.S. Given that we've seen that this virus doesn't respect any sort of borders, is that a logical conclusion? Does that seem like the right next step to take?
Well, I think the testing rules that we had in place for travel never really made a lot of sense. 3 days before you travel to get a test, then it moved to 1 day. We even know 1 day before isn't really adequate with Omicron. You can be negative yesterday and positive today. So I'm not sure that the testing rules ever made a ton of sense. Instead, what we should be switching to is other layered mitigation. Let's make it mandatory that you have to be vaccinated to get on any plane, whether it be international or domestic. Let's make masking not just mandatory, but let's make high quality masks mandatory. What if when you go to the airport, they give you an N95 or a KN94, a high quality mask that can serve to protect you, those around you? I think with layered mitigation, the testing isn't as necessary, but we need to make vaccines mandatory for flying.
But Dr. Masking has been quite controversial, and the latest sort of news out is that young kids should be wearing their masks under the age of 5. You have 2 and 3-year-olds. These young children, they put it on, they take it off, it drops on the floor, they pick it up. How hygienic is that? Does that seem like a sensible thing to do, particularly when you see, people like the mayor and governor in Los Angeles sort of taking off their masks and walking around? There's so much sort of controversy and confusion that happens surrounding wearing masks.
There is a lot of confusion, and it's because we're not really focused on the science. The masks work, especially high quality masks. They work to prevent people from getting others sick. And the masking isn't just about protecting yourself, it's about protecting those around you. So in indoor settings, as cases are continuing to surge, kids should be masked. My kids wear N95s every day that they go to school to protect themselves and protect those around them that maybe aren't fully vaccinated, that are immunocompromised. And what we have to kind of also steer away from is that we can't always have perfect, but that doesn't mean that we abandon the measure completely. Any level of protection will be helpful. And most kids, at least the kids that I've had experience with, they wear their masks pretty well. Under 2, of course, you're going to have really not very effective mask use. But for most kids in an indoor setting, they can wear masks. And of course, that helps to protect those kids that maybe are too young, they can't wear their masks.
And Doctor, as far as getting more people to realize the importance of vaccination, I'm wondering, where do you stand on the issue of misinformation? It's been in the news lately a lot, partly because of Spotify. It's star podcaster Joe Rogan getting into some controversy over allegations that he's spread misinformation. He apologized subsequently. Where do you stand on that?
Well, Joe Rogan and Spotify are just the tip of the iceberg here. It's Facebook, it's Instagram, it's Twitter, it's Reddit, and it's also politicians, people like Ron Johnson, who are frankly spreading lies about vaccines. And that disinformation really undermines all of the public health efforts that we are putting enormous amounts of efforts in to protect the American people, the American public. That kind of disinformation is leading to thousands and thousands of deaths. In fact, we have data telling us that 160,000 deaths could have been prevented if everybody got vaccinated. And this kind of misinformation undermines those efforts to get everybody vaccinated. And, nobody would drive around in their car, hear a knock or their brakes don't work, and drive up to the emergency department and ask me for advice on how to fix their car. I'm not qualified to do that. And in the same vein, we shouldn't be going to a comedian, somebody who does color for MMA, and asking for advice about science and about medical issues. Instead, we should be focused on real experts, the public health experts who are out there, who are doing the work, who are living this every day, who are putting the effort in to get the best information across to people. And I think the American public is smart enough to be able to do that. But sometimes we need a little bit of help. And we need to really hold people accountable, hold Spotify accountable, hold Joe Rogan accountable for this misinformation that's frankly killing people.
Yep, follow the science. Good advice there. Okay, we will have to leave it there. Dr. Anand Swaminathan, thank you so much for stopping by today.
All right, great conversation there, guys. Thank you. Coming up next, a conversation with New York Congresswoman Alexandria Ocasio-Cortez on capitalism. So don't go away.
Welcome back. Well, in this week's episode of Influencers, Yahoo Finance's editor-in-chief Andy Serber heads to the Bronx for an exclusive sit-down interview with Congresswoman from New York, Alexandria Ocasio-Cortez, as she shares her thoughts on capitalism and the broader U.S. economy. Take a listen.
I believe that in a broad sense, because when we toss out these big words, capitalism, socialism, they get sensationalized, and people translate them into meaning things that perhaps they don't mean. So to me, capitalism at its core, what we're talking about when we talk about that, is the absolute pursuit of profit at all human, environmental, and social cost. That is what we're really discussing. And what we're also discussing is the ability for a very small group of actual capitalists, and that is people who have so much money that their money makes money and they don't have to work, and they can control industry, they can control our energy sources, they can control our labor, they can control massive markets that they dictate and can capture governments, and they can essentially have power over the many. And to me, that is not a redeemable system for us to be able to participate in for the prosperity and peace for the vast majority of people.
So people talk about stakeholder capitalism, right? Like Larry Fink at BlackRock, where the weighting for different constituents besides shareholders is more equal. Is that something you'd be amenable to?
Well, I think at the end of the day, it's it is about who has control over the very core assets of production in society. If it ultimately comes down to a billionaire or the Koch brothers or the Koch family having control over the vast majority or large plurality of our oil assets in the United States, if it's a handful of very wealthy families having control over, private families having control over means of production, that is essentially the capitalist system that we live in. It is a small group that is of privatized control over what we eat and how we fuel our society. Now, where we can transition to, and there are certain ideas where we're talking about, for example, Elizabeth Warren has discussed workers being elected to the boards, governing boards of companies, and also, we're here in the Bronx. I represent a community that has the largest concentration of worker cooperatives in one of the largest concentrations in the world. Now, these are alternative ways of doing business. Free markets are not the same thing as capitalism. And you can have markets where businesses and ways of producing, trading, selling goods are really controlled, and not just controlled, but given more power to workers. People get a fair shake. Union jobs, unionized workplaces. All of these are different steps and levels that we're talking about in a more just economy.
Congress people trading stocks. You have come out calling for a ban here. And I wonder, and there seems to be some momentum, but I wonder why this seems to be such a difficult thing to pass. And is Speaker Pelosi a roadblock here?
Well, it's not really a mystery to me why it's difficult to pass. An enormous amount. I wouldn't be surprised if it was a majority of members of Congress hold and trade individual stock. I don't know the actual numbers, but it is a very large degree. And the key here is that it's not to say that you can't have a retirement fund or a college savings account.
Or a blind trust.
A blind trust, right. a mutual fund, an index fund. These are vehicles of investments that are broad that individual members of Congress don't have direct control over. But even last year, there was at least 75 members of Congress that held individual stock in Johnson & Johnson, Moderna, and Pfizer. We're talking about in the last 1 to 2 years. And so that is where we should be drawing the line. I am a member of Congress. Members of Congress have access to very sensitive security clearances. We have access to very detailed, tailored briefs. Our job is to try to anticipate and legislate for what we see is coming. And we should not have the ability to both have access to that information and be able to hold and trade individual stock. And that's really what this is about. It's about our ability to direct and hold trades in individual stock with access to the sensitive information that the public has given us.
Voting rights reform, is that a dead issue? It's tied to the filibuster. Mm-hmm. Joe Manchin, Kyrsten Sinema have come out against it. What is your take on where that stands? This is, I think, one of the top level
questions and issues that we have before us in Congress. I very much believe that we are at the precipice of a return to Jim Crow style laws across the country. We're already seeing these wheels in motion, attempts in Texas and Georgia and across, across many different states, attempts at voter suppression. And frankly, what Senators Manchin and Sinema failed to recognize, and what is disappointing and sad to see, is how ahistoric their stances have been throughout this debate. Ahistoric on the roots of the filibuster, ahistoric about the idea that voting rights requires bipartisan consensus, when the right to vote for Black Americans was passed on a partisan basis. And I truly wonder what their answer to the question would be, if they would say, if you were back in 1965, does this mean you would have voted against the Voting Rights Act? Because we're in the same situation today, and if they are holding their standards today, that they are expressing today, back to 1965, it means they would have voted against the Voting Rights Act. And is that their stance today? And I believe the public deserves to know that.
Another potential battlefront, the Supreme Court, with Justice Breyer announcing his retirement. The president has said he wants to appoint a woman of color, a Black woman, I believe, specifically. What else would you look for in this justice?
Now, I appreciate that question, because identity is just the starting step when we are discussing a Supreme Court justice. There is no shortage of incredible, qualified, leading Black female candidates to serve on the Supreme Court. But the question is, what is going to be that nominee's worldview? And what I hope is that what we see is a nominee that is truly rooted in not just public service, but with a protection towards the very rights that frankly have been eroded over the last not just 2, 3, 5 years, but the last 10 years. What their stance on something like Citizens United would be, what their stance would be on expanding the right to vote. I mean, these are central questions about our democracy, both in the financial capture of our democracy, but also the racial injustice capture of an erosion of our democracy as well.
Okay, that was our Andy Serwer talking with Congresswoman Alexandria Ocasio-Cortez in a wide-ranging interview. We are going to take a quick break, but on the other side of it, home ownership is key to creating generational wealth, but the door is more open to some than others. We discuss that coming up. Welcome back to Yahoo Finance. Well, home ownership has always been a part of the American dream, but for many minorities, including Blacks, the dream is becoming unaffordable. Here to shed more light on the topic, we are joined by Kristen Myers, the Balance Editor-in-Chief. Kristen, thanks so much for being here. And this is a great topic, so I'm so glad you came on to discuss it. So the latest census data show that white home ownership held pretty steady last year at about 74%. However, Black home ownership has seen a steady decline from the pandemic peak to about 43% at the end of last year. Why is that gap getting bigger?
Yeah, and one other thing to note there, Karina, is that this gap that's around 31 points right now is actually wider than the gap that existed 60 years ago in 1960 when it was 27 points. So why we're seeing this gap, or rather this decline, right now, I think probably a little bit of an impact from the pandemic. But also we have to say that this gap has existed again for 6 decades. It has been persistently wide. And I think really we have to look back in history for the answer to that. This is essentially just the cumulative and persistent and ongoing impact of, frankly, discriminatory policies that exist in the housing market.
Well, let's tick through some of the reasons why this is still happening all these years later. And the problems are very much the same as they were decades ago. Let's begin with redlining. How prevalent is that right now, and what has its impact continued to be on the Black community?
Yeah, so redlining doesn't exist in the open way that it existed in the 1930s, when it was an official policy of the banks to quite literally draw a red line around maps of areas where they were not going to give loans, or where only Black Americans or other minorities were essentially allowed to live. But we do see that there is segregation still to this day. It just doesn't happen as overtly as it once did, because redlining was essentially outlawed in 1960. But we still have studies to this day, even of agents sometimes, steering home buyers to certain areas that maybe have people that only look like them. So the effect of redlining still exists to this day, and it does still happen to this day, just not as openly as it once did.
Yeah, Kristen, my husband is African American, and he was looking to buy a home in St. Louis several years ago, and exactly the same thing happened to him, and he was directed in one direction when he made it very clear, because he's from there originally. No, this is not where I'm interested. I'm interested in another area. So it definitely does happen. You say the policy of urban renewal is a new threat to Black home ownership as well.
So urban renewal is something that actually has been going on for quite some time. And it essentially was a policy that allowed the government to raise and completely destroy a lot of Black neighborhoods in the name of, building a highway or putting in shops and malls and other amenities and centers. And we saw a lot of Black communities just be completely destroyed because of that. So, first you have a lot of these communities or a lot of African Americans, I should say, forced into certain areas, then creating, vibrant communities of culture, and then having those communities destroyed through this process of urban renewal. But a lot of what we are seeing now is a devaluation of assets that Black home buyers have. So a lot of folks, they do manage to purchase a home, and now they want to sell a home. And right now, is a really great time to go out there and sell a house. Homes are at record high prices. But when they go and get an appraisal, their home is worth far less than the homes that are owned by their white counterparts, sometimes next door or within their same neighborhood. And the cumulative impact of that is literally hundreds of billions of dollars of lost wealth that has been, in effect, stolen from the loss of the gains that could be made in that housing market, even once you do own that home.
So look, we know that home ownership is very closely tied to wealth and generational wealth. It remains a popular, way to increase wealth for all people in this country. What does this gap, what is the inability for a large number of the Black community to become first-time homeowners? How does that impact their overall wealth?
I'm really grateful that you asked that question, Alexis, because we have talked a lot about the racial wealth gap in the United States, how it has widened over time, how it has remained persistent despite, massive gains in the stock market, despite massive gains in the US economy, right? Why does this racial wealth gap still exist? Well, the point is it's because of the homeownership gap that still exists. As you mentioned, home ownership still is the most popular, the most viable way that Americans can attain wealth. For most Americans, owning a home is going to be the largest asset that your family is going to have. So if you're first unable to purchase a home, and then even once you are able to purchase a home, your home is now worth less, that is real wealth that is being denied to you and your children and your grandchildren and your great-grandchildren, and on it goes. I mean, in 2019, homeowners had 40 times more wealth than that of renters. And that's just real cumulative losses that happens every single year. So if we want to tackle that racial wealth gap, we're going to have to start looking at that home ownership gap as well.
Yeah, thankfully, there is much more light being shed on all of these unfair practices. We'll have to leave it there. Kristen Myers, the Balance Editor-in-Chief, thanks so much for your time today.
Thanks.
All right, and coming up next, the sell-off continues on Wall Street. High tech leading the decline today. We're going to have a recap of the markets for you on the other side of this break. Welcome back, everybody. It looks like the market still cannot find its footing. We have got ourselves a broad-based sell-off on Wall Street right now. All of the major indexes sharply lower, with tech leading the decline once again. So it has become an all too familiar story. The Dow is now down nearly 300 points, off its worst level of the day. The S&P down 76, and the Nasdaq really taking it on the chin here, down more than 2.5%, or 378 points, led lower by those big tech names. Meta, Facebook's parent company, is suffering its biggest one-day loss ever. The stock is down 26% now on news that it lost daily users, or they fell for the first time in the company's history. Meta's stock losing more than $200 billion in value as investors dump the social media giant. We also see other social media companies like Snap and Pinterest lower as well. They're due out with earnings after the closing bell, as is Amazon. All of those stocks lower in sympathy with Meta today. It seems as though a lot of these tech stocks have been priced way beyond perfection, and they're now facing some scrutiny as interest rates are poised to rise. Quick check of the sectors. All of them are lower except for one right now, and just slightly in the green, we are seeing consumer staples moving higher. Much more Yahoo Finance Live to come right after this. Don't go away.
Metaverse, the tech giant formerly known as Facebook, was worth about $900 billion before reporting earnings, but the dismal results mean its cap has sunk to about $670 billion overnight. We assess the market impact and what it means for growth stocks. The push to unionize is gaining traction for some Starbucks workers, with efforts underway in 19 states to pursue elections. We speak to one barista to hear what the effort means to employees. Plus, the start of the Winter Olympics in Beijing is just hours away, but they take place in the shadow of a sea of human rights abuses, including those tied to the alleged genocide of Muslim Uyghurs, as well as international violations. We speak with Real Sports to highlight some troubling ties between the Games and China's repressive policies. Welcome back. I'm Karina Mitchell, along with Alexis Christoforous. The mood is definitely risk-off today after weak earnings from Meta, with more tech names set to report after the bell, including Amazon and Snap. Here with more on what is moving markets right now, let's bring in Jared Blickery. And Jared, it is an amazing story. Meta with its biggest drop ever. This company was worth, like I said, $900 billion, now down by about $200 billion.
It's incredible to see what's going on here. And it's not just Facebook. You can see what's happening to Snap. That stock is down 22%. Pinterest down almost 10%. We also have a social ETF down 7%. Twitter, by the way, 5%. The list goes on. But let's stick with Facebook here because it's really about the user growth just leveling off here and also their outlook. They're facing a lot of competition from TikTok as well as other companies. So let's go to a 2-year chart because you're going to have to go back 2 years to find the prices to which we have fallen today. And you can really see that on the candlestick action here. So here is this candle that we've been watching all day, and boom, you got to go all the way back to 2020. That was early on in the COVID recovery. I do have some analyst commentary. Here's JP Morgan. They're downgrading the stock along with many other firms to neutral from overweight price target down to 284 from 385. The company is seeing, they're saying, a quote, significant slowdown in advertising growth while embarking on an expensive, uncertain multi-year transition to the metaverse. Competition from TikTok along with Apple's changed privacy policy, quote, will both have a bigger impact than expected in 2022. Here's BMO Capital Markets. They're downgrading the stock to market perform from outperform. Price target is all the way down to 290 from 425. So you can see price target is still above the current price, but not encouraging given where it was coming from. They're saying that this downgrade comes on a greater competitive pressure and lower conviction in timing and impact of targeted measurement improvements. While Facebook continues to have a huge opportunity related to commerce, quote, it seems less likely to drive multiple expansion as new competitive elements likely overwhelm the narrative. They've still yet to monetize WhatsApp to a large degree. They haven't incorporated crypto. Don't know if that doesn't seem to be on their radar here, but there's a lot of work to be done here, not only for Facebook, but also for the investors to kind of flesh out and try and find what could eventually become a support level. But the low today, probably not going to hold.
And remember, there are lots of lawmakers out there who would like to see Facebook, or rather Meta, broken up.
Yes.
Want to talk about Spotify, things going, I guess, from bad to worse for this music streaming service. We know that their Q1 subscriber numbers were weak. They've got that controversy with Joe Rogan. And I think, correct me if I'm wrong here, on a percentage basis, they could be looking at their biggest one-day loss ever.
They've got to be up against it, Alexis, and you can see just hovering at the bottom end of their range. I'm going to put a max chart on so we can get a better view of the technicals in play here. Here's the price action for today. We're all the way down here, back in the middle of this range that we traded in, or that Spotify traded in from the beginning of its IPO before it broke out. So the fact that it was able to gap down below into what is or could be a support area, but not really, I think we're going to have to go lower and test the all-time lows, which seem to be about in the lower 90s. I have some analyst commentary as well. And here's Wells Fargo. They rate the stock in underweight. The price target is now 153. They cut it from 200. You can see 153 still under the current price. Their reasoning, they're saying, here we go, the bull case called for 2022 to be the margin inflection year after hefty podcast commitments in 2020, but that dream is fading. We know they spent a lot of money to bring in, well, Joe Rogan, you just mentioned him, among others. Also saying that Spotify will need to show the fruits of these investments to win back the street. We were talking with Mark Mahaney earlier today. He said he likes the long-term prospects for Spotify. However, you take a look at the price action here. This is another stock that's a little bit broken right now, probably has a little bit more downside to go.
And then, Jared, Merck revising down its sales forecast for its COVID antiviral sales, now 5 to 6 billion, down from 7 billion.
That's right. So they narrowed that a little bit. It was going to be 5 to 7. Now it's 5 to 6 billion dollars, and that's on the COVID front. But really, Merck is all about Keytruda. That's their huge money-making operation. And I do have some commentary from the street. But first, let me bring up a chart. We can see I would say that's one of the bigger losers in the healthcare space today. Here's Merck on a down 3% today, and here's what it's done over the last 2 years. And you can see that's a lot of sideways, choppy trading action right there. Here is a 5-year look, and you can see basically the stock really hasn't done much since it broke to the upside in late 2018. So here's what it looks like BMO Capital Markets is saying about them. Price target is now $87. They hold it at a market perform. They're saying the narrative at Merck remains highly dependent on Keytruda, with diversification of the pipeline says that Keytruda's success and growth is fairly priced into the stock, and the disappointing COVID-19 data from oral antiviral Molnupiravir, that's their drug that fights COVID, highlights a relatively thin late-stage pipeline. So not maybe enough drugs in the late-stage pipeline to get excited about in the near future. Maybe some bolt-on acquisitions to get some early-stage drugs would be in the works. Nevertheless, pharmaceuticals, let's see how they've done year to date before we go here. Yeah, that's not going to work. So I think I'll just end it there, guys.
Okay, Jared Blickery, thank you so much for that. We'll see you back in a bit for the oil close. We'll keep it on the markets right now and bring in our guest, Ahmed Riazgo, Insignio Chief Investment Officer. Thanks so much for being here, Ahmed. And just really want to start off with your take on that really disappointing results that we got out of Meta, and first quarter guidance also lower, and the way the stock is just being punished by investors today. We're seeing historic losses, as we pointed out. What is it telling us about the bigger picture tied to growth and valuations? What are you looking most closely at earnings as they come out?
Look, this is partly a consideration or a continuation of the broader theme we've seen here to start the year, where growth and tech are being hammered out there because of the environment we're in of higher rates. But I think the Facebook story, as long as with also other social media companies, is largely a story of, I think these people are going to be in a structural downtrend for many years. I think they're going to be coming under intense regulatory pressure. And these are just not names we want to own. What we've been telling our investors actually since October of last year is to use increases in prices in these stocks as exit points, not use dips like today as entry points. So we are sticking to that call.
And then I want to turn your attention. What are your expectations about tomorrow's government jobs report? Because we've been getting some mixed data, right? The ADP number was terrible. And then we got better than expected unemployment claims today. So it's a tale of two cities at the moment. How do you square those two things? And then does the number tomorrow actually matter? Because the Fed is so focused on lowering inflation, is a real number that we need to look at next week when CPI comes in.
I mean, I couldn't have said it better myself. Don't have a lot or high conviction on the employment number tomorrow because, like you said, we've had conflicting data points out there. But like you said, I think the most important thing that the Fed is looking at right now, and we are as well as investors, are those inflation prints. We need to start seeing those coming down. Our sort of thesis right now is that the market is sort of peak hawkishness. We need to see confirmation from those numbers, right? We need to see the second derivative of these numbers start to shift down.
And then markets now pricing in 5 rate hikes to come this year. Some are even pricing in a couple more. Where do you stand on that? And do you think that the number is too aggressive?
We think it's sort of at its peak aggressiveness right now. Ultimately, we don't think it makes much of a difference whether the Fed raises rates 4 times or 5 times or 6 times. We're talking about 25 to 50 basis points. That's not what's going to kill the economy. What we need to see is what the terminal Fed funds rate is going to be. And as long as the central bank's policy rate is below the long-term neutral rate, that won't be enough to undercut the expansion.
And then let's talk about where investors should be looking at to preserve their portfolio, look for, minimal growth at this point. I don't think anyone is expecting the double-digit growths that we saw last year. And what is your feeling on tech? Is it just a sector that's too volatile right now and you stay completely away from it? Or is there cherry picking that's happening? And if so, which areas are you interested in?
Well, I think you need to stay away from the mega cap tech names. But there certainly are opportunities within the space. But investors overall should be underweighting that space in their portfolios.
So then where should they be looking? Value, cyclicals? What are the areas that you're finding attractive at this point?
Yeah, we still like energy a lot. I know it had a very good performance last year, but we continue to like that, even with some of the risks, the geopolitical risk out there with Russia and Ukraine and other places. So we continue to like that sector. We like the financials. We like sectors that are going to be performing well in a rising rate, a sort of now paradigm shifting rising rate environment.
And then what about commodities? Is that something that you're interested in as well? In a rising rate environment, particularly?
Absolutely. Commodities are a great inflation hedge, and we have them in our portfolios precisely as inflationary hedges.
Okay, we will leave it there. Thank you so much. Ahmed Riazgo, Insignio Chief Investment Officer. Alexis?
All right, coming up, the push to unionize at Starbucks is gaining steam. We'll talk about it with one of the coffee chain's baristas next.
Welcome back. Well, is the Securities and Exchange Commission clamping down on crypto? SEC Commissioner Hester Peirce spoke with Yahoo Finance's Jennifer Schonberger about why she thinks an SEC proposal to expand the definition of a trading exchange could be a backdoor way to regulate cryptocurrency exchanges. Jennifer?
Hey there, Karina. That's right. SEC Commissioner Hester Peirce also telling me in an exclusive interview what it's going to take for the SEC to finally greenlight that physical spot Bitcoin ETF, why she thinks the SEC should be looking at NFTs, and what she sees overall for regulating digital assets. Take a listen.
The securities laws are intended to be flexible and to accommodate changes as they come along. And the Howey test has worked to cover a lot of things that people are doing that look a lot like securities offerings, but maybe aren't labeled securities offerings. And so it serves a function. I mean, there's a reason that the Supreme Court adopted the Howey test, but I think it does make sense to look at the rules and say, hey, are they achieving for crypto what we want them to achieve? And I think that's where it gets a little more difficult, because the token it works in a different way than some of these other assets do, and the information that you might want about that token is a little bit different than you might want about other kinds of assets. So it's a complicated question, but I think we're not solving it by bringing one-off enforcement actions in cases where there's no fraud.
So what disclosures need to accompany digital assets, who they report to, and what those regulatory obligations should be?
Well, I think some of the things that people want to know, I mean, they want to see the code, and they want to be able to, test the code and make sure that it's actually working as it's intended. They want to know who's behind it, right? Who's behind this new project? Who's selling me this token? How many tokens are they going to keep for themselves? When are they going to sell them? How are they going to sell them? What are their plans for developing the network? And are they actually carrying through those plans when they tell us they're going to do that? Those are the kinds of things people want to understand. What's your plan to getting toward a decentralized status? Those are the things people want to know. And I think we could craft some kind of an exemption. I've suggested crafting a safe harbor that would get some of that information to people and make sure that that information is backed up by our anti-fraud rules under the securities laws.
I know you have voiced opposition to creating a new regulatory agency that would oversee crypto, but what are your thoughts or ideas on perhaps a self-regulatory organization that can maybe serve as a conduit that would be overseen by perhaps the SEC and the CFTC to oversee digital assets?
Adding another regulator in Washington does tend to complicate the landscape, but I can understand why some people might prefer a self-regulator in this space, because it allows for more flexibility, and the industry knowledge is infused throughout the self-regulatory organization. There's a benefit to that. I will say that sometimes adding in that self-regulatory layer can add some complexities, and we see that in crypto already, because our self-regulator FINRA plays a role with respect to some of these entities that are some of these broker dealers that are trying to get into crypto. And so FINRA has to communicate with the SEC, and then FINRA has to also communicate with the entity trying to apply. And so there can be some complication in that kind of arrangement. But it is one option, and I'm sure it's something that Congress will think about as a potential option.
Commissioner, you mentioned that you don't really see anything on the docket in the way of new rules or regulations from the SEC this year. But I do want to ask you about stable coins because the Biden administration, while tasking Congress to come up with a brand new framework to regulate stable coins, has also asked regulators to look at using their current authorities to regulate them. Would the SEC consider looking at regulating stable coins akin to money market funds, or perhaps mandating some sort of disclosure and liquidity requirements?
I think it depends on what the stable coin looks like, and they aren't all designed the same way. And so I can imagine that we might look at some of them and say they have securities like features or money market like features, but it really is it's a facts and circumstances analysis, and it's something that has to be done on a through a one-by-one process. I think, again, we need to be looking at what the objectives we're trying to achieve are, and shoving something into an existing regulatory regime may not be the best way to achieve those objectives.
Commissioner Peirce, what's it going to take for the SEC to approve a physical Bitcoin, a spot futures Bitcoin ETF?
Well, so we've painted ourselves into a difficult corner because we keep coming back and denying these spot Bitcoin applications, and we do it based on the fact that we think that there's a problem with the underlying markets, the problem being that they're not regulated the same way that our equity markets are regulated. And that's true for many things underlying exchange traded products that trade in our markets. So we're applying a crypto specific framework here in denying these products. So, my suspicion is that it's going to take seeing the Bitcoin markets regulated just the way our equity markets are regulated before one of these things gets approved. But we'll see. I've expressed dismay now for 4 years that we're applying this crypto specific standard.
And Commissioner, NFTs have absolutely exploded. They are now worth more than $40 billion as a market. Do you see the SEC looking to regulate NFTs or NFT trading?
As with many other things in the crypto space, there are places where they might intersect with the securities laws. And so I would like us to take a look at them and to offer people who are involved with NFTs some sort of guidance about where they might think about potential interactions with the securities laws, whether it's people who are fractionalizing NFTs and selling pieces of them, or other types of financialization of NFTs. It's something that we should be thinking about. And again, not leading with enforcement, but leading with a regulatory hand to help people navigate this very difficult territory.
And you can catch that full interview online at finance.yahoo.com. Guys?
Oh, Jennifer, that was a great interview. Very insightful. Thank you so much.
Thank
Jennifer
you so much.
Schonberger, speaking with SEC Commissioner Hester Peirce. And Alexis, I'll throw it over to you.
All right, thanks, guys. Coming up next, that push to unionize at Starbucks is just gaining momentum. We're joined by the coffee chain's one of their baristas next. A growing number of Starbucks stores are filing for unionization across the U.S., with now over 50 stores petitioning to unionize. Here now is Yahoo Finance's Danny Romero, who's joined by a Starbucks employee. Danny?
Thanks, Alexis. And like you said, we are joined by Kai Fireside, a Starbucks barista in Eugene, Oregon, where there are now 4 stores that have filed for unionization. Thank you so much for joining us.
Thanks for having me.
So Kai, what are the reasons that are fueling your store as well as the 4 other stores that want to unionize?
I think the biggest one is that Starbucks has always called us partners, but we don't have any say in any decision the company makes at all. And we think that unless we are able to unionize, that we will never get any sort of seat at the table.
Yeah, and going off of that, Starbucks has made quite a few changes, right? They've hiked up some of their wages. They say that they plan on doing so again. What is the missing piece? What can Starbucks do better?
Honestly, if they just had a way to listen to us, to ask us about making these decisions. I know they say that they're raising wages, but I'm still making less than the hazard pay that they took away 2 years ago. They really don't consult us regarding COVID safety or any other matters of safety in the stores. So really, we just kind of want to be able to be there and have those conversations with them. And right now, there's just no avenue for us to have those conversations with anyone at the company.
Yeah, and Kai, has your store called on Starbucks CEO Kevin Johnson to sign the fair election principles? What is that, and why is that really important?
We've done that, as has, I believe, every single store that's filed. So each store that's filed has written a letter to Kevin Johnson. Whether he's read them or not, I don't know, because he's never replied to us. But the fair election principles are just a short list of ideas that say, hey, be fair with us. We're asking to unionize. Don't fight us on unionizing. Don't union bust. Don't waste a bunch of time when we're trying to just come to the table with you. Partners in Buffalo that filed in August only just now got to start having their contract talks 2 days ago.
Yeah, what are you most concerned about, knowing what you know, what's going on in Buffalo, and obviously now these 4 other stores, now it's progressed, right, across the country. What are you most worried about in regards to making that signing, if you do end up unionizing? What are you thinking about? What are your concerns in regards to that?
We've tried not to focus too much on individual things that we would want in the contract, just because I think that's going to deter from the ultimate goal of being able to sit down with them. That being said, the 2 issues that I hear the most from people are wages and COVID safety.
And I guess, why are we seeing a younger generation really move toward unionization? I think that's an interesting side of this as well.
It is. I don't know if I'm young enough to comment on that. There are a lot of people at our store that are in their 30s. This isn't a job that's staffed by a bunch of teenagers, although we do have some of those as well. I think that we're really acutely aware of the fight that the labor movement has had over the last 100 years. And we don't want to lose any of the ground that our predecessors gained. And we've seen that with right to work and everything else that's come along since the first big labor movement. We see these incremental losses, and we don't want to see that anymore. We want to get back to a point where workers are stronger, and we have a huge workforce. Our strength is our numbers.
Yeah, and to wrap up really quickly, last year Starbucks opened their first cashierless cafe in New York City. Are you concerned that the company could move more in that direction following the big union push that's going on?
I'm not terribly concerned about that, because the company focuses so much on us making connections with customers. And we do have 1 store in our district that is a similar model. It's mostly online ordering and people come and pick it up. and we haven't seen that that's negatively impacted us at all.
Well, thank you so much, Kai. That was Kai Fireside, a Starbucks barista in Eugene, Oregon, and I'm going to toss it back to Alexis.
All right. Thanks a lot, Danny Romero. We appreciate that conversation. Coming up next, human rights abuses casting a dark shadow over tomorrow's start of the Winter Olympic Games in Beijing. We'll talk with a reporter from HBO's Real Sports next. Well, the U.S. stock market may be in risk-off mode today, but oil is rallying. In fact, WTI crude topping $90 a barrel for the first time since 2014. Jared Blickery here now with a closer look. Maybe $100 crude oil isn't that far away, Jared.
It's literally only $10 away. And as Ramp Capital points out, this is $130 off of, $130 off of those negative 40 lows that we saw in 2020. So you can see we got some acceleration to the upside. Facebook not weighing on WTI crude at all, nor should it. Adjust a little bit instead of cry when looking at those Facebook earnings. And I do want to get a check of the energy sector, and we can see kind of a mixed picture here. We got Royal Dutch Shell, the old Royal Dutch Shell, which is now Shell, that's up 1%. So some of the foreign majors like BP and Total, they're up marginally. But in the U.S., you're seeing a lot of red here, and that just has to do with the risk-off flavor of the market. Also, Occidental Petroleum notably up 2%. But yes, we have crude oil trading at above $90 per barrel, $100 not far away. I do want to show a much longer-term price chart. This is going to be a max. I'll put some candlesticks on it so we can see all the indecision areas. Here's that negative 40 print all the way down there. But for the most part, crude oil really not doing anything since about 2005. It got almost up to $150 a barrel. That was in the great run-up the last time we had serious price inflation, especially in commodities, 2007, 2008, and then it fell off a cliff, hit 30, and those lows would be taken out and then some, not only in 2016, but of course during the pandemic. So crude oil really just back up into the middle of its range. Could easily see 150 if things continue the way they are.
Wow. All right. And that would just add to all the inflationary pressures we've got. Jared Blickery, thanks for that. Well, the 2022 Winter Olympics are ready to start in Beijing on Friday, but not without the cloud of human rights abuses by the Chinese government hanging heavy over those games. Isabel Young is a reporter at HBO Real Sports, and she joins us now. Isabel, thanks so much for being with us. And I know in your work, you've been exploring this troubling relationship, really, between the International Olympic Committee and China's campaign of repression. Just tell us briefly what you have found.
Yeah, I mean, as you said, the Olympics are going ahead. The opening ceremony is tomorrow, and that is despite everything. A lot has been thrown at this Olympics. Obviously there's the situation with COVID, but more disturbingly, there are mass human rights abuses. There are huge crimes against humanity taking place at the moment in the area of Xinjiang in northwestern China, which is where 12 million or so Muslim Uyghurs live. This is an ethnic minority which has had an enormous crackdown over the last few years. 1 to 2 million of them have been rounded up and put inside what they call re-education camps, which are essentially high security prisons. This is the strictest surveillance state in the world right now. Women have been forced to go through sterilization. Children have been separated from their family members. This is an enormous scale of a crackdown. The US and other nations have called this cultural genocide.
China denies all of these allegations, right? So how does it justify all of these camps? And then the IOC promotes tolerance. So how does it justify not doing anything in response to what's going on?
Yeah, I mean, I think that's the question. The IOC says that they are a force for good, but at the same time, they say that it's important for them to maintain political neutrality and that they don't want to get involved in politics and that they are not a governing body. They are a sports organization. But, a lot of activists would say that that's just not good enough. And when you're talking about mass crimes against humanity, it is time to speak up. And there's a huge amount of disappointment from the Uyghur community, as well as from other communities in Hong Kong and Tibet and others who have faced the authoritarian regime of the PRC.
Isabel, what kind of signal do you think this sends the world? The fact that we're allowing the U.S., along with many other countries, allowing these Winter Olympic Games to be hosted by Beijing. Does it tell the world that somehow we're supporting this, that Xi Jinping's government is normal?
Well, I think it depends who you ask. I mean, the US, Australia, the UK, and Canada, other countries are going through a diplomatic boycott of the Games. And so they're not sending any government officials to actually be there and to be representing the countries. However, obviously, yes, these Games are going ahead. I think that this speaks to the fact that China does have incredible economic and political power right now. It is one of the two major superpowers in the world, and it is capable of kind of throwing its weight around. I was living in China back in 2008 when the last Summer Olympics were held there, and there was a huge amount of excitement, and there was also China making promises to improve its human rights track record. No such promises are being made right now, and so I think that speaks to, the level of influence and power that China has globally right now.
And how much of a leg up do you think, and something like this gives China, because it gives them the spotlight? Xi and Putin are meeting tomorrow to strengthen their alliance. And, China has increased its aggression towards Taiwan. Is this another foot forward in them gaining more control over that issue?
I mean, I think that, on an international scale, there's a lot of criticism right now over China. I don't think there's been an Olympic Games quite like this. I mean, there is huge amounts of critiques over their handling of the Uyghurs, over their handling of the tennis star Peng Shuai more recently, as well as what's happened in Hong Kong and Tibet. Having said that, I mean, I think that domestically it's a massive propaganda win for China. I'm sure that the Games are obviously going ahead and that they will be spectacular. And I think it really solidifies China's position on the global stage and makes sure that they are in the spotlight, as you said.
Isabel, here at Yahoo Finance, sort of from our lens, we take a look at the corporate sponsors of this game. I don't know how much you can speak to this, but you've got big names, right? Toyota, Visa, Airbnb, Coca-Cola, Intel, the list goes on. among the sponsors of these games, how important is it for them to speak out against these human rights issues, and perhaps they do that with their wallet and not sponsor these games at all?
Yeah, well, I mean, we haven't seen much of that, given that China is obviously a massive, massive market and has huge potential for a lot of these international brands. So yeah, a lot of these brands have gone there and are not speaking up. In fact, they're staying very silent. And I think that again speaks to China's political and economic influence. More disturbingly, I would say that there are also domestic sponsors who are directly linked to the repression that is happening in Xinjiang. So we've seen brands like Anta Sports, which proudly sources their cotton from Xinjiang. A lot of Xinjiang cotton is banned elsewhere in the world because of the record of forced Uyghur labor that is used to produce this cotton. iFlyTech is another domestic sponsor of the games, which will be making automated translation services for the games. This is a company that has reportedly been involved in the repression of Uyghurs directly by providing the technology to take iris scans of Uyghurs so that the Chinese Communist Party can better track them. So I think that, the economics behind the games is something which keeps the games going, which keeps China very much at the forefront of hosting the games and future events, and also is very effective at keeping brands, keeping individuals, and keeping nations, quite frankly, silent on the abuses.
And Isabel, beneath the glitz and glam of the games is an issue that's close to my heart, because China has systematically been desecrating democracy in Hong Kong, which is my hometown. It's where I'm from. And I feel like the athletes are being held hostage in a way to help cover it up. Should they be in that position, and should they be speaking up more themselves?
Yeah, I mean, I also have roots in Hong Kong, so I feel your pain. I think that it's a very difficult situation for athletes to be in. On the one hand, it is a glorious event, and there's a lot to celebrate about seeing such skills and such unity on display. On the other hand, China has made not such subtle suggestions that athletes are not welcome to speak up about human rights abuses, and that it is going to be very difficult for them. And I think as public figures, it is very difficult. You face losing sponsors, you face losing a foothold in one of the biggest markets in the world. So I think, it's a difficult spot, and it's frankly, a lot of people would say, an unfair spot for athletes to be put in.
Yes, indeed. And the world will be watching. Isabel Young, and it's an important conversation to have. Thank you for bringing your perspective. Again, it's on HBO Real Sports. A lot of great reporting coming out of that show. Thanks so much. Karina?
Okay, and after a quick break, we will be speaking to the CEO of MicroStrategy, explaining why Meta's pivot away from crypto may have dire consequences for the company's future. Stay with us. Welcome back to Yahoo Finance. Well, crypto prices facing fresh pressure today, continuing the bumpy ride for many investors. But Michael Saylor, CEO of analytics powerhouse MicroStrategy, says anyone thinking crypto's golden days are over is doing so at their own peril. Saylor explained to Yahoo Finance earlier why crypto investors are playing the long game. Take a listen.
People buy Bitcoin because they want to buy an asset that they understand that might have value in 100 years. And the truth is there's no security trading on the NASDAQ or the New York Stock Exchange right now that you can understand 100 years from now. We got a long time horizon. And so, yeah, this is near term. There's a lot of risk off volatility, but I don't think that bothers any true Bitcoiner.
And we know that you are a true Bitcoiner, of course, Michael, because we've talked to you about it, of course. You tweet about it. You've put it on the books at your company and on in your personal accounts as well. I would ask, though, when an individual buys Bitcoin and it goes down, it has an effect. When you put it on your balance sheet and it goes down, it costs you, right? It costs you in terms of the accounting for your company because you get penalized when it goes down, but you don't benefit when it goes up until you sell it.
Yeah, well, I mean, yeah, go ahead. Your question?
I mean, what do you think accounting rules need to change on that front?
I mean, indefinite intangible accounting means that you can only mark it down, you can never mark it up. And in truth, I'd be better off from an accounting point of view to buy a stack of comic books or baseball cards, because I would only be evaluating them for impairment once a year, as opposed to every minute on a Saturday night why people are skittish about a risk-off trade. So I think that the gap accounting isn't a positive factor for a company that relies heavily on it. I believe that FASB's taken this up as an issue. We'll see what they say. Clearly, it would be better if there were fair value accounting for a publicly traded company. And if we ever see a transition from indefinite intangible to fair value accounting, that would be a catalyst for more corporate adoption of Bitcoin.
But could it also, in a sense, allow companies who are going to add Bitcoin to their balance sheets to sort of quote unquote cook their books or to make things look better than they are? I mean, I guess you could argue on the flip side, things maybe look worse for MicroStrategy than they are right now because of that other accounting.
I mean, with the current accounting for when Berkshire Hathaway accounts for their ownership of Apple stock, they do it via fair value accounting. So I think that either accounting is appropriate if everybody agrees that's what they're going to do, and then the accountants close the books at the quarter and they account for the assets based upon that guiding set of principles.
Michael, do you see yourself, despite any accounting issues as it pertains to how you account for Bitcoin, do you still see yourself using leverage at some point to go out there and launch more Bitcoin products and perhaps change your strategy at the company?
We have used leverage, and if you could borrow money at 1% interest or 2 or 3% interest, and if you thought that assets were going to appreciate at a dramatically higher rate, then it makes total sense. I think we're in an inflationary environment. The Argentine peso has lost 93% of its value over 4 years. In Lebanon, they've lost 93% of their currency value almost overnight. In environments like that, it's almost criminal not to use leverage. You should borrow in the local currency, and then you should buy a stronger asset. In the United States, I think you can expect a 15% or more monetary inflation rate for the coming few years. So if you could borrow money at substantially less than 15%, then your arbitrage is clear and obvious. So yeah, we think it's a good idea if properly used. It all comes down to the terms and conditions. With all leverage, I mean, I would not recommend anybody go and go long Bitcoin 20-to-1 in a mark-to-market margin loan situation. You're going to get wiped out. But if you have the ability to mortgage your house for 30 years for 2.5% interest, and if you knew that the currency was going to lose 15% of its value a year, then by all means, you ought to buy a house with mortgage. And if you have a house that's unmortgaged, then drawing down a credit line against that real estate in order to invest in a tangible, scarce, desirable asset that's going to appreciate in value at a much higher rate is a rational business decision.
Michael, before we let you go, as someone that has used Bitcoin to diversify their business, look what we're seeing out of Meta this morning here. Challenging quarter. Now, they announced recently they're getting out of the crypto space. Was that a mistake for them? Because if they added Bitcoin into their business and built that out, theoretically, maybe they would be able to just avoid some of these Apple privacy issues and just report better earnings.
Well, to be clear, I think the mistake was not getting into the crypto space. Meta pursued a DM project, and that wasted many, many years of their time. If they were to adopt and embed Bitcoin into their product, they could deliver a compelling offering to billions of people. And I think it'd be worth hundreds of billions, if not trillions of dollars to Meta. So the answer to Meta's problem on the revenue and the P&L side is embed Bitcoin and Lightning into their product line. And the answer to the problem of how do you make cyberspace more secure and improve the quality of your products is to embed Bitcoin and Lightning into your product line. I have 10,000 Instagram bots in my DM, and they're not real people. They attack me. You can't really trust anyone that communicates with you in cyberspace. You can't trust scammers coming at you in WhatsApp. Every day I have dozens of WhatsApp bots attacking me. So if you want to clean up WhatsApp, if you want to clean up Instagram, if you want to make Facebook, and for that matter, YouTube and Twitter safe for children and safe for the world, you ought to wrap those personas in a layer of digital energy, and that would be Bitcoin on Lightning. And, Meta's solution is, Jack Dorsey pointed this out. He said, if Bitcoin had existed when Twitter was founded, they wouldn't be so reliant upon advertising, and you wouldn't have this surveillance capitalism problem. Meta's solution is to go from a pure ad model to a value creation model where they become a bank in cyberspace. There's no reason why they couldn't accumulate $1 to $10 trillion of assets on their cloud platform if they built Bitcoin and Lightning into their product line. So I think that's the solution to the problem. They have not embraced Bitcoin. That's the problem.
Okay, that was the CEO of MicroStrategy, Michael Saylor, talking about the crypto long game. And Alexis, I'll send it over to you.
All right, just getting uglier here on Wall Street. Stocks extending losses this afternoon. We're going to wrap it up for you right after the break. All right, so the selling just picking up momentum here as we are about to enter the final hour of trading on another ugly day for the market. As you can see, steep losses across the board. These three major indexes are right near their worst levels of the day. The Dow is off more than 400 points, and I want to take a closer look at some of the winners and losers there. Let's start with the losers. Honeywell, we know revenue there, missing estimates, guidance wasn't great, and the street is punishing the company for it. Honeywell down more than 7%. Salesforce also sharply lower, along with Merck and Microsoft, giving back some of those recent gains. On the flip side, let's take a look at some of the Dow winners, because believe it or not, even with the Dow down 400 points, there are just a handful of Dow components in the green. That would be United Health, Procter & Gamble, IBM, Coca-Cola, and Walmart, all eking out some gains. If not for them, the Dow would be off even more. But of course, the day revolving around Meta, Facebook's parent company, the stock suffering its biggest one-day loss in history after a pretty dismal earnings report. First time in the company's history it has lost daily users. And the guidance wasn't very strong as well. So a whole bunch of big name tech stocks on the downside as well. Want to quickly show you the bond market because yields there are rallying today. Perhaps no surprise as investors search for some sort of safety. We've got the yield on the 10-year now at 1.82%. That's going to do it for us. I'm Alexis Christoforous along with my co-host Karina Mitchell. Stay with us. Our colleagues are going to take you through the closing bell right after this.
Tech stocks are sliding after Meta Platforms' major miss on key quarterly results and guidance last night. The S&P 500 is on track to end a 4-day winning streak, and the NASDAQ composite is off by more than 3%. But we'll see whether earnings results from other major tech names, from Amazon to Snap, after the close today can help stem these stock declines. Santosh Rao, head of research at Manhattan Venture Partners, will join us later to break down those Amazon results. And it's been about a year since meme stocks soared to the stratosphere as investors on Reddit scooped up these shares in droves. So far in 2022, these meme stocks have been under pressure, but at least one analyst thinks that these names could be due for renewed gains. We'll discuss with Evercore's Julian Emanuel in a bit. Plus, we'll get a check of the state of the restaurant industry with the National Restaurants Association's Senior Vice President of Research on just how long it may take for dining out to return to pre-pandemic levels. As a hint, it's probably not going to be in 2022. We have an hour to go until today's closing bell. I'm Emily McCormick.
And I'm Brad Smith. Great to be here with you, Emily. Let's get right into it as we begin this final hour of trade with a deeper scan of today's trading session. First and foremost, we've got the major averages there for you on screen, down across the board right now and in negative territory. Starting off with the Dow, you're seeing that lower by about 416 points, 1.2%. We'll round that off to 2% lower. You're seeing the S&P 500. That is down by 93 points. And 3% lower, you were seeing the NASDAQ composite. That is down by about 447 points for the tech-heavy average. And so for much more on today's trading session and what's been in play, we bring in Yahoo Finance's Jared Blickery. Jared?
It's been all about Facebook, or mostly about Facebook today, but I want to go through the Dow first. That's down 400 points or so. NASDAQ composite is where we are seeing the steepest losses, and we just took another small leg down, and we're just hovering near session lows right now. S&P 500 down 2%, and I've been showing this chart for several days here, saying that we entered a potential sell zone, and guess what? Right before we were able to break that critical level, 4,600, we have now sold off. So the potential remains that we simply return, test these lows, or worse, we go even lower. Have to see if that comes to pass here. VIX also perking up a little bit. You can see two green candles here, so could be putting in a temporary bottom there, or maybe we're just going to chop around some more. Difficult to tell right now. 5-year yield, the bond market, that's up 0.6%, and the 10-year is up 0.6% too. But value trade is not really working out today. Here's the sector action. Only staples in the green and losing steam, followed by utilities and healthcare, real estate, very defensive setup there. Communication services, 6.5% to the downside, worst daily performance since the depths of the pandemic sell-off in March of 2020. And then you take a look at this screen. This is a disaster in the mega caps. Even Tesla has turned negative. It was green most of the day. Facebook down 26%, hundreds of billions of dollars wiped off of its market cap. Amazon down because of the news in sympathy with respect to Apple. That's down 8%. Microsoft off 3%, and it really doesn't get much better when you look at some of the other social media names. We're seeing, and let me do this on an equal weight basis, we're seeing Snap down 23%, and they're going to be releasing results after the close. We're going to bring that to you. Pinterest down 10%, Twitter down 5%, Yelp down 4%. The carnage really just beginning to be felt here in terms of the Facebook miss.
Yahoo Finance's Jared Blickery. Thank you so much for that breakdown. Let's stick with the topics of the markets with our next guest. Chris Pollard is Managing Director and Head of Market Strategy at Cowen. Chris, thank you so much for joining us this afternoon. What do you think is really behind this renewed selling that we're seeing? Is this all because of those disappointing results and guidance from Meta Platforms, or is there something else at play here?
Sure. Well, thanks for having me. Good afternoon. I think that, the earnings misses, obviously the headlines earnings misses, and the capitalization impact that the specific names today are having on the markets is driving a lot of the weakness. But if we take a step back and we think about why markets have been weak, going on not just for this year, but really into the latter part of 2021, it's been the hawkish policy pivot. And that's not just in the US, but increasingly a global one. We saw Bank of England raise rates today. The pricing of the potential for an ECB rate hike is elevated. So the idea of a tightening of the monetary spigot is increasing. And certainly the idea that that is going to occur is going to lead to pressures on multiples. It's also going to move people a little bit inward on the risk curve as opposed to at more extremes of some of the less profitable companies in the market, a dynamic that we've seen really year to date. And so when you put it all together, it's really hawkishness first that's driving this weakness, but certainly some of the fundamental hiccups that we've seen are adding to that.
And so with all of this in mind, with the investors that seemed like they were going long, re-entering on the 28th, the 31st of January, and what we had seen in that concerted move higher, if they have already picked their entry points at this point in time, do you expect that there's going to be any further buying activity to provide a backstop or a type of buoy?
So that's a great question. The move that we saw at the end of the month was really a reflexive response to how deeply oversold some of the technical factors in the market had become. The intensity of the downside move was truly historic in terms of how bad the year started. And when you look at some oscillator momentum measures, if you look at downside extension from, say, moving averages, the technical dynamics had become really extreme to the point where reflexivity should have been expected and indeed was realized. To the extent that there were inflows there, some of that was probably oriented around month-end dynamics and some recalibration in portfolios as a result of the drawdowns that we experienced over January. But from here, as we move through that phase, and as Jared was mentioning before I came on, the overhead resistance is really asserting itself here. And it's important to remember that, particularly with the NASDAQ and with the Russell specifically, the breakdowns that we saw in the second half of January have now stranded a tremendous amount of trading underwater. So the classic technical idea or concept of support becomes resistance is really coming into play. And that's where we hit our head earlier this week. So from here, we would expect weakness is going to persist. The idea of taking out those January lows is not an unrealistic one to hold. But we're going to have to see it's path dependent. I think in the very, very near term, downside is certainly the direction we would be focused on.
And in terms, Chris, of catalysts that we should be looking for, even as soon as tomorrow, when we get that new January jobs report out, do you think we're in that zone where bad news is good news in terms of how we might expect to see markets react to a potential downside surprise in the jobs report and what that actually might mean for monetary policy?
Sure. Yeah, you're right to point out the data backdrop is incredibly important, particularly in the first half of February here. The Fed has told us that their data dependence is really going to be what drives the realization of policy path here, specifically with the non-farm report this week. I think it's been pretty well teed up that there is likely going to be weakness. That weakness is going to be driven predominantly by the ongoing health considerations from Omicron. And the ability for people to look past that, I think, is going to be pretty elevated. So in my mind, in a very, very tactical sense, there's a bit of asymmetry around this release insofar as folks are expecting weakness, expecting a disappointment there. And if you do actually get a better release, something that shouldn't be completely ruled out given the internal strength we've seen in the labor market going on 6 months now, that could actually set up an additional hawkish result. But if we think about what the reaction function is from the central bank community and certainly from the Federal Reserve, it's pivoted fully towards the price side of the Fed's dual mandate. Next week, we're going to get CPI and PPI data. It is almost assured that those readings will be historically hot, particularly on a headline basis when we factor in the movements we've seen in commodities. But even on a core basis, the pressures that we're seeing and realizing at the start of this year are pretty elevated. In the press conference in January, following that FOMC meeting, Powell discussed the concept of him revising higher his full year outlook for inflation in 2022. And that sensitivity is going to be hard to remove from the committee, at least over the first half of this year, just given some of the base effect dynamics coupled with some of the supply demand dynamics that we're seeing in the commodity complex. And it's going to make it pretty challenging to see a pricing out of the hawkish policy path that markets are focused on at this point. So data is going to remain a headwind. You're right to bring up the concept of bad news equals good news, but I don't think that that's going to be a reality for markets, certainly not in the first quarter, but likely in the first half of this year.
All right, well, we'll see how things shape up when we get that jobs report and that CPI data out next week. Chris Pollard is Cowen Managing Director and Head of Market Strategy, and we thank you so much for your time this afternoon. A new subvariant of Omicron is spreading throughout some parts of the world. We'll discuss what this may mean for the pandemic moving forward on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. We've been keeping close tabs on the latest variant of a variant, if you will, of the COVID-19 pandemic, and that is the Omicron variant, subvariant, and how that's gaining even more international attention. For more on this and to break this down further, let's bring in Yahoo Finance's own Anjali Kamlani joining us now. Anjali, what should we need to know about this?
Well, what we do know is that it is increasingly transmissible. So let's break down what this is. This is the subvariant BA2, which is sort of a sibling to Omicron. And we've, of course, seen how Omicron has spread like wildfire throughout the world, becoming almost 100% of cases here in the US. We're now expecting to see that same concern arise in some other countries. Right now, it's already a concern. Right now in Denmark, we know that it's a majority of cases. We know in South Africa, there's growing concern. While it remains something that health experts are keeping an eye on when it comes to the US, there is no doubt that it is more transmissible than Omicron as well. And so what we're looking at is just waiting to see, how it spreads, whether or not the current surge is extended as a result of that. And that had been the fear as soon as it was first identified. We know that right now in the US, we're still seeing deaths continue to rise from that initial surge of Omicron. So just to point out, of course, we know the statistics do point to largely unvaccinated or immunocompromised or vulnerable individuals that are dying, even though we do currently have, vaccines available. So there's still some concern there among health experts about what an additional variant and the impact of that could be here in the US. Back to you.
Thanks so much, Anjali Kamlani. And to go further on this, let's bring in Dr. Asha Shah, Director of Infectious Diseases at Stanford Health. Doctor, thanks for taking the time here with us today. Based on what we know to this point about the transmissibility, and the severity of symptoms of the subvariant of the Omicron variant exhibits, the amount of time that lapses between the identification and the spread that's perhaps already taken place, what do we know about that particular window, and how are we narrowing that?
Well, I think that BA2 has actually been around for quite some time. It is BA1 and BA2 came from the same ancestor strain of Omicron. So calling them siblings is really accurate. And that's how I explain it to people. So we know that BA2 is circulating in the United States along with BA1. It's called the stealth variant because it doesn't have that S gene target failure that some laboratories use to detect Omicron BA1. But the fact that it's more transmissible and perhaps not as severe could potentially be a good thing in terms of getting more towards population immunity from COVID in general.
Doctor, this is Emily here. Thank you so much for your time. What is our best course of action for addressing future variants that are likely going to be emerging for COVID-19? Is it going to be variant-specific vaccines, since we know Pfizer and Moderna are working on those Omicron-specific vaccines, or what other courses of action can we take?
I think that the vaccines are our most important tool. And I think the fact that that technology exists and that these companies are working on new formulations is a smart way to move forward. And I do think we're going to get to a point where perhaps we get a COVID booster at a regular interval that perhaps contains the most predominant variants from the last COVID season, similar to what we do for influenza. So I do think the best way for our country to respond to this is to really encourage everyone to get up to date on their vaccinations. There's still a lot of people that have not received a single dose of a COVID vaccine, and that's a problem. And that's what we saw, what was overriding the hospitals through this last Omicron surge. We have to get everyone vaccinated with this very effective tool. That's the way we move forward.
I think you mentioned something very key a moment ago as well with regard to the correlation between the spread, yet less severity there, and then additionally, the efforts that we have seen on the vaccination and other precautions front that we have taken, and primarily through vaccines providing that herd immunity and having less severity or less severe reactions when you do have a more transmissible variant. How should we be thinking about the new variants as a population when they do emerge, even if we do have a less severe yet higher transmissible rate?
The hope is that as these variants emerge, that if they do become less and less severe, COVID-19 may soon become like a common cold. as we continue to increase vaccine uptake in the community, as more folks get infected with various strains of COVID-19, both of those things combined contribute to the immunity in the population as a whole. And that will kind of help contribute to the shift from pandemic to endemic, and not thinking about COVID first thing when you're making social plans or making travel plans, that this becomes like many of the other coronaviruses that circulate in the community. That will likely take some time, but this may be, a shift in that direction.
You mentioned travel, and on that front, earlier this week, the lobbying group Airlines for America and a number of other travel associations asked the Biden administration to drop COVID testing requirements for vaccinated passengers for flights into the U.S. Now, clearly, these companies have an interest in removing hurdles to international travel, but is now the time to be lifting testing requirements for cross-border travel, even for the vaccinated?
So it depends on that definition of fully vaccinated. I think that would make sense if those travelers were up to date with their vaccinations, meaning that they've received a booster, because we've seen how effective that booster is in further protecting individuals from severe disease, hospitalization, and death, and in fact, even from getting infected. What the definition of a vaccination or full vaccination is remains, to be seen. But I do think it's reasonable to ultimately relax some of those testing requirements if individuals are up to date.
Dr. Asha Shah, Director of Infectious Diseases at Stanford Health. Doctor, we appreciate the time here with us this afternoon, and thanks for helping us break this down further. And everyone, before we go to break, we want to take a quick look at the major averages. As of right now, we're seeing the Dow down just a little bit more than 1%. Meanwhile, the S&P 500, you're seeing that in the red by about 2%. We'll round that off to generally 88, 89 points to the downside there. And the NASDAQ composite, you're seeing that down 3%. Right now, 428 points in decline. We're going to keep close tabs on the major averages, given that the last 30 minutes of trading typically sees the most volume in addition to the first 45-ish minutes of trade. Also, coming up on the other side of this short break, Warner Music Group charts its NFT strategy, bringing exclusive offerings from artists and musicians even more direct to their fan bases. We've got that up next.
Welcome back. Artists at Warner Music Group now have another way of engaging with their fans and communities through Web3. The NFT platform Block Party has announced WMG as its first major label partnership, giving artists the ability to swap, trade, and sell their own NFTs. Juana Ruxandra, WMG Chief Digital Officer and Executive Vice President of Business Development, and Vladislav Ginsburg, Block Party CEO, join us now for more. Vladislav, I'll start with you on this one. How did this partnership come about, and why WMG for your first major label to work with?
First of all, thank you so much for having us and an opportunity to talk about this exciting partnership. The partnership came about, it's almost a year in the making. I think that Warner Music Group has always been at the forefront of innovation and technology for their artists. And so they reached out to us to learn about Web3 and learn about what we're doing in Web3. And I think that some of Block Party's initiatives resonated for Warner artists, specifically the ability to mint to multiple blockchains, some carbon neutral blockchains like Flow, as well as really the flexibility to express their creativity in whichever way they want to.
Oana, when we think about the artists that are going to be able to take advantage of this, talk about that relationship between WMG and the artist and who's going to initiate that conversation. Is it the artist coming to you and the team to say, hey, we'd really like to tap into the NFT landscape, or is it you creating the strategy and presenting it to the artist?
So it's a little bit of both, right? The space is so nuanced and it is emerging. It requires resources and time and effort. And the creation of real authentic storytelling through NFTs, through token projects. And so we're spending a lot of time with our artists, with Block Party, and with other experts in the space to really fundamentally understand what works and what doesn't, what we should be building, what we should be working on. And then we build with our artists. And so it's really a collaborative process. I'll say that the community is also a big piece of it, right? Understanding what our fans want, understanding what they're communicating as well. We're all over our Twitters, Discords, et cetera, to really get the sense of what the community is looking for from the artists and from engagement.
And Oana, I want to follow up on that and ask, what kinds of projects, and I do realize this is early days, but what kinds of projects and NFTs are you seeing are really resonating with artists, fans, and communities? And are you finding that NFTs are coming naturally to many of your artists, or is this an ongoing educational process?
Yeah, it's definitely an ongoing educational process at this point. Some artists are really dug in. Some are trying to understand the pieces of the puzzle. I will say that it's variable what's working and what's not working. This world of Web3 and everything crypto and metaverse and NFTs and tokens is new. It's nascent. It's growing. It's something that we're building in and partnering in with amazing companies like Block Party. What we've seen resonate is the things that feel authentic. So if an artist is tapping into a platform where their audience actually isn't, if they're tapping into a space or dropping exploitative NFTs, things like that just don't feel right, don't feel relevant, then that's something that the community rejects. But the things that have done really well are the things that the community understands and the community feels like they're a part of and that they see real value in. They see real value in that connection and understanding how that connection will work with artists for the future.
Vladislav, walk us through the pricing strategy here. Everything from the sweet spot that artists may be looking to strike with their fan base on different offerings that they may bring to the platform, but then additionally for Block Party yourself, how the company is seeing its own profit model move forward as a result of partnerships like this.
Absolutely, it's a great question. When we enter into an artist's economy, we have to understand what their fans are about, what the culture is about with their fans, and the price points that are going to make their fans comfortable. So when we've worked with different Warner artists and coached them through what Web3 looks like for them, we're going to see how far-reaching some of these initiatives are. Naturally, if we're doing something that is going to feel more like a concert poster 2.0 with a really broad distribution, we want to price it that way. We want to make sure that the average consumer is able to afford it. And we want to make sure it's accessible as humanly possible. We have other artists that are really willing to engage with their communities by offering exclusive experiences or really limited edition merchandise, really limited edition drops, As you can imagine, there are quite a number of Warner artists that have deep parallels into fashion and deep overlaps into other sort of verticals that we are also tapping into with NFTs. So in those cases where something is a little bit more exclusive, we might go the auction route and enable users to bid as high as they want to, or as far as the market demands. For Block Party's profit structure, we really think about this as a platform where all creators can come create, but it's really professionals and amazing artists like Warner's that come on and really drive the majority of our profits. So it ends up being a little bit like the 80-20 rule, where the Warner artists that we have will really generate a great majority of our profits, because the audiences and communities that they attract are just so broad.
Vladislav, a quick follow-up to that. The musician John Legend just announced yesterday, I believe, that he was launching his own NFT platform for artists called Our Song. How are you thinking about these potential other channels that artists could be embarking on, and why should artists be using Block Party for their NFTs rather than starting their own platforms?
Absolutely. I think that we always welcome folks like John Legend that are masters of their worlds and to build. But the question that we've been asking ourselves, and Block Party has been minting NFTs for 5 years. We're incumbents in the space, and I think Warner Music recognizes that we have the experience. So we, 5 years into our life cycle, are asking ourselves, what is the role of the platform in a market that values musicians selling directly to their fans? What's the role of the record label? What's the role of Warner? And we have a great answer to that. We're helping to educate these artists. We're helping to educate their communities and allowing them to leverage great tools to impact their communities. Starting a marketplace from scratch, I mean, you're looking at years of iterating and building and getting it right. So we welcome as many new entrants to the space as possible, because it grows just how many platforms can service the world. But for those of us that have been around for a while, we offer the experience and the know-how to grow into the space. So Alana mentioned that there are exploitive NFTs out there. There are problematic NFTs out there. And we are really focused on artist-driven storytelling.
All right, we'll leave it there for now. Vladislav Ginsburg is CEO of Block Party, and Oana Ruxandra is WMG Chief Digital Officer and Executive Vice President of Business Development. Thank you both again so much for joining us this afternoon. U.S. crude oil prices topped $90 a barrel this afternoon for the first time since 2014. But our next guest thinks this oil run-up may be getting ahead of itself. We'll talk about it on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. We're taking a quick check of the markets as we see the major averages still in negative territory here on your screen. We've got the Dow, the S&P 500, and the NASDAQ there for you in sight, and the Dow still down and moving lower from when we last checked in on it. Right now, it's down by about 1.15% to be exact. The S&P 500, you're seeing that down 93 points, 2% in the red, and then also in negative territory, deep in declines by about 3.2%. We'll round that off to is the NASDAQ, the tech-heavy composite, down 457 points here on the day. Well, switching gears, everyone, let's get to our 2 and 2. Emily and I each have 2 tickers to put on your radar before the market close, and I'll lead us in today. Emily, I've got 2 stocks that I'm keeping my eyes on. First up, got to talk about PINS, Pinterest. And of course, we're just teeing the earnings up here, and that story particularly that we're going to be tracking here. And so investors, they're also having to continue to wade through what the iOS risks may mean for Pinterest after Meta Platforms signaled in their earnings that they anticipate modestly increasing ad targeting and measurement headwinds from platform and regulatory changes. Now, Pinterest also, on the other end, is a platform that historically has been vulnerable to engagement headwinds as the pandemic continues to unwind in the US. This is something that they've said before in previous earnings reports. So stick around and watch for that to see exactly how that may have been in play. It was certainly in play, as we heard from companies, some of the companies that have already reported that are looking at the retail and the consumer strength. And over the course of the final months of 2021, we're citing some of the headwinds that they saw as a result of the Omicron variant. And so that potentially one of the weights on Pinterest here on the day, 2 of the major weights, I should say, on Pinterest today, ticker symbol PINS. It is down bad as of right now, and we'll see exactly where that moves once they report their earnings. And then I got to talk about Square here, or the SQ ticker symbol, I should say. But of course, this is the company now known as Block, and this is lower on the day. It's actually got some unusually high volume. It's about double, actually a little more than double at this point in time, the average volume that they would see, usually about 11.5 million shares traded of Square or Block SQ shares on a daily basis. But today, 24.3 mil. And so with all of this in mind, this week, they did finalize the acquisition of that buy now, pay later acquisition that they made, $29 billion for Afterpay. And so we'll see exactly where this continues to move them forward in their offerings for their customers, and perhaps some overlap from the sentiment that we saw from PYPL, PayPal, after they reported earnings too. So those 2 names that I'm tracking going into the close, Emily.
Brad, I'm sticking with the tech theme, and after today's Meta Platforms meltdown, another big tech company is on tap to report earnings results in just a little bit, and that's Amazon. Now, this stock is down this afternoon, but let's take a look at what Wall Street is expecting from these results due out after market close in just about 25 minutes. Now, this is the point in the recovery where year-over-year comps are getting a little bit trickier for Amazon, given that e-commerce had still been the preferred purchasing method for many people during the pandemic in the comparable year-ago quarter. Now, because of that, we are expected to see a slowdown in sales growth rates, and Q4 revenue likely grew 10% to reach $137.8 billion for Amazon. Now, that would be the first time ever that Amazon sales topped $130 billion in a single quarter. But again, that rate of growth would be a major step down from the 44% increase posted in the same holiday quarter in 2020. Now, also do keep an eye on AWS, or Amazon Web Services, in this afternoon's report. It's currently the cloud market leader, but recall that Microsoft Azure is also gaining ground, and Microsoft last week delivered a strong outlook for Azure for the current quarter. Now, all told, Amazon shares still feeling the pressure today after those Meta Platforms earnings yesterday. That stock down by about 7.5% this afternoon and down by about 16% so far for the year to date. Then shifting gears, there are also shares of Honeywell that I'm watching. Now, we've been talking a lot about inflation hitting companies' earnings results. Honeywell is no exception here. Now, the company offered a weaker than expected full year outlook on sales and earnings due to rising input prices and supply chain disruptions. On the high end, Honeywell expects earnings to come in at as much as $8.70 a share on revenue of as much as $36.4 billion. Both of those metrics were short, again, even on the high end compared to Wall Street's estimates. Now, Honeywell Chief Financial Officer Greg Lewis said during this morning's earnings call, quote, "We expect supply chain impacts to remain as challenging in the first half of the year as they were in the third and fourth quarters." But he did add that they'll likely start to ease in the second half of the year, so something to watch out for as we move through 2022. Brad?
All right, we're going to keep close tabs on these 4 tickers going into the close here. And switching gears, we've got to talk about the oil rally on the day. This afternoon, West Texas crude oil, it settled above $90 a barrel for the first time since October of 2014. Meanwhile, Brent crude, that's up 13% year to date, more than 60% over the past 52 weeks. Showing this continued move higher as OPEC signals its intention to maintain its policy of moderate output. So for more on this, let's bring in Paul Ciana, who's the Bank of America Chief Global FICC Technical Strategist. Paul, help us break this down first and foremost. With the rally that we have been seeing, is there any sight of cooling down?
Thanks for having me. It would be a pleasure to discuss oil. Look, I think the biggest pictures here in the secular trend for oil is undoubtedly bullish in the technical charts. But when you boil down sort of, the biggest picture to the medium and the short term, to answer your question specifically, yes, there are some short-term concerns here for the oil rally. Number one, oil prices have trended to the top end of their upward sloping channel, which in February is about $90 to $92.5 a barrel. So we're starting to see some resistance in the chart that oil prices might not be able to push much higher from here right now. Number two, momentum is getting overbought in those short-term charts. So oftentimes that can lead to a pivot. And if you look at the trading sessions over the last week or so, there have been a number of higher tails, meaning the sessions trade higher during the day, but ultimately close kind of down at the middle or the low end of the range. Now, today is a little bit of an exception to that because we did have a nice big up close this afternoon, but we're still just barely approaching the top of that channel, which may be the resistance point for an overbought dip.
Paul, this is Emily here. Thanks for joining us. How much of a threat are oil prices at current levels to economic activity? Is this something that could potentially slow down growth here in the U.S. because of this inflation that we're seeing in energy prices?
I think it is getting there, but it's not necessarily at a level for long enough that, ruins consumer spending, for example. I think everybody's been home saving some of their gas money for a year or two, ready to get out on the road and actually spend money at the pump to go do things and live their life. And that's where the second half of the, oil rally might actually come from, is the fact that people need to get out and they want to get out.
And so let's think about some of the other commodities that people might look to at this time, even outside of oil. Where should we be focusing our attention on for where there might be another leg up?
That's a great question. And, we touched briefly in a question on inflation. Well, inflation is typically good for all commodities, all real assets. And the way that the charts read, while they're being bullish oil, they're actually bullish commodities in general. The overall commodity indices we review on a technical basis do look like they are trending higher. So the next two big candidates within that would be something in base metals like copper prices and in precious metals like gold. And both of these charts have been trending sideways into a tighter and tighter range, often called a triangle pattern on the technical charts. And those types of patterns usually precede a spring-like move in price action, which would mean copper prices and gold should be accumulated while they are trendless and kind of, converging inside this pattern, ideally for a breakout higher this year.
How much are you seeing geopolitical risks like Russia-Ukraine tensions playing into the oil price action that we're seeing right now? And when do you expect those to dissipate?
Yeah, there's a lot of factors driving oil: the geopolitical risks in Russia and Ukraine, the negotiations and discussions with Iran. We can even probably add Venezuela and some of the South American countries to that. Geopolitical risks are high, but they're high for both, adding supply as well as taking away supply. So there can, over time, be some balance between different forces. The headlines this morning from the U.S. administration stepping back a little bit from the imminent threats of Russia and Ukraine as far as their description of the situation is actually something that may alleviate oil prices for the short term because maybe there is not a risk of confrontation. But there's many other factors here. It's been ice cold in the north for longer than it seems and deeper than it seems as far as temperatures go. Economies, like we said, are reopening. Inflation, as we noted, is high. So there are a number of factors But when you look at momentum and sentiment, they just look really stretched right now. So do you want to buy oil when it's trading at $90, $92 a barrel, when you can maybe get some copper and gold for a better price before they break out? I think the trade might be leaning that way.
How long are these prices sustainable for industries that rely on larger purchases to operate, everything from airlines all the way to some of the kind of larger travel elements that are out there that are trying to buy their barrels, if you will, in broader bulk?
Sure. So, the secular technical call is that oil prices peaked in 2008 and they bottomed in 2020. So that's a 12-year decline in oil prices. So how long could oil prices theoretically go up if the world was perfectly symmetrical? For 12 years, we could be having a series of higher highs and higher lows that takes oil prices to new all-time highs. Now, within that construct, could there be a 30% decline, 40% decline? Sure, there could be. But ultimately, with that tide pointing higher, I think higher energy prices and probably higher commodity prices may be a multi-year scenario that markets, corporations, everybody has to deal with.
Paul, we appreciate the time and insights. That's Paul Ciana, who is the B of A Global Chief FICC Technical Strategist, joining us to break down oil here. And coming up on the other side of this short break, the meme stock rally. Is that coming back? Don't call it a comeback. Well, maybe you can call this one a comeback. We're going to dive into where the fundamentals lie and where traders may be still having some fun at the end of the day with the meme stocks. We'll see.
Welcome back. Let's get a quick check of the market action with about 15 minutes to go until the closing bell. And we're seeing a lot of red across the screen. The selling action accelerating here to the downside across the three major stock indexes. The Dow Jones Industrial Average down now more than 450 points, or about 1.3%. The NASDAQ Composite, definitely the laggard during today's session, off about 3.5%. Those big tech and growth stocks coming under considerable pressure. And the S&P 500 down about 2.3%. Now, taking a little bit of a deeper dive here on the sector basis in the S&P 500, we have the tech-heavy communication services, consumer discretionary, and information technology sectors moving sharply to the downside. All 11 major sectors are still in the red this afternoon as well. But shifting gears here, it's been about a year since meme stocks soared to new highs, but these darlings of the Reddit-fueled trade last year have endured a tough couple of months. Our next guest is looking for a potential rebound. Julian Emanuel is Evercore ISI Senior Managing Director of Equity, Derivatives, and Quantitative Strategy. Julian, thank you so much for joining us, and walk us through this thesis that you have. So first, what stocks specifically in this so-called meme trade are you seeing as ripe for a recovery?
Well, there are really a number of them, and the way we think about it is if you crested at that peak of emotion in January and February, and you were down 50, 60, 70% or more into what is really what we think a bottoming phase in here, particularly if you had the same thing that carried the meme stocks to their highs a year ago, onerous short interest. Those are the kinds of names across a variety, synthetic meats, theaters, all manner of things like that, exercise equipment, et cetera. All of those names really do look as if not only have they been sort of left forgone, but that in fact, the short side of the ledger is really pressing these bets. And from where we stand, basically, it's not likely warranted simply because positioning is so extreme on the one hand, and on the other hand, the credit markets, even though we have this kind of volatility we're seeing in the broad market, are still relatively sanguine, despite sort of the way January has gotten off to start.
All of these names are very different. We were just taking a look at a few of the prominent meme stocks on the screen there a moment ago, and Robinhood, the only one in positive territory today. We should also note that off of their most recent earnings report, they had seen some new all-time lows. And so with all of that in play, one company, very different, AMC, they secured $950 million, and that was as part of a bid and attempt to pay down debt. And so all of this considered, where have you seen some of the meme stocks try to reattach themselves to fundamentals, and are the traditional or the Reddit retail trader community, are they latching on to that move back towards fundamentals and praising that?
Well, to be perfectly frank, the market itself is going to dictate that traders and investors reassert the primacy of fundamentals. That's what a rising interest rate environment dictates. That's what higher volatility dictates. And frankly, Fed policy that is likely to become, markedly less accommodative in the weeks and months to come. All of that means that you need to do your homework about what fundamentals look like. And the case in point that you made of the company that was able to secure financing to the extent that the credit markets remain open and there is substantial business viability, that really argues for a potential bounce in these types of stocks.
So against that backdrop and all these factors, including Fed policy that you mentioned, how sustainable would a rebound actually be for some of these names? Would it be something that could be sustained, or would it just be a brief jump off of the bottom?
I would say that a lot of it has to do with what the outlook is for the economic reopening. Our fundamental thesis is that the virus is likely to become endemic by mid-year, and if that's correct, some of these names that have had their fluctuations in and around the last year, in and around the sort of the movements and the psychology surrounding the virus, may have a lot more staying power than their share prices currently reflect.
All right, we'll leave it there. Julian Emanuel is Evercore ISI Senior Managing Director of Equity, Derivatives, and Quantitative Strategy. And thank you again so much for your time. Coming up, we're counting down to the closing bell and earnings results from Amazon. Stick with us.
Welcome back, everyone. Taking another look at the major averages with inside of 7 minutes left in today's trading activity. You've got the Dow Jones Industrial Average down by 500 points, 540-ish points to be exact there, 1.5% lower. S&P 500 down 2.5%. Triple-digit move lower for the S&P 500, my goodness, and the NASDAQ Composite. That's down more than 500 points, 3.7%. For much more on this, let's go to Jared Blickery, who's standing by with the breakdown. Jared, as we are accelerating some of these losses into the close, what do we need to go and know, before that closing cross?
Well, at least there's Amazon after the bell. They're going to have to blow it out of the water here, but there's no saving the Facebook carnage that has already occurred. NASDAQ 100 down 4%. That's really heavy into the mega caps here, and we haven't seen a drop like this in quite some time. You'd have to go back to about September of 2020. Here's the S&P 500. I've been showing this chart for a while, selling off from critical resistance. Not the best move for the S&P, but I want to get to some heat maps before we get to the bell. And here's the sector action. Staples had been in the green most of the day, not anymore. Consumer communication services is down over 6%, almost 7%. That's what houses Facebook as well as Alphabet. But consumer discretionary is going to be in focus as well after the bell. That's where we have Amazon. That sector down 3%, and that's followed by tech. All three of these house the mega caps, and they are all seriously moving to the downside. Here's our NASDAQ 100 heat map. I haven't talked about T-Mobile today. It is a bright spot. Let me show you a two-day chart because they had an outlook beat that investors seem to like. That's up 10%, but really nothing else on the screen even approaching that. We're seeing a lot of weakness in the semiconductor space. We're also seeing it in the software space. We're seeing it in Chinese stocks. We're also seeing it in ARC innovation stocks. So the list goes on here. These are one-day losses. Look at Spotify down 16%, Twitter down 5%, and those even aren't even all of the worst performers. Let's take a look at Bitcoin. Haven't taken a look at Bitcoin in some time today. Bitcoin off about 3% over the trailing 24 hours. Let's get a price for you. 36,400 and change at the bottom of that range here, guys.
Jared, amazing breakdown there, and we're going to be keeping a close tab on this going into the market close as well. We're going to be right back on the other side of this short break, but some significant declines that we're continuing to track and deep in the red for the major averages as we get closer to the end of the trading session. Just seconds away from the closing bell, everyone. We're just about 120 seconds out from that moment. And taking a brief look at the major averages in the bottom corner of your screen, you're seeing them in negative territory. Brad Smith here with Emily McCormick, as well as our panelists for the market close. And first and foremost, want to bring them in and just introduce them very briefly here. We have got on our panel for today, we have with us Julie, and excuse me, I am missing, okay, Julie Beal, here we go. Kane Anderson Rudnick, Portfolio Manager and Senior Research Analyst, and Tim Pagliara, CapWealth Chief Investment Officer. Excuse me for forgetting your titles for a moment there, but let's just dive right in for a brief second. Julie, I want to get your take on the acceleration of the losses that we've seen going into the close very briefly.
I think people are concerned that these tech earnings are not going to be as robust. And, we're seeing the impacts already across the spectrum. You have Google reporting great results, Facebook problematic results, PayPal difficult results. These are tried and true names that people were seeking out as a safe spot after investing heavily in narrative stocks. And I think now they're realizing maybe there's not safety here. And I think that makes sense. I think for us, we're long-term holders. And so we want to keep focusing on businesses that can do well over an entire business cycle. And that's where we're focused.
All right, we are going to be coming back to our panel in a hot second here, so stay tuned. We want to take a quick look at the major averages. Bottom corner of your screen, you're seeing the losses accelerate here on the day and pulling off of some of those levels, but the NASDAQ down 3.8%. We're going to go to the closing bell live right now.
And that is the closing bell this Thursday, February 3rd. Taking a look at where the major stock indexes are going to settle out today, definitely a negative day on Wall Street. The S&P 500 down nearly 2.5% on the day. The Dow Jones Industrial Average off more than 500 points, or about 1.5%. The NASDAQ Composite down about 3.7%, with those technology and growth stocks coming under considerable pressure yet again during today's session. Well, let's turn back to our market panel for more now. And Tim, given today's market reaction, is this an overreaction, or does this renewed move to the downside, especially in those tech names, make sense to you given where we're at right now?
I think it's all the tech names. In fact, if you take 7 different companies, wrote them down: Bank of America, AT&T, IBM, Coke, GE, WestRock, and Hershey's, they're either up or they're just down fractionally. So it's a very isolated part of the market that is disappointed in a big way. A lot of investors.
Tim, just to follow up on that, though, this is, an isolated part of the market that has larger implications in terms of the different areas and segments and industries that they all overlap in. And so there's something to extrapolate from perhaps each of these earnings that we've seen within tech and how that correlates to other areas like broader retail, some of the other areas that we've seen them all touch in one form or another. And so with that in mind, what does that set up for the rest of this earnings season?
It sets up a lot of volatility and new expectations and a renewed focus on valuation and streams of cash flow in the forms of dividends at companies that are well capitalized and have, good spots in their respective industries can deliver.
Julie, I want to follow up on a point in your note that you sent over to us. And you mentioned that your conviction is quality tech bargains. And you say that you're avoiding narrative-driven, unprofitable companies and focused on smaller profitable companies with strong positions in niche markets. Are there any specific names, sectors, or industries that you think investors should be looking for and that perhaps have gone on sale with this latest leg lower?
I think vertical software that is software that's serving a specific industry is where we see a lot of opportunity. I would think of a company like a Duck Creek Technologies or Aspen. These are businesses that have a strong position. They have great relationships with their customers. They provide software that is used every day. It's just their basic software that runs the business. And so they have high levels of recurring revenue, and they have a lot of visibility into what their revenue is going to look like so they can plan their expenses. These are businesses that have great earnings power through a cycle. And I think, generally speaking, the tech sell-off has been pretty broad-based and indiscriminate. And so a lot of these are at a pretty reasonable valuation.
You know, we had this major question and discussion earlier around whether or not a lot of the buying had already taken place, even if you had people that had a long-term range that they were setting back at the end of January, whether that was rotation in their portfolio or not. Just looking at some of the discounts that were already out there, has a lot of that buying for the dip, for those discounts that were there at the end of January, has that already taken place? And do you expect even more of that buying to emerge, Julie?
You know, it was still pretty indiscriminate, right? You still saw a bid across the tech space, and it's not very discerning. What we've been hoping is that earnings is going to separate the true fundamental stories that are intact and strong from those that are just kind of being swept up in the tide that's lifting all valuation boats in technology. So for us, it's really a point of view on the quality of earnings, right? How many people are putting write-downs or stock compensation or whatever else. And then also guidance. What kind of confidence do management teams have in their ability to deliver predictable earnings? I think the real place that's been disappointing, if you look at earnings overall, just across industries, it hasn't so much been earnings themselves, it's been guidance.
Tim, want to switch gears here and ask about the Fed. Is the bigger risk that the Fed over-tightens and slows down the economy at this point, or is the bigger threat that it doesn't move enough to bring down the multi-decade high rates of inflation we've been seeing?
I think the biggest risk is that the Fed doesn't focus on data and react appropriately to how this unwinds. That's the key. I think they have all the tools to bring inflation under control. It's just a question of how orderly they can do that and how much disruption you're going to have in these companies that have earnings and profits that may be 5 to 8 to 10 years out that are going to have to access the capital markets again for additional funding.
Tim, when you think about tomorrow's jobs report that we're going to get, any significance that the markets can extrapolate from that with regard to how the Fed may continue to move forward?
I think if it's very negative, then that'll be one of the things that the Fed considers. It may be the difference between getting a 0.5 point increase or a 1/4 point increase. And later in the year, it may be the difference between getting 4 rate hikes like Goldman Sachs is predicting, or maybe just they stop at 3 and they focus more on reducing their balance sheet and some of the other tools that they have at their disposal.
Julie, are you seeing any opportunities right now outside of U.S. equities? Are you seeing any opportunities, emerging markets, international stocks? Where else are you looking that investors should be considering?
I think you can find opportunities for businesses that have strong network effects, right? A network effect is probably the business model that is the most durable. So, you know, a company that we might like is something like a Rightmove. That's a listings company in the UK. They have a really strong network effect, very high levels of market power. That's the kind of business that we'd look for. Whenever I'm going to be moving outside of GAAP, IFRS accounting, I want to know that the business has a lot of structure that protects it and the earnings are durable.
And so are there sectors right now where you continue to look for opportunities in this near future? The individual names that we've been tracking over the course of this week, it's been remarkable to see some of the price reactions on earnings. But when you think broadly, broad strokes perhaps, across some of those sectors that have yet to report this earnings season, Julie, where are some of the emerging themes that you're going to be keeping tabs on?
You know, the things, it's really hard. If I've learned anything over the last 2 years of COVID is that it's really kind of a waste of my time to try to predict what the next 2, 3, 4, 5 years look like, right? It's so hard to figure out. There are sectors that I know I don't want to be invested in, right? Everything related to business travel for me is pretty dicey because I do think that sector is pretty permanently impaired. So that's a sector that I'm avoiding. But generally speaking, I just try to find great businesses that can do well in good times and bad so that I don't have to pull my hair out trying to guess exactly which way the world's going to go.
Julie Beal, who is the portfolio manager over at Kane Anderson Rudnick, and Tim Pagliara, who is the Cap Wealth CIO, joining us here today. Thanks so much for the breakdown and the time here in the after hours. And we're keeping close tabs on earnings that are coming across the wires. We are getting results from Amazon. Ticker symbol AMZN is jumping, as Destiny's Child would say. It's up by about 12.6%. And for that, let's toss things on over to Jared with the results.
Got to put a ring on Bezos's finger here because we need needed this. You can see it's already erased all of the day's gains here, up about 13% here in after-hours trading. I don't want to bury the lead. If you have an Amazon Prime membership in the U.S., the price is going up. Now, this applies to members after March 25th, if you're already a current member. For new members, February 18th. And they're going to raise the price of Prime membership to $139 per year from $119, so $20 more. If you're paying the monthly, that's going to go from $12.99 to $14.99. It's that pricing power that may be giving some enthusiasm for the stock right now. Here are the fourth quarter results. EPS coming in at $27.75 versus $14.09 1 year ago. Net sales, $137.41 billion. Here's what's interesting. It's actually a little bit short of the Wall Street interest estimate of $137.82 billion, still up about 9.4% year over year. I want to get to some of the other key numbers. Amazon Web Services, its net sales were $17.78 billion, just barely topping the estimate for $17.23 billion. That is an increase of 40% year over year. And then a couple of other key metrics. Third-party seller services, net sales excluding foreign exchange, that is up 12% versus the estimates of 12.8%, so a little bit of a disappointment there. We're also going to be excluding FX for this, which is subscription services and net sales. Those were up 16% versus the estimate of 20.6%, so a little bit of disappointment there. But Amazon Web Service, I gave you the raw numbers before, they are up 40%. The estimate was for 36.1%. That is Amazon's cash cow. That is what gives them their profit. So nice to see that there for them. Also, their outlook pretty strong. They see first quarter net sales, actually a little bit light here, first quarter net sales of 112 to 117 billion estimate, and the estimate was 120 billion. Sorry if I confused you there. So first quarter net sales, this is a projection, 112 to 117 billion. Pretty much lower than the estimate of 120 billion. They also see first quarter operating income of 3 to 6 billion. The estimate was 6.06 billion, so not even getting the estimate there in their high watermark for that particular number. Now, they also issued a statement that their higher costs are driven by labor supply shortages and inflationary pressures, which persisted into the first quarter due to Omicron. So a bit of disappointment in some of the headline numbers, but I think there's a lot of optimism about the pricing power of Amazon Prime. I don't know about you guys, but I guess I'm going to be paying $20 more for that this year.
Jared, sounds like I will be doing the same thing with my Amazon Prime membership. Thank you so much for that breakdown. And the earnings roll on with Ford numbers now crossing the tape. Pras Subramanian is here with more. Pras, give us the details on this report.
Yeah, Emily, shares bouncing around here now lower in the after hours after initially being higher. It was a top line beat for Ford, reporting $37.7 billion in fourth quarter revenue. That beat the Bloomberg estimate of $34.79 billion. However, adjusted EPS missed estimates, came in at 26 cents versus 45 cents, which is the Bloomberg estimate. Full year net income was 17.9 billion, and a company adjusted EBIT was 10 billion. That was in between their guidance range that they gave last quarter. And Ford ended the quarter with $36 billion in cash, $32 billion in equivalents. They're also noting this includes the Rivian stake, which has actually gone down in value from $10.6 billion to $6.6 billion as of right now. Guidance for the rest of the year, very important here. They upped their guidance for full year adjusted EBIT for 2022 to 11.5 billion to 12.5 billion. That's from the 10.5 to 11.5 billion they had last quarter. And they also expect to see continued variability in supplies of key components due to COVID shutdowns, and they're expecting increased commodity costs. Global production capacity for battery electric vehicles, they still see at 600,000 units for 2023. On the call, want to hear more about those chip shortages and component shortages in the near term. We note that GM had mentioned this last week in their earnings, saying that they had the chip shortage was easing, right? Also, I want to hear more about EV plans, investment, transformation. Maybe we're going to hear about this potential new investment in the EVs that Bloomberg was reporting from CFO John Lawler and CEO Jim Farley in the earnings call later today.
All right, shares of Ford moving lower here in after hours by about 6.8%. Yahoo Finance's own Pras Subramanian, thanks for breaking down the results here for us, Pras. Appreciate it. And everyone, coming up on the other side of this short break, we've got much more on Amazon earnings. Shares moving higher in after hours on the results. It was a mixed bag if you have an Amazon Prime membership. We've got more on the other side.
Welcome back. The earnings parade continues this afternoon with Snap reporting fresh quarterly results. Yahoo Finance's own Jared Blickery is back with the details. And Jared, this stock is shaking off earlier losses, now up well over 20% after hours, and well over 30% after hours. How are the results looking?
I'm just shaking my head here. What a day for this sector. First, the Facebook losses, where we saw Snap down in sympathy about 23.5%. It is now up 34% on some outstanding results. So just about erasing the day's losses and probably a little bit then some. Let me get to the numbers. Revenue coming in at $1.3 billion for the fourth quarter. Estimate was for lower at $1.2 billion. Adjusted EPS 22 cents versus the estimate of 11 cents. So doubling that. And then we have adjusted EBITDA of $326.8 million. That is up 97% year over year. Almost double the estimate of $179.4 million. So really knocking it out of the park when we talk about profits. Free cash flow, another important metric, ending at $161 million versus a negative $69 million a year ago. And the estimate was for quite a bit lower, $114 million. Daily active users, another metric everybody looks at, 319 million, just edging out the estimate of 316 million. That's up 20% year over year. Most of that coming from the rest of the world, not the United States, not North America or Europe. Now, the average revenue per user was $4.06. That's up 18% year over year. Estimate was for a bit lower, $3.81. And when you look at what's happening in North America, that's their big revenue center. Those users, they got $9.58 per user from. Estimate was for quite a bit lower, $8.91. And then the rest of the world, not contributing as much, but that's where the user growth came from. They are contributing $1.12 per user versus the estimate of $1.11. Now here's their forecast for the current quarter. They see revenue of $1.03 billion to $1.08 billion. Estimate was for lower, $1.02 billion. And they also see adjusted EBITDA of about zero versus the estimate of $23.8 million. Also, in terms of their daily active users, they're going to see about 328 to 330 million. Don't have a comp on that, but I do have some notes from the earnings report. They're saying many of the supply chain and labor-related headwinds faced by advertising partners in the fourth quarter challenges entering the first quarter, a lot of those have been rising to the surface. And also, while the company has made significant progress in navigating those iOS platform changes, that's Apple right there in the fourth quarter, they believe it's going to take at least a couple more quarters for advertisers to build full confidence in the new measured solution. So up 38% now in after-hours trading. Incredible. Incredible.
All right, Yahoo Finance's Jared Blickery, thank you so much for that breakdown. Well, another stock that we're tracking is Amazon. And just moments ago, Amazon reported its latest quarterly earnings results. And one big headline, Amazon Prime membership prices are going up. Santosh Rao, head of research at Manhattan Venture Partners, is here with more. And Santosh, this is a $20 price increase on Amazon Prime memberships, now starting at $139. What does this mean for Amazon going forward?
Well, it just shows that they're confident of their pricing power, and they'll get it. Amazon Prime is a great service, and I don't think they'll have any problem. It'll pretty much it'll be accepted. So it's good. It's one of the growth engines, I guess. Prime is, and raising prices there was in the equation for the company, and they've done that. So which is good.
This business and its margins, it's still comes down to the web services and how they're able to continue to move the dial forward there. And so from the growth perspective, what opportunities still lie ahead for Amazon in continuing to try and not just retain what they've already amassed, but build on top of that market share? And do they need to make acquisitions in what we've seen in an acquired or growth strategy across the tech landscape to essentially add on to cloud positioning?
Absolutely. I mean, they have amazing market opportunity ahead. I mean, retail, e-commerce is just 20% of the overall retail market. So on that end, there's a lot of penetration to be had. So that will do that. Then on the other end, they still have to penetrate groceries and apparel and all the other categories as well. And then in the international segments, I think they're pretty much, even in the US, they're pretty much done with the fulfillment centers all over. So that should help in expanding sales there. So overall, I think there are a number of other services in there that should play in to the overall revenue mix other than just the core business. So AWS continues to be solid. They delivered this quarter as well. So I think the beauty of this quarter was that, and that's why the stock is rallying, is that there were no real surprises. Everything was essentially in line. We knew about the headwind with costs and labor and all that, and it was very well telegraphed. So I think they came in, and it looks like they managed much better than what we thought. The operating margins were much better. Operating income was much better. So I think that's great. And looking ahead, looks like some of the issues of 4Q and earlier will flow into 1Q. So we're seeing the estimates are slightly light, but I think overall down the road, I think the market is confident that they can manage all these issues and continue to grow. I think that's what the market wanted, and that's what they got.
How much growth do you expect to continue coming from Amazon's e-commerce business in terms of actual increases in the volume of unit sales, not just because of the increases in prices that we're seeing from Amazon Prime, but actually because that volume is continuing to rise?
Yes, that's a good question because competition is coming up. I mean, the brick and mortar guys have really ramped up. The Costco's and other services have also ramped up. So there is competition. But then these are the best of breed. They have the lead on otherwise. They are the incumbent leaders, so to speak. So they will continue to grow. It's not as fast as before, but they will maintain their speed. I think, if I remember right, it's about 10%. The top line, the core business will continue to grow. So I think that part is not at risk. They have a good competitive position in that area. Not as fast as before. Competition is getting intense, but they can maintain their competitive lead with all their extensive offerings.
One of the particular areas that continues to catch my attention for Amazon is in the advertising services, and particularly because of the growth that we've seen there, because of the conversion rate that they have. Is this a formidable competitor to some of the other digital advertising mechanisms that marketers have been able to lean into, and primarily thinking about Facebook and Google here?
Yeah, I think they have a unique advertising opportunity here because they get to there's no third party stuff, so they can actually really attract a lot of advertising dollars just based on their platform. I mean that's something unique about them, and it's growing pretty fast. It's at a 10% growth rate. The advertising revenue is. So I think they will continue to grow on that end, and they have a unique offering because they have this captive audience, and they can really get some good advertising dollars there. I think that's their beauty. They don't have to really depend on other things.
Santosh Rao, who is the head of research over at Manhattan Venture Partners. Thanks so much for joining us here today to break down Amazon's earnings results that have come in. AMZ and shares moving higher here in after hours trading. And switching gears here, we want to get to this next conversation about restaurants and how they can chart their comeback and whether or not some of them might be down forever. Well, Hudson Riley, who is the National Restaurant Association Senior Vice President for Research, joins us now. Hudson, that's the big question. Where can restaurants chart their comeback, and do you believe that they will?
Absolutely. Basically, of all the industries in America, the restaurant industry was the one that was most severely impacted in terms of employment and sales declines. But you look at what's happened in 2022 so far, it is definitely a sober start, but 2022 will definitely be better than 2021, and 2021 was certainly better than 2020. But the fact is, this year we're looking for close to $900 billion in sales overall. But most importantly, on an inflation-adjusted basis, that is still well over 11% below where the industry was in 2019. So it's a long road to recovery, but the consumer has documented quite well over the past couple years that they enjoy and will continue to use restaurants in their daily lifestyle, except there has been a very big move to what we call that off-premises market, takeout, delivery, and drive-through.
Hudson, and to that point, what types of restaurants do you think are going to be the ones that ultimately persevere? Is it going to be just the national chains that have the scale to weather these virus-related concerns? Is it restaurants that can pivot to primarily setting up ghost kitchens? Or what qualities of restaurants are you looking for to really succeed in this environment?
Well, to generate that $898 billion in sales, there are actually 70 different segments of the restaurant industry. And many are a unique industry unto themselves, and they have different income statements, different operational characteristics, different profit margins. But overall, the industry is comprised of mainly small businesses. And so consequently, obviously, over this 2-year period, tens of thousands have gone out of business. But you do see, even over the past year, that new ones are being developed. And one of the most important questions for the industry over the upcoming several years is what happens with that remigration pattern of workers back into these city center areas. Because when you look at the development of the industry over the past decade, these city center areas were quite important to the development of many of these independent operations. And as those workers exited the city centers and went to the more suburban rural areas, some of the operators followed them. But the fact is, even with a hybrid work model, say these workers come back 2, 3, 4 days a week, that still indicates that there are going to be meal occasions that are missed in these city center areas.
Certainly. Okay. And so from that point and perspective, you bring in the conversation of where some of those higher ticket purchases or higher tickets seen because of business, either lunches or just business and entertainment type expenses, where that comes into play. And that also dovetails into the type of employment that restaurants can put forward. And so the question being here, what level of employment will reemerge on the other side, and what amount of that employment will actually shift towards things like ghost kitchens or restaurant adjacent services?
Those new business models are going to be quite important. Obviously, they were in development pre-pandemic, but the pandemic accelerated the expansion of many of these new business models. And overall, industry employment, the restaurant industry is the nation's second largest private sector employer. And through December, restaurant industry employment was still down by over 650,000 positions. And that's well over a 5% drop off of that pre-pandemic peak. So as the industry moves forward, these new business models will obviously capture some of that employment growth. But in the end, it still remains a hospitality service business. And there's been a huge amount of technology integration into the industry that will continue. And in many ways, that has expedited the use of that carryout delivery curbside model, because what happens with the digitization of restaurant menus and ordering is that it allows consumers to really have additional channels to place their orders and get these meal solutions. So on-premise dining was obviously quite well hit with those on-site dining restrictions, but it is coming back. And when the association research asked about pent-up demand for restaurant usage, particularly table service, and that includes the higher check operations, it is substantially elevated as to where it was pre-pandemic. So the consumer is quite clear they want to get back on site, and that will happen as the pandemic ebbs.
Bank of America was out with a new note pointing out that for the weekend of January 29th, restaurant spending was down 12% on a 2-year basis for those aged 76 and over due to the latest spread of Omicron. How crucial is it that older consumers return to restaurants in person for this recovery to take hold?
It's a great question. And the new State of the Industry report the National Restaurant Association just released spends a large amount of time discussing how restaurant behavior differs dramatically by these age groups. And so when you look at how, for example, the Gen Z and the millennials use restaurants, what their expectations are regarding restaurants, it is entirely different than the Gen Xers and baby boomers. So when one's thinking about the future restaurant industry customer, they expect to have a high level of service, hospitable, levels of technology which are rapidly advancing. And in the end, it still is an environment where all restaurant sales end up being local. And so from the consumer perspective, it's clear they enjoy going to restaurants. They view it as an essential part of their lifestyle. And at the moment, a lot of that need has been on that off-premises market. All the meal periods for off-premises are up, on-premises are still down substantially.
Hudson, we got to leave things there on the day, but we'd love to have you back to continue this conversation. Very important one for employment as well as small businesses and larger chains as well. Hudson Reilly, who is the National Restaurant Association Senior Vice President for Research, joining us today. We appreciate the time. And before we depart, everyone, we got to get you an update on ATVI. Shares moving higher by about 0.1%. That is despite a miss on both the top and bottom lines in their most recent earnings report that's just dropped. Revenue came in at $2.48 billion. That's versus the $2.65 billion expected. Earnings per share, $1.25 versus the $1.31 expected there. We're going to leave things there on the day. Thanks for joining us here on Yahoo Finance Live. We will see you again tomorrow at 3 p.m.
In this episode of Influencers, New York Congresswoman Alexandria Ocasio-Cortez.
Capitalism at its core, what we're talking about when we talk about that is the absolute pursuit of profit at all human, environmental, and social cost. A lot of these price increases are potentially due to just straight price gouging by corporations. If we just allow a full just continuation of student loan payments, we are talking about a catastrophic development for millions.
Hello everyone and welcome to Influencers. I'm Andy Serwer and welcome to our guest, Representative Alexandria Ocasio-Cortez. Representative, nice to see you.
Thank you so much.
I know you want to talk about student debt and some other issues as well, but before we get to that, I want to ask you about inflation and interest rates and Fed Chair Powell, who recently said that the strong labor market made it appropriate for him to soon raise interest rates. I wonder what your take on that is.
Well, I think particularly when we have this conversation in the context of inflation as well, it's really not just labor, it's not just rising wages, but there's a lot of different dynamics that I think are contributing to the increase in prices, whether it's supply chain complications, yes, labor issues, but sometimes lack of labor, a lack of the ability to be able to work consistently in their jobs, which is also tied to pandemic controls. And also, there's a real distinction to be made between inflation and price gouging. And there's a lot of evidence that particularly industries with high concentrations, corporate concentrations, whether it's almost oligopoly level industries, a lot of these price increases are potentially due to just straight price gouging by corporations.
Are you concerned about inflation and higher interest rates and the impact on working people?
I mean, wherever prices are increasing and it's making it difficult for someone to be able to feed their family, that is always going to be a major point of concern, a primary point of concern. But the real key is making sure that we're diagnosing the causes correctly, because the danger here is that if we say we're helping working people too much and say that the cause of this is, oh, it's because we provided too much assistance during the American Rescue Plan, stimulus checks were too generous, that is why we are dealing with the problems that we're dealing with now. What that's going to result in is a pullback in the assistance that some families need the most right now. And when we already talk about the cessation of the child tax credit with the failure to pass the Build Back Better Act before the end of last year, we really need to be very careful about diagnosing these issues correctly. Because on the flip side of that coin, if we say there are real antitrust issues here, there's a lot of corporate abuse of power leading to price gouging, then that allows us to pursue lanes such as antitrust and also pursue labor protections, COVID protections that can help people get back into the workplace and stay safe in the workplace.
Right, and so you are seeing those who are suggesting that it's because of the assistance that people had during COVID that's inflationary and therefore we need to swing the pendulum back.
Yeah, and I couldn't disagree more.
Right.
I couldn't disagree more with that assessment.
Student loan debt, and I know you've called repeatedly for President Biden to forgive student loan debt. Why hasn't that happened, and what do you think will happen if the pause that exists presently is allowed to lapse?
Well, I cannot understate the danger and the risk economically, politically, and just where we are right now as a country of allowing the moratorium on student loan payments to lapse in May. If we just allow a full just continuation of student loan payments, we are talking about a catastrophic development for millions, the over almost 50 million student loan borrowers in this country. There were millions of student loan borrowers that were already defaulting going into the pandemic. But more than that, we are at such a delicate point in the financial and just general economic recovery post-COVID that to then restart payments that are essentially the size of a mortgage payment, sometimes even larger, on a generation that was already so devastated, not just by this, but the recession, et cetera, I believe it could it could throw out of balance already what is a very fragile recovery. And not only that, but this forgiveness forgiveness is the just thing to do, it's the right thing to do. Why the president hasn't done it yet, I'm not sure, but I do think that this is an issue of increasing urgency. He has already indicated an openness to it, and he has actually already used his authority to forgive student loan debt in certain small, very narrow cases.
Because there are people who suggest he doesn't have the authority. Is that a legitimate argument or just maybe a smokescreen?
I don't think it's a legitimate argument. In fact, we've seen him use the same legal authority that the president has used to suspend student loan payments is the same authority that he would use to cancel them. And not only that, but he has used that authority. He has indicated a willingness to use the authority. And I think that it would be extraordinarily important and urgent for him to do so.
And what about the argument that it's a moral hazard? In other words, you're letting people off the hook by forgiving the debt.
Well, what I think is the true moral hazard here is the surging costs of education in the United States. What has actually created the moral hazard is this guarantee of saying we will issue minors hundreds of thousands of dollars in student loan debt at almost any level with almost no limit, and we will allow colleges and universities to dramatically increase the costs of their tuition with the guarantee of that loan value on 17-year-olds. So what is the actual true moral hazard here in the situation is the controls on the cost of education in the United States. And one very important control in this, to that note, is tuition-free public colleges and universities. Because then what that does is that it introduces competition into the market to which private universities have to actually meet a lower baseline. But people act as though it's just fancy public schools that are extremely expensive now. But public college tuition has also increased dramatically far beyond the pace of inflation.
We'll be right back with more from New York Congresswoman Alexandria Ocasio-Cortez. Welcome back to Influencers. I'm Andy Serwer, and I'm here with New York Congresswoman Alexandria Ocasio-Cortez. You have a huge social media following, obviously, and a big platform. Have you been either surprised by how much or how little influence that affords you in Congress? In other words, how does that translate, Representative?
That's an interesting question. I think it's the way that I've thought about it, first going into office and then continuing, is that in Washington, there are a lot of different sources of power. There are some members who have extraordinary connections to different power players, different power centers that are very well connected and networked. There are other individuals who are very, frankly, financially connected. Industry, lobbyists, corporations throw their weight and donate and give their influence, their lobbyists, et cetera, throw an enormous amount of their support behind other members of Congress. So every single member kind of has their assets that they lean on. And for me, I decided early on, because I don't accept money from corporations, I do not take meetings with lobbyists, I am not well-connected, I don't come from a well-connected family or community or anything like that, that my ability to navigate and advocate is going to have to be squarely rooted in relying on everyday people and their support and my ability to communicate with them what is going on in Washington.
It's an interesting perspective. You self-identify as a democratic socialist and have called capitalism irredeemable, I believe. But what does that really mean? And does that mean capitalism should be eliminated? And are your views compatible with capitalism?
Well, I believe that in a broad sense, because when we toss out these big words, capitalism, socialism, they get sensationalized and people translate them into meaning things that perhaps they don't mean. So to me, capitalism at its core, what we're talking about when we talk about that is the absolute pursuit of profit at all human, environmental, and social cost. That is what we're really discussing. And what we're also discussing is the ability for a very small group of actual capitalists, and that is people who have so much money that their money makes money and they don't have to work. And they can control industry, they can control our energy sources, they can control our labor, they can control massive markets that they dictate and can capture governments, and they can essentially have power over the many. And to me, that is not a redeemable system for us to be able to participate in for the prosperity and peace for the vast majority of people.
So people talk about stakeholder capitalism, right? Like Larry Fink at BlackRock, where the weighting for different constituents besides shareholders is more equal. Is that something you'd be amenable to?
Well, I think at the end of the day, it's it is about who has control over the very core assets of production in society. If it ultimately comes down to a billionaire or the Koch brothers or the Koch family having control over the vast majority or large plurality of our oil assets in the United States, if it's a handful of very wealthy families having control over, private families having control over means of production, that is essentially the capitalist system that we live in. It is a small group that is of privatized control over what we eat and how we fuel our society. Now, where we can transition to, and there are certain ideas where we're talking about, for example, Elizabeth Warren has discussed workers being elected to the boards, governing boards of companies, and also, we're here in the Bronx. I represent a community that has the largest concentration of worker cooperatives in one of the largest concentrations in the world. Now, these are alternative ways of doing business. Free markets are not the same thing as capitalism. And you can have markets where businesses and ways of producing, trading, selling goods are are really controlled, and not just controlled, but given more power to workers. People get a fair shake. Union jobs, unionized workplaces. All of these are different steps and levels that we're talking about in a more just economy.
Congress people trading stocks. You have come out calling for a ban here. And I wonder, and there seems to be some momentum, but I wonder why this seems to be such a difficult thing to pass. And is Speaker Pelosi a roadblock here?
Well, you know, it's not really a mystery to me why it's difficult to pass. An enormous amount. I wouldn't be surprised if it was a majority of members of Congress hold and trade individual stock. I don't know the actual numbers, but it is a very large degree. And you know, the key here is that it's not to say that you can't have a retirement fund or a college savings account.
Or a blind trust.
A blind trust, right. A mutual fund, an index fund. These are vehicles of investments that are broad that individual members of Congress don't have direct control over. But even last year, there was at least 75 members of Congress that held individual stock in Johnson & Johnson, Moderna, and Pfizer. We're talking about in the last 1 to 2 years. And so that is where we should be drawing the line. I am a member of Congress. Members of Congress have access to very sensitive security clearances. We have access to very detailed, tailored briefs. Our job is to try to anticipate and legislate for what we see is coming. And we should not have the ability to both have access to that information and be able to hold and trade individual stock. And that's really what this is about. It's about our ability to direct and hold trades in individual stock with access to the sensitive information that the public has given us.
Voting rights reform. Is that a dead issue? It's tied to the filibuster. Mm-hmm. Joe Manchin, Kyrsten Sinema have come out against it. What is your take on where that stands?
You know, this is, I think, one of the top level questions and issues that we have before us in Congress. I very much believe that we are at the precipice of a return to Jim Crow style laws across the country. We're already seeing these wheels in motion, attempts in Texas and Georgia and across, across many different states, attempts at voter suppression. And frankly, what Senators Manchin and Sinema failed to recognize, and what is disappointing and sad to see, is how ahistoric their stances have been throughout this debate.
We're going to take a quick commercial break. We'll be back with New York Congresswoman Alexandria Ocasio-Cortez. Welcome back to Influencers. I'm Andy Serwer, and I'm back with New York Congresswoman Alexandria Ocasio-Cortez. What is your ultimate objective when it comes to those big tech companies, Representative?
Well, when you look at a company like Facebook, you can't kind of put them all in in the same boat. They do different things. But when you look at a company like Facebook and the completely corrosive ways that they have exercised an abuse, I believe, in civil society writ large, not just our democracies, but you look at, for example, what we're hearing from other countries when we talk about production of vaccines or perhaps like what we can do to export, help them. They say it's not just, there are some things that the United States provide that are welcome. There's also things that we want the United States to stop exporting. And one of those things is disinformation. And disinformation through US-founded companies like Facebook that have absolutely slowed and frankly sabotaged the global effort to fight against the coronavirus. And we see this disinformation used both in the public health sphere. We've also seen social scientists have truly shown the impact that Facebook has had in contributing to social violence and perhaps even accelerating large-scale, very dangerous, and some would call genocidal activities in places like South Asia, et cetera, human rights abuses, and also hate here at home.
But I'm curious, what do you think we should do about them, or what we should do to them, I guess?
Facebook should be broken up. We should pursue antitrust activity on Facebook, and there are so many different reasons why. They are acting as an advertiser. They are acting as both platform and vendor. They are a communications platform, which has historically been a well-established domain of antitrust. And so because there are so many businesses and industries in one, the case is, I believe, right there in and of itself as to why they should be subject to antitrust activity.
I want to ask a couple of personal questions about you. I'm teaching at Columbia this semester, and one of my students, Penny Ramirez Fernandez, wanted me to ask you, how did being a waitress help you understand the American economy, its successes and failures?
Well, I mean, I believe that my time as a waitress is the most politically formative experience that I had. It's that, along with just growing up in a working class family, experiencing just the ravages of the Great Recession, almost losing our home, all of that. But particularly the years that I spent working in restaurants. The thing about restaurants is that it really is such a crucible of so many different public policies. I worked alongside undocumented workers. I didn't have health insurance. I tried to buy Obamacare, the ACA, Affordable Care Act. I actually used and relied on the policies that were coming out of Washington. And I worked, I was a Senate intern back in college. I got an economics degree. I worked in public policy spaces. I also had worked for nonprofits. There is an ocean of a difference between the white papers and the policy you see on paper and how it's experienced by everyday people. And unless you actually go on to the exchange and try to buy healthcare for yourself and use that healthcare and understand how it's serving you and how it's not serving you, it's very difficult to understand why so many people are frustrated by otherwise well-meaning, sometimes democratic policy.
As a former dishwasher, I can relate. So I want to ask you maybe a kind of funny question about the moniker AOC.
Okay.
So is that what your friends and family call you, or no. When did that sort of evolve? When did you become AOC?
I actually think it's funny enough. AOC really emerged after I won my primary. And I think there were a lot of pundits on television that were kind of like stumbling, because my name is Alexandria Ocasio-Cortez. And when it was the news story after I won my primary, it was so sudden. And there were just all these folks on TV that I think were kind of like struggling to say my name, that it actually started coming from TV. And so, you know, in the past, there were some folks that would sometimes say it like jokingly, but it was never a nickname that stuck. But I think it actually kind of came from media pretty overnight, but my friends don't call me that. The folks that I organize with.
Do they call you Alexandria?
They'll call me Alexandria, or they'll call me Alex. My friends will call me Alex. But yeah, it's a, you know, it's shorthand, but I now embrace it, welcome it, accept it.
And final question, maybe it's too early in your career to ask this, but I'm going to ask it anyway. How do you see your legacy going forward?
You know, I always feel like, I actually think that it is important for young people to ask themselves questions of legacy very early. And I think the reason that that's important is because we shouldn't root our legacy in a position or a job or a role, but we should really root it in a mission of what we want to do qualitatively and how we want to be remembered. And I don't think it's ever too early to consider that, because it helps us make decisions, it helps us root us in our values and our morals. And I just hope that for me, you know, what I do and what my community understands and receives and feels from me as their representative is someone that always puts the people of this country first, that doesn't allow herself to be dissuaded or distracted by power, influence, etc., and that we are dissuaded and relentless and honest and authentic in our pursuit for a better world. And that, you know, that in that pursuit, we just tell it as it is and try to do everything we can in every moment that we can. And I think that's pretty much it.
That's it. Representative Alexandria Ocasio-Cortez, thank you so much for your time.
Of course, thank you so much.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.